For a weak start today, they've slashed their outlook. The new CEO facing weak demand, also having to deal with tariffs. And VW got the tariff story on their mind too, weighing on Audi, weighing on Porsche. So we watch those shares. They've been down on TradeGate. Will they be as well at the open? Tom, we are moments away from the European cash trade.
It's the earnings story and his expectations that maybe you get fewer than 2 cuts from this Federal Reserve on the back of stronger jobs data that is tying in to the markets right now. Worth noting again that the Asian session was weak, snapping at that run of gains. Of course, global stocks still near those record highs, but some question marks now when it comes to the earnings story and how to think about how much support is going to come through from these central banks. In terms of the pricing, we're looking at the FTSE 100 opening just modestly higher. In fact, range bound right now, starting to get a bit of a grip on the situation with NatWest will be playing that role. We know, of course, that the Prime Minister Keir Starmer will be in Scotland meeting with President Trump, of course, over the weekend. We'll see if there's any more details in terms of that US-UK deal. So you're flattening right now on the FTSE 100. We're expecting pressure to come through on the DAX when that opens. No print yet. The CAC 40 is down 0.5%, and no doubt LVMH will be leading lower on that. We'll get the details in terms of that particular stock. But softness when it comes to the CAC 40, down 0.4, and the DAX still not opening. The IBEX over in Spain just down 0.1%, but of course we're going to be watching VW and Puma when it comes to the DAX. And again, the ECB sounding reluctant to go further. 2% is where they've held rates, of course. Will they go again by the end of this year? The trade story will be central to that, Lizzie.
Well, Tom, we are waiting for the DAX to open, but at the moment, sectorally, bottom of the basket are the autos, and Valeo is at the bottom of the basket. We're going to be speaking to them later on in the programme. We wait for the result, the share open for VW, but not far behind autos sectorally is consumer products and services, down 0.7% because we've got a whopping great move to the downside from Puma off the back of them slashing their outlook, weak demand, tariffs weighing on them, and those shares down 20% as things stand. Another one to the downside off the back of earnings is Signify, but a bit of upside from NatWest. Maybe we would have expected a bit more. We, of course, were speaking to the CEO earlier. NatWest raising its guidance, unveiling this £750 million buyback, but the share's only up 1% as things stand, and the broader banking sector, much of a muchness really, in the middle of the basket, only down 0.25%. The only sector that is in the green this morning, Tom, this Friday morning, is utilities, up 0.1%, but it's negativity across my screen, both in terms of the sectoral picture and the whole of the European story.
Yeah, in terms of some of those individual movers, again, of course, Valeo, we're going to be speaking, as you say, to a key executive of that business, currently down a little over 10% with that exposure to the auto sector. The challenges are there, of course, in terms of pricing, in terms of margins, in terms of the tariff story as well. The broad benchmark, Stock 600, now down 0.4%, but of course, in the context of the gains that we've seen more broadly this week, the FTSE 100 now down 0.2%, and the DAX, with that print lower, down 0.8 on the German benchmark. Lizzie.
Well, we have Volkswagen open now, shares down more than 2% after the company lowered its financial outlook for the year as US tariffs bite. For more on the ground in Wolfsburg, we have Guy Johnson at the VW factory. But we'll be coming to him in just a moment. I just want to go through those VW results. Volkswagen cutting its outlook, US tariffs weighing on Audi and Porsche in particular, but a bit of upside when it comes to the EV sales for Europe. The drivers looking to Volkswagen instead of Tesla, it seems, because of Trump's ties to Elon Musk.
Tesla has seen its shares sales dropped double digits in both France and Germany. So can they take advantage, VW, of that drop and that pressure on Tesla, of course? Look, Guy was on the ground for us and Wolfsburg. You saw the factory humming there. But clearly this is a company that is exposed not just to the tariff story and the pressure in terms of the cost, but also the Chinese market as well. They've been embedded in the Chinese market for more than 2 decades, and that market has not yet turned around for VW. Guy Johnson, of course, joining us from inside the VW factory, and Guy has been speaking to the CFO. Guy, what have you been hearing?
Hey, Tom. Yeah, I've been speaking to Arno Andlitz. He is the CFO here at Volkswagen. As we can see, the stock is down this morning. Actually, I thought earlier on that maybe it would be down a little bit more than what we've currently got. This is a company this morning that has come through and cut its margin guidance. We've now got a new range, 4 to 5% is the new margin guidance. And the reason basically for that is because of the tariffs. However, we don't have a deal yet. So how on earth do we calculate exactly what that tariff impact is going to be? Well, they're basically telling us at the upper end of the range that we are at around 25%, that you're going to see potentially a 200 basis point hit coming through for Volkswagen. At the lower end of the kind of 10% range, obviously that number is significantly lower. Now remember, Toyota got a 15% number, so you can probably do the maths on exactly what that is going to look like, but clearly there is a hit coming through here. So I spoke to Arno Andlitz. He is the CFO of Volkswagen. This is what he had to say.
To give you an indication, on a 12-month basis, a 27.5% would be 200 basis points weighing on our margin.
In terms of what you expect to get, Toyota got 15%. Is that a kind of number that you think you can get here at Volkswagen? Can you live with 15%? Give me the margin hit at 15%.
Okay. Obviously, I cannot really comment on a specific number. That's clear.
No.
What I can say, 50% would be in the middle of the range, what we just gave. And what I can also say, I mean, look at our industry. Yeah? We make 6 to 8% margin. And currently we are faced with 25% tariffs.
Yep.
So this is clear, we need a good solution, and a solution that fits both the needs of the American administration, but also the European automakers. And by the way, not only the European automakers, also our customers and dealers in the US. Give you just one number, in June our sales were down 25%.
Yep.
And that has a huge effect also for our dealers and their families.
Could you live with 15%?
Okay, as said, we need a good compromise, and we gave a range between 10 and 25%.
Once you get the number, will you be able to give a much more accurate figure when it comes to the margin? I.e., will you reissue guidance when you get the figure?
We were very transparent, and we gave you the number for 25%.
Yep.
That's 200 basis points.
Yep.
So and for 10% is 60 basis points.
So I can do the
so
maths.
you can do the math for whatever tariff, you get the burden, and you can compare that to our guidance. So we are very transparent on that.
Are you going to have to make more investments in the United States? Is that now on the table in terms of what you're going to have to do as part of any package that is likely to come from the White House?
Look, we are a key market leader in Europe. We have a comeback plan in China, but we want to grow in the US.
Yep.
And that was true before, and that is still true. Look, we invested a lot in the US already, 12 billion. We operate the factory in Chattanooga, but we have only 4% market share.
Yep.
So US is still our, and will be in the future our growth market. And we also invested in a very exciting project. I don't know whether you know the Scout project.
Yes, no, I've seen the Scout project.
So it's really
I've seen one. You've got one just kind of over the road. Looks very nice. But you've also invested in Rivian as well.
Yes.
There would appear to be some logic at the moment of going, why not just buy Rivian and take the factory you were going to use for the Scout, for instance, use that for the Audi brand, which is struggling in the United States because of the tariffs, because you make them here, you don't make them there, and actually start to maybe reorganize as a result of a, let's call it a 15% tariff number. Isn't this the moment to rethink some of the plans in the United States? The US administration is making it hard to build electric vehicles in the United States. They're going down. Is now the right moment to do Scout?
So these were a lot of information. So first and foremost, let me elaborate a little bit on Scout. So So first and foremost, it is a great brand.
Sure.
We have a great heritage.
Yep.
And it will be not only electric power, we will add a range extender.
Yep.
So Scout will have an electric portion, but it has a range extender, and that gives us a range of 500 miles. So we are quite confident that this package, a very robust design, great interior, with the 500 miles of range, will meet the demands of the American market. And in terms of synergies, we use synergies for the Scout project. For example, electric engine that we will use for Audi. And Scout will be also one of the first projects that gets the software from our Rivian JV.
Okay. But how do you get Audi and Porsche back to double-digit margins if you're not going to build them in the United States? Can you get Audi and Porsche back to double-digit margins if we are going to see, let's call it 15% tariffs?
I mean, we explained that already. We look into the opportunity to build Audis also locally, but this is too early to give you
but it is a possibility.
It is on the table.
How much money do you think you're going to have to invest in the United States? Is it more than you've invested now? I think Toyota's done more than 60 billion. You're nowhere near that kind of a number. Is that number that you've put on the table for the United States going to have to go higher as a result of these tariffs?
We invest in Scout, and this is a big number already.
Yes.
And of course, if we would invest into a factory for Audi in the US, that number would go up.
That number would go up. So, but I've heard the word massive being used. What does massive mean?
Too early, too early, guy.
But north of where we are now.
In terms of investment, clearly.
So you think you are going to have to invest more in the United States?
We will, we want to grow in the US. It's a growth market, it's a strategic market for us, and we want to continue to invest in the US.
But give me an order of magnitude. Is it much, like massive would seem to imply that you are going to do a lot more. You are going to put a lot more money to work in the United States. You don't have a figure in mind?
Too early to give you a figure.
Okay. In terms of what you are going to be doing in terms of the portfolio, there's been some suggestions that you may be offloading some brands, some parts of the business. How far down the road are we in terms of understanding what that's going to look like? And do you have a timeline?
What? Can you repeat it?
In terms of maybe rationalizing the portfolio?
Yeah.
Give me an idea of where you are in terms of your thinking.
When we talk about rationalizing, we basically talk about restructuring.
Yeah.
And we communicated the restructuring program, for example, for Europe, for brand Volkswagen, and this is massive. Yep. Now we adapt our capacity in Europe to the market's needs in Europe, and we reduce our headcount, and we will also streamline the industry here.
Analyst, the CFO here at Volkswagen in Wolfsburg, speaking to me a few minutes ago. Look, guys, I think he's in a really tough place right now. They've given us a reasonably broad approach to how they are looking at the tariff story, but they don't know the number. And it's really tough when you don't know the number to figure out exactly what the business is going to look like. They know at the upper end it's probably a 200 basis point hit on the margin. But after that, we've got a lot still to figure out. What kind of investment are we going to have to do in the United States? That's a question that Volkswagen is still going to have to answer. Do we need to reorganize our current plan? Clearly, this tariff story is making life very, very confusing for Arno and the rest of the team here at Volkswagen. Do we get more clarity when we get the number? When do we get that number? I don't know, nor do they. And I think that's probably why the share price maybe isn't down as much as we would have thought first thing this morning. This is a margin cut. Normally, you would see a fairly big price reaction off the back of that. But who knows? Certainly Volkswagen doesn't know at the moment. They've tried to give the market some sort of an indication, but they are struggling. But I think the takeaways are, yes, tariffs are going to have an impact, and yes, Volkswagen is going to have to invest more money in the United States. How far does that go? Where does that go? Does that resolve the issue, particularly around Audi and Porsche? We don't know yet. So it feels kind of at the moment as if we're in limbo. But they've given us some numbers, they've given us a rough guide, the market's reacting to that, but we need an update. And I think that really is the story out of Volkswagen, out of Volkswagen this morning. Guys, from the factory, back to you.
Guy Johnson, great interview, pinning him down on some of those details amid, of course, all those questions that still remain for VW in the broader sector. The stock now down 2.6%. Guy Johnson, of course, anchor of the opening trade on the ground for us at Wolfsburg, of course, the headquarters of VW. Let's get to some of the more individual names as well. Other names on the move today. We're talking about VW. Let's check in on some of the core 6 when it comes to the European stocks to watch for us. Novo Nordisk, of course, within the drug space, down just 0.1%, a little bit softer in the session. A fairly larger drop, of course, for LVMH. Not a big surprise given the sales softness that came through towards the end of the day, European time yesterday, with that sales drop, and particularly, of course, the squeeze continues in China for the maker, of course, of Louis Vuitton handbags and Dior luxury goods, going down 1.5%. Ferrari a little softer as well, the luxury car maker down 0.6. 0.9% is the drop you're seeing for ASML within the chip and semiconductor space, and a drop of 1.5% for Schneider Electric. Nestle, it came out with earnings earlier this week, just down 0.2%. The earnings, of course, giving some detail in terms of the pass-through on costs and pricing. Let's get some more of the individual stocks on the move this Friday and bring in Chloe Melly from our stocks team. Chloe.
Good morning, Tom. Let's start with Puma. So a major drop this morning in Puma shares. We're down about 18%. It did cut its outlook. It cited, of course, the tariff impact on earnings, but then also the fact that there's really weak demand really for athleisure and sportswear, and that's really weighing on Puma at the moment. And investors are reacting very negatively to that. A major drop this morning. Moving on to Deutsche Bank. So Deutsche Bank actually had obviously a great day yesterday with results that were welcomed by the market. It is down 2% this morning, and this may be because we had a downgrade from Citi analysts that said that the results that everyone was really excited about were actually a little bit average, and there was kind of limited evidence of revenue progression going forward. So it might be paring some of those gains today on the back of that. Now, moving on to a completely different sector, to drinks, to cognac. We've got Rémy Cointreau. It lifted its guidance this morning. It said that there was really good sales of cognac in the US, and then also it avoided the worst of the tariff impact in China, and that is leading the shares up 3.3% this morning. So quite a good morning for the spirits maker. And then finally, we have got Carrefour. So Carrefour, last night, it announced that it was selling its Italian operations that were kind of weighing down the earnings a little bit, and it also reported earnings that were quite good, that kind of were better than expected. The company is kind of in the middle of a strategic review. It's thinking about different asset disposals, and that seems to be kind of encouraging investors, and we are up 3.5% this morning on the back of that.
All right, Chloe Melly, we thank you. Chloe from our equities team, thanks for all your work this week. I want to add a stock in of my own. Valeo shares are down 13.5%. They're weighing on the autos and parts basket, the worst drag on that sector, and it's the bottom of the sectoral basket across Europe. They have had a full-year revenue forecast missing estimates, and we're going to be speaking exclusively to the company's CEO, Christophe Perella, live from Paris next. So stay with us for that interview next. This is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg. Bringing you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hordern in Alberta, Canada, and this is Bloomberg.
Welcome back to the opening trade. We're nearly 20 minutes into today's session, and it is not a happy Friday, I have to tell you. We've got red across the screen in Europe. Underperformance, in particular, from the DAX in Frankfurt, weighed down by Puma shares, down more than 20% this morning off the back of their earnings. But, Tom, we've also got misery for the autos and parts sector. That's at the bottom of the sectoral basket, down 1.3%, and a lot of that comes down to Valeo.
And VW as well, of course. But Valeo is the one we're going to be speaking to right now, focusing on, because shares, to your point, tumbling this morning, currently down 13.4%, a 13.4% drop for this company. The automotive supplier, of course, the worst performer among its peers so far after revising lower its revenue forecast for the year. So revisions lower for the full-year revenue picture. Let's cross over live to Paris now and talk to Valeo's CEO, Christophe Périllat. Christophe, thank you for your time this morning. What are the key headwinds for the business right now?
Well, the market is not so great, as you can imagine, and you had a great interview from the CFO of VW that says pretty much the same thing. So that's one of the headwinds. The second headwind are the currency exchange. We have half of our revenues in euro, and we have half of our revenues in other currencies. And all these currencies have, devaluated versus euro by 10 to 15% since the beginning of the year. This is what led us to lower the sales guidance. But when we have revenues in one area of the world, we have costs in the same area. And this is the reason why we've been able to keep our EBIT guidance. And frankly speaking, it seems to me that the stock reaction this morning is an overreaction, because when you look very carefully at our publication yesterday, there's 2 points. Point number one is our financial margin, our margins are improving and our costs are down. And the second point is we're preparing the future with great orders received from our customers in the first half at the rate of 130% of our sales.
Okay, so you would describe the market reaction down, the stock down 13%. That reaction today is an overreaction in your view. When it comes to that improving margin picture, Christophe, to what extent could that be derailed if we don't get a US-EU trade deal?
Well, it will not, because we have, in terms of manufacturing, local policy. We have basically an industrial footprint that's local. It means that we are producing in North America when we sell in North America. We're producing in Europe for sales in Europe, and we're producing in Asia for sales in Asia. So when it comes to the Europe slash US negotiations that are going on, there's no impact for us of such negotiations at all.
Okay, so really, on the factory floor, you're not seeing the impact of US tariffs manifesting on your business?
Can you repeat the question, sorry?
So are you seeing US tariffs having a manifest impact on your business on the factory floor?
No, they have not, because, you know, as I said, we are manufacturing in North America for the North American market. We pretty much have no finished product, you know, crossing the oceans. So we are sensitive to Mexico versus US, but here we've made a great work to make sure that our products are you know, USMCA compliant. It means that they have enough local content in North America not to be subject to a significant tariff. So we do have a few tariffs coming from the Mexico to US trade, but we've been managing these tariffs quite well. And you know, at the end of the day, the net impact for us in S1 has been quite you know, minimum. And this is what enabled us to continue to improve our EBIT by 0.5 points from 4% last year to 4.5% this year, despite all these headwinds.
Yeah, it's really fascinating to speak to a business who seems to be somewhat cushioned from these headwinds. But, you know, one issue that does remain a big topic for Europe is production overcapacity. How are your clients dealing with that?
Well, you know, the European volumes are not so great, and this is why we have we've done quite a lot of restructuring in Europe as far as Valeo is concerned. You know, we've embarked into a restructuring plan that was, you know, in my opinion, very well dimensioned versus the market, and you know, have in mind as well that we're growing in Europe. You know, despite the fact that the market is down, our sales are growing in Europe, and we're growing in Europe because we are you know, right positioned on the technologies of the car of tomorrow. We have more content basically in the car of tomorrow than on the car of yesterday, because we're positioned on electrification, because we're positioned on you know, ADAS, which is a you know a very good technology. We're doing we're helping the cars to be connected. So we really have done the work to reposition the company on these technologies that, you know, will increase their content in the car of tomorrow. So we have restructured in Europe. This is done. We've done the work of last year and in the first half of 2025, and we're going to benefit from these lower costs moving forward.
Christophe, more broadly on this sector, we know, of course, the auto sector is challenged on a number of fronts. As you look into 2026, do you see a turnaround? When do you see a turnaround for this auto sector?
Well, we're not planning for a turnaround. We're just planning on our own strengths because we don't know what's going to happen. The only thing we know is that there will be challenges, and basically there have been challenges. When you look at 22, 23, 24, the semiconductor crisis, the inflation, now the tariff, I mean, the sector is facing multiple headwinds. What is important is to make sure that we have a plan, despite multiple headwinds, to continue improving step by step, semester by semester, year after year, our financial indicators. And of course, EBIT is one of the key ones. And this is what we are doing. Look at the free cash flow in the first half of 25. It's doubled versus what it was a year ago. So we're making our own work to be more competitive, to be more profitable, to benefit as well from this transformation of the industry, whatever the market, whatever is going on in terms of headwinds.
Okay, Christophe, so good to have you with us this morning. We thank you for making the time. The Valeo CEO, Christophe Périllat. We'll continue the autos theme next. This is Bloomberg.
Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
Now we're playing. Yep, now we're playing. First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5.
Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
We made 6 to 8% margin, and currently we are faced with 25% tariffs.
Yep.
So this is clear. We need a good solution, and a solution that fits both the needs of the American administration, but also the European automakers.
That was Volkswagen CFO Arno Antlitz speaking to Guy Johnson, of course, on the ground at their headquarters in Wolfsburg. Earlier this morning, we brought you that interview, of course. Let's get more analysis right now on the broader auto sector and bring in Horst Schneider, head of European Autos Research at Bank of America Global Research, someone with deep expertise in this space. Horst, thank you for joining us. As we think about a potential deal between Europe and the US, what would a 15% tariff deal mean for the auto sector of Europe when it comes to future margins?
Well, that's hard to tell because the companies have not really yet told us what is their margin forecast in this scenario. We have written a report about that, and we highlighted that then maybe the margin hit could be something like 1%, 1.5%. If you include mitigation measures, then maybe the impact is only anymore 0.5 to 0.7%. But it really depends on import-export flows. What is in the end the capex credit that's going to get granted? Is there any capex credit that will be granted? So it all depends on that. The uncertainty really company by company remains very high.
More broadly, when we speak to executives, there is a sense, we didn't get this so clearly from Arno, the CFO of VW, but we have had that sense from others within this space, that just getting a deal, just getting certainty in terms of where that tariff rate settles will ultimately be better than where we're at now for this auto sector. If we finally do get some, at least certainty going forward, pushing into 2026, how much of a benefit is that picture for this auto sector? Can they start to rewire and push for growth?
Yeah, that is something I don't really understand, I've got to tell you, because in my view, a 50% tariff isn't something that you should celebrate. I mean, we have seen a tremendous rally in the European auto sector, especially amongst those companies which are maybe the most hit by the tariffs since the 9th of April. To me, it looks a little bit like buy the rumor, sell the fact. So I'm not so sure why the market celebrated also this Japanese trade agreement, because it still assumes a net burden. You're right that certainty, of course, is better than uncertainty, but then basically, you need to work from here basically against the tariff burden. That means the car companies need to raise prices in order to mitigate the impact. If you raise prices, usually there's a price elasticity and demand goes down. So maybe we discuss next, what is the impact on demand if inflation increases in the US?
Well, yeah, what's the answer to that question, Horst?
Sorry, can you repeat that, please?
Well, what's the answer to that question on inflation?
Yeah, what's the answer to the question? I don't know. I mean, we see that also that the market forecasters, S&P, for example, they revise the forecast every quarter. They are also not sure about that. We have seen so far that the companies have hardly raised the prices. Therefore, also the impact on demand was not yet really there. We expect at the moment that in Q4 we get a little bit a step back in the US market. But it really needs to be seen what then the impact on 2026. But I would be surprised if the impact of all these tariffs is really positive. It should mean that the demand stays muted. I think we debate in the end, is the market flat or is the market down, right? I think that's a debate in the end.
Well, I wanted to ask you really, because of course VW there is kind of putting a finger in the air when it comes to the effect of tariffs on its business. What is the biggest threat to the European autos industry at this point? Is it actually tariffs, or is it weak Chinese demand? Is it the EV legislation?
Well, I would say there are so many risks that we cannot enumerate them just with one hand, right? So therefore, you're absolutely right. China remains a risk. Tariffs remain a risk. If global trade gets deteriorated or is disturbed, it's not great for any of the car makers, especially for the German OEMs. That's clear. Then we have got also disruption. We have got still this shift to EV. We have the shift to autonomous driving. I think the shift to autonomous driving is more significant, or is the biggest threat even than the shift to EVs. So therefore, let's wait and see. We had recently also warnings from Renault, from Stellantis. They talk about increasing commercial pressure in Europe. So therefore, I think there are enough burdening factors. But nevertheless, the auto sector has been up. It's cyclical, heavily shorted. It's cheap. Market has rallied. And then people look for cheap cyclicals, and therefore maybe they bought autos. Let's see how long this rally lasts.
When you look at Tesla, Horst, missing estimates, Musk warning of difficult times ahead, but really not a lot of detail when it comes to this guidance. What do you read between the lines in terms of the outlook for Tesla? Are you worried about Musk continuing to be involved in politics?
Well, I'm not so sure about this Tesla because keep one thing in mind: in US dollar, it's the most valuable auto stock in the world. So the market seems to see there's still something that creates value. You're absolutely right. Elon Musk has said the next quarter is going to be bumpy. Q3 is still strong. After the next 3 quarters may be weak. He's counting still biggest hopes on these autonomous cars. The market, I think, does not yet really believe it, but the market cap tells us maybe that the market is believing it somehow. So therefore, I'm not so sure. I do not want to imagine what happens if Tesla produces at one point maybe positive news. So therefore, let's wait and see. I think this Tesla stuff, all the questions are very hard to answer. I think it's still all about autonomy, about robotaxis, will they get launched, etc.
Horst, given the collapse in sales for Tesla in Europe, particularly France and Germany, which European OEM or automaker is best positioned to take advantage of that and take market share from Tesla?
Well, what we have seen year to date, that Volkswagen have taken most advantage for that. So if you look at the EV market share in Europe, I think it has roughly doubled since beginning of this year. So basically, the market share that Tesla has lost, Volkswagen has taken. I think the other car makers, they still struggle, except BMW. What I'm a little bit worried about is that when Tesla comes with a low-cost car to Europe, and that's going to happen in the course of 26, that they also take back market share again. So therefore, I'm not sure how long we can celebrate these market share gains. But for now, of course, the answer is Volkswagen has taken the market share.
I want to zero in on something you said earlier about autonomous driving maybe being more disruptive than even the shift to EVs. I haven't heard that many people make that argument. Just unpack that for us, and who is most vulnerable to that shift?
That's a good question. I think all legacy OEMs are affected by that, because in the end, the problem of the legacy OEMs is that they still sell a lot of ICE cars, and in the ICE cars, it's hard to accommodate basically autonomous driving. You need to find the tech structure that can implement basically autonomous driving in ICE vehicles and also in electric vehicles. And I think the only car maker who has managed that so far is BMW, but let's see, they have also not yet launched the vehicles. We're going to see that only next year. And all the other car makers, they still struggle. I think Volkswagen, for example, is on a good track with the partnership with Rivian. They can maybe get ahead of BMW even in 2028. About the other mass market car makers, I'm not so sure, because it's also an expensive device, this autonomous driving. And I'm not sure if the customer really pays for that yet there.
Okay, Horst Schneider, Head of European Automotive Research over at Bank of America Global Research. We thank you so much for joining us this Friday. I hope you enjoy your weekend. We've actually, Tom, seen autos and parts improving as a sector throughout the programme, even though we've had our autos theme. So actually, they're about 3/4 of the way down the sectoral basket now when it comes to the Stock 600. But coming up, we're going to discuss the outlook more broadly for these markets with Kieran Nandra, Head of Equities over at Jupiter Asset Management. That conversation next. This is Bloomberg.
Estava sitiada. Nisso eu começo, eu tremia, não sabia o que fazer. Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home, they are suffering, and someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being a billion-dollar business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Nisho talia ki kon ahma ta suara pangop ahma le pah manchang le nyai kun mamanya. Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
This uncertainty, it's fascinating talking to clients. The impact on any given client's business of the tariffs, whatever the arrangement will be, can be very varied.
If the consequence is that there will be a step up in tariffs, if this tariffs is like, I don't know what, 15%, it should be manageable.
When you look at scenarios in these times, I think we had more than 20 scenarios.
If it's 15%, yes, there will be an impact on the activities, Europe, US. But if you look at the options that Europe has, the calibration, the step up in their own investments, that should normally compensate.
We did
the tech transfer of the one remaining medicine that we had never produced in the US, and we had to do a tech transfer for.
Everybody's sort of positioning for how am I going to participate in that investment wave or be a supplier into all the things that in Europe we need to invest in. And that's definitely going to be an offset to whatever the headwinds are that come from the trade arrangements.
European business leaders speaking to us here on Bloomberg TV about the tariff situation amidst a very busy week of earnings. And joining us now for analysis is Kieran Nandra, Head of Equities over at Jupiter Asset Management. Welcome back, Kieran.
Nice to be back.
I wonder what you've made of earnings season so far. You just heard a load of CEOs talking about the tariff impact. Were you surprised by how much we've heard so far? A lot of it is kind of talking about uncertainty, talking about currency headwinds. Are you expecting more of a direct impact from tariffs later in the year?
Yeah. So I think the one thing that, so first of all, kind of we're pretty early on yet with earnings. So I think probably around 10% of companies have actually reported. But I guess the big difference for me, for us this quarter versus last quarter, is that last quarter we were getting a lot of company management teams that were understandably, I would say, skirting around the issue of tariffs, just given the really high level of uncertainty. So clearly company managements are grappling with that as we just saw. I think this quarter that's actually changed at the margin, which has been pretty interesting. So now we're having a little bit more granularity, a little bit more certainty, if you want to call it that. Just with the management's actually addressing head on whether they expect these kind of impacts to be passed on to consumers, whether it's going to be the middleman, the kind of retailers who are taking on those hits, if you like. So we're actually seeing company managements now actually kind of engaging with that, actually coming out and saying this is how we expect it to impact earnings. But we're still really, really early days yet. I would say that it's probably reinforced our preference for those companies that show much more of that kind of self-help ability. Europe's been through a lot. We've had Brexit, we've had the Ukraine war, we've had tariffs, etc. That's clearly been something that companies have had a lot of practice, I would say, in terms of just being able to grapple with those. So I think the big thing is that we're just seeing companies now coming out and giving a little bit more certainty, if you want to call it that, in terms of how they're going to be kind of navigating this issue.
I like the psychology of it. I feel like I should lie back in the chair as we analyse all of this. That's the company perspective. As we look at it from a stock perspective, of course, we've got the deadline August the 1st coming up next week. Do you expect volatility to ramp up as we get to that?
So I don't think so. Initially, some of the numbers that we were kind of expecting. There were numbers that were coming up as high as kind of 30%. I don't think that was kind of fully at all baked into numbers and baked into stock markets. We are seeing now. Just judging from the commentary that's come out as well, we are seeing a bit more kind of coalescing around that 15% number. I think just having, frankly, a level of number that people can coalesce around, I think would be helpful. But I'm sure there'll be a lot of noise in the run-up to that.
Is there irrational exuberance in these markets right now, given the uncertainty?
Oh, no. I would say, if anything, I know if you look at kind of valuations, and that would be my measure of, and kind of earnings kind of revisions as well. So when I look at valuations, I don't think we're seeing anywhere near, I would say, rational exuberance, especially so in European markets. European markets are trading at around 14.2 times. So granted, they're not sort of screamingly cheap as they were, 6 months ago, call it, but we had really, really bearish sentiment. I would say, actually, that, in terms of what's been driving European stock prices, let's face it, it's been more kind of dividends, it's been more kind of re-rating. What we need to see now is some of those kind of earnings numbers really picking up. So we're seeing those earnings consensus numbers increasing. We've got some pretty positive, I would say, expectations for especially fiscal stimulus, and company managements have come out and said they're expecting this to be kind of back half loaded. So I would say we're definitely not in that kind of irrational exuberance stage.
Have we been reminded, given the performance in terms of earnings and the US markets as well, have we been reminded that actually that US exceptionalism trade is not fully dead, that the US has key players that are going to propel and get the upside, particularly when it comes to AI? We've had a reminder of that from the likes of Alphabet. The banks are storming ahead in the US. And yes, we've had a decent banking season in Europe as well. But the idea that US exceptionalism is dead is is premature, no?
Yeah. So I think I would caution. So it really depends on your timeline. So I think one thing that's happened and what has really changed is that the level of political uncertainty that we're hearing from the US is not something that we've really seen before. And against that backdrop, you've got valuations which are still looking pretty punchy for US equities. And if you look at, for example, if you take out those 7 stocks which are still outperforming, the 493 are actually more or less producing the same types of numbers that we're seeing from European companies. So the question would have to be, why would you pay up, that much more for those kind of 493 companies when you can get that same level of earnings growth in Europe?
There's a concentration risk.
Totally. Yeah, there absolutely is.
But away from those key players, obviously you've got the meme stock revival, maybe taking a bit of a breather yesterday. But to Tom's point, doesn't that give you a bit of pause for thought when it comes to the S&P jumping from record to record? Or is it getting a bit frothy?
So I think that the meme stocks, I think, has been something that we've been watching from a distance. That, to me, as I say, it's the fact that we've still got valuations where they are. You've got, as you rightly point out, these meme stocks which continue to kind of have that background interest. To me, there's a bit of a disconnect, I would say, between valuations and sentiment, and then what we're actually seeing on the ground. I would totally agree with that.
Okay, so put that in another basket then. We talked about volatility. More broadly, if you look at the second half of the year, are you expecting less volatility then? Because I saw that you like the banks.
Yes.
The volatility helped the banks in the first half of the year. Surely if it's quieter, it's not going to help the banks.
Yeah, so you're right. So I guess especially for those the banks that are kind of reliant or using those kind of trading revenues, we saw some pretty phenomenal numbers from those banks. I guess the types of banks that we are more focused on would be more of those kind of, I would say, quote-unquote kind of domestically focused, that are more funded by kind of retail deposits, that can really benefit from a kind of an upward tilting yield curve, if you like. So those are the types of banks that we're kind of really kind of invested in. But you're absolutely right. I mean, that volatility is something that the investment banks are absolutely taking advantage of. But in terms of where we find those pockets of value, it'd be much more in those kind of Italian banks, the Spanish banks. They've got pretty stable macro backdrops. There's also a fair amount of M&A as well that's taking place. So there's a lot of kind of, a lot of drivers there, a lot of levers on the bank sector in particular.
You're seeing opportunities. So that's a call in terms of some of the banks, the bank stocks in Europe, and maybe consolidation is a catalyst there. But you also have a view that there are some opportunities in Asia as well. There's a big event happening in China right now in Shanghai, an AI summit as well, where we're going to be hearing from some of the key players there. That is clearly a sector that the government is leaning into. But the growth picture for China is still challenged.
Yeah.
What are the Asian opportunities? You sit in China. You want exposure to those who have exposure to China.
So I would say I would broaden out into the kind of the Asian opportunities. So some of the drivers that are impacting and positively impacting European stocks that move away from US exceptionalism, those factors apply to other regions as well. So I guess the issue with China has been that it's been exceptionally cheap. We've had DeepSeek, which has obviously been a great catalyst for performance. I think what we're looking more at is that regionalization. I think supply chains have a huge part to play there. And then India clearly has been something that I think is a long-term, huge structural opportunity. And then, of course, I think that Southeast Asian bucket as well is something that we're kind of very, we're very positive on.
Kieran, the dollar's had a relatively decent month compared to the whole of the year, right? That's knocked the pound. It's helped the FTSE. Yeah. Do you think that that's going to continue?
So I guess the interesting thing to take on the FTSE actually has been that despite, I suppose, the sterling increasing, you've had oil which has been declining. That's typically an environment where UK equities should really underperform. And I think we're seeing a kind of decoupling, if you like, of that relationship. So I think what's been driving that has been, I'm going to call US exceptionalists again, that valuation, the huge valuation discount that you've got in UK equities. And just I think the diversifier impact that UK equities have. So we are seeing that kind of interest coming back into UK equities. We have seen foreign buyers coming back in at the margin. And if you look at kind of cross correlations of UK equities in a global equity bucket, I mean, it's a hugely positive impact. So I think that's kind of...
Just briefly, where are we in that story when it comes to UK equities and whether or not there's further to run?
Yeah, so I guess a lot of what's been driving, we had some pretty decent results from the UK banking sector as well. I think aerospace and defence will still continue to be a big driver of returns. I say we're a little bit more sanguine on the consumer cyclicals, just given where we are on the fiscal situation. So I think that still has legs to run. And things like the dividend, the income, cash flow generation, that still remains incredibly strong. So again, that's really much kind of a bottom-up story.
Okay, Kieran, thank you very much indeed. Kieran Nandra, Head of Equities at Jupiter Asset Management. Now, President Donald Trump, meanwhile, been downplaying his clash with Fed Chair Jay Powell over cost overruns during a tour, pretty remarkable pictures, of the central bank's renovation project yesterday, though he did make it clear that he saw the issue of lower interest rates as a more pressing concern.
Well, I'd love him to lower interest rates, but other than that, what can I tell you? We had a little talk about it, and I thought it was a very productive talk. He'll be able to tell you at his next meeting, but I will say that he did say the country's doing really well. His term comes up soon. I think he's going to do the right thing. Everybody knows what the right thing is. Even people that believed in, the higher rates, they're all on board. They all want to see the interest rates come down. It's very important.
Okay, let's bring in Bloomberg's Valerie Teitel for more then. So we look at those remarkable pictures and, of course, a bit of a debate, bit of sharp words, at least trading barbs over the cost overruns, as they've been described, at least by the White House, when it comes to that Fed renovation. But also a reminder that this is a president determined to pressure Jay Powell and the Fed on lower rates.
Yeah, no, that's right. I mean, not only is it just a rare event that a U.S. president even enters into a Fed building, we haven't seen one do so in 20 years, but especially not two that have had such disagreements, and a president that has expressed vocally his political pressure to get the Fed to lower interest rates as soon as possible. He wants them lowered as soon as the next meeting on next Wednesday. So it's extraordinary pictures of the two, this fight between them, this anger that President Trump has had with Jerome Powell being basically televised to the media in quite a spectacle yesterday. I mean, it was extraordinary to even see the U.S. president pressure Jerome Powell, standing next to him in the Fed building in front of cameras. I think that's something that's going to go down in history as pretty remarkable to see. Note that he did talk about the renovations. He did claim that the renovation cost has now exceeded $3 billion, but Powell was there to tamper those remarks, saying that included some prior renovations that had finished 5 years ago. But still, Trump is throwing criticism at the Fed renovations and how expensive the bottom line of that has led up to. But again, he did say, which I found quite interesting, that the project itself overrunning wasn't enough to dismiss Fed Chair Powell, saying that his firing wasn't necessary. And as you heard there in that video, saying he thinks that Powell will still do the right thing, which is widely known as what Trump wants is to lower interest rates as soon as the next meeting. It does, I guess, go very much against what the market has priced in. We're not pricing a single basis point of easing next week, and the full cut from the Federal Reserve isn't priced in until October, so in 3 meetings' time.
And speaking of which, when it comes to the ECB, the odds of a September cut falling to 20%, Val, as we speak, given that hawkish hold and all the mood music that we heard out from Christine Lagarde in Frankfurt yesterday. Bloomberg's Valerie Teitel, we thank you. We've got the weekend to look forward to, Tom. Plenty on the docket. The Belgian Grand Prix, the Women's Euro final, the Tour de France final stages, and I'm heading up to Scotland for Donald Trump's visit to his golf courses. Thanks. I'm married to a Scot, so I'm allowed to do it.
A bit more of the Scottish accent. So you're going to be teeing off in Scotland with President Trump, maybe, on the courses up there. I'm definitely going to be watching the Euro finals. This is a big game for England and the Lionesses versus Spain in the final. And they've kept us on the edge of our seats versus Sweden and versus Italy, of course. They actually beat Spain earlier this year. So maybe there's hope. There's certainly hope for the Lionesses against Spain in the final. Don't forget, of course, to tune in to Bloomberg Next Africa. That is today for the latest monthly episode. This month, the show airs from the G20 Finance Ministers meeting. The Pulse is next. This is Bloomberg.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
President Trump says he will not fire the Fed chair as he clashes with Jay Powell and pushes for lower rates during a rare tour of the central bank. The global stock rally hits the brakes as uncertainty over U.S. monetary policy snaps a 7-day winning streak. Plus, tariffs weigh on European earnings. Both VW and Puma cut their outlook as trade concerns mount. So we've had that run-up, of course, in terms of the equity markets this week, taking a bit of a pause. Then you saw the downside in the Asian session, and the earnings story is not helping Europe at this stage. Also a repricing in terms of these central banks, with markets now and traders fading some of those cuts expected for the Federal Reserve. Fewer than 2 cuts now being priced. S&P futures then, worth noting that they did notch up another record, the 10th record by the end of the close yesterday on Thursday, out of just 19 sessions. Today, futures pointing modestly higher by 0.1% when it comes to the S&P futures. The benchmark 10-year yielding 440, yields are up 1 basis point. Again, you can tie that to expectations around the Fed. You had strong jobless claims numbers in terms of fewer jobless claims, and therefore suggesting that the labour market of the US remains relatively resilient. Euro-dollar at 117, largely unchanged in the session. Let's take a picture at the map then and see how the story is shaping up with the earnings front and centre. The disappointment around VW, the disappointment around Puma. Part of that is the tariff story, as we mentioned. The CAC current also lower by 0.4. That's the LVMH drag. That is part of the story there. Sales dropping more than expected when it comes to the luxury goods maker. The DAX, though, down 0.8%. Autos under pressure. When it comes to the UK, we'd started with a more resilient picture at the start of the open. Now down 0.3%. NatWest coming through with a beat in the banking space. We have some breaking lines coming through in terms of the health of the German economy. Germany's July IFO Business Confidence Index coming in at 88.6, a little softer than the estimates. 88.6, the estimates had been for 89. And in a short while, I will be speaking to the president of the IFO Institute, Clemens Fuest, as well. So stay tuned for that conversation about how the health of the German economy is shaping up, given the fiscal stimulus, but offset, of course, to some extent by the tariff and trade concerns. Pre-market, let's check in on Intel, because the CEO disappointed analysts in terms of communicating around cost-cutting versus building out for that AI future, and that is pointing lower by 4.4%. So the pressure is on the CEO right now, of course, taking the helm relatively recently, and it was the comments, again, about cost-cutting, that being the focus, more than building out. And they still don't really have a solution in terms of how to get proper skin in the game when it comes to AI. The start of the show, the Pulse, starts right now.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning. Welcome to The Pulse. I'm Tom McKenzie in London, in for Francine Lacqua. President Trump then says he will not fire Fed Chair Jerome Powell after making a rare visit to the central bank, the first by a sitting president in nearly 20 years. The pair publicly clashed over cost overruns during a tour of the Fed's renovation project.
It looks like it's about $3.1 billion. It went up a little bit, or a lot. So the 2.7 is now 3.1.
I'm not aware of that.
Yeah, it just came out.
Yeah, I haven't heard that from anybody at the Fed.
Yeah, it just came out.
Our notes had it about 3.1 as well.
3.1.
3.2. This came from us?
Yes. I don't know who does that.
You're including the Martin renovation. You just added
our entire capital.
Yeah, you just added in a third building is what that is. That's a third building.
Well, no, but it's a building that's being built.
No, it was built 5 years ago.
There's a lot you can read into that. That is going to be great fodder, though, for the late night shows, isn't it, in the US? Let's bring in Bloomberg's Valerie Teitel right now. The physical presence of President Trump being in the building with Jay Powell, standing alongside him, having that awkward exchange. There is a monetary policy implication to this.
Well, I mean, not only was he criticizing Jerome Powell on the cost overruns of the Federal Reserve renovations, but he went on to basically pressure the Fed chair right in front of the cameras in the Fed building to cut interest rates at the next decision. And after so, Tom slapped him on the back and walked away. So it goes to show that even though Trump says there is no tension between the two, it is clear that President Trump is trying to amp up the pressure on Fed Chair Jerome Powell to lower interest rates, saying at one time that I want to see just one thing happen. It's very simple. Interest rates have to come down. So an extraordinary sight to see one of a U.S. president pressuring the Fed chair in the Fed building in front of televised cameras.
Not a scene we get to see every day. Meanwhile, U.S. equity markets notching a fresh record high. We've said that a number of times this week, 10 times in the last 19 days. What is the next catalyst for these markets? Are things looking a little overstretched at this point, Val?
Well, before people would say it was going to be the earnings season that was going to be a catalyst for the equity market, and it's turned out quite okay. The S&P 500 index has notched a record high every single day this week, and with futures pointing in the green, we look to make it maybe 5 in a row. This coincides, Tom, with the VIX, the kind of Wall Street fear gauge, the implied volatility gauge, dropping to a 5-month low. And if you actually look at NASDAQ 10-day historical volatility, it's dropped to a 4-year low, Tom. So this decline of volatility, almost like markets are getting used to this kind of political show from President Donald Trump, not fearing necessarily tariff headlines anymore, is something that's really been opening the door for more gains in the equity markets to come. It was helped out yesterday as well by the fact we did have jobless claims coming in, declining for a 6 weeks in a row, hitting a low they've not seen since early April. So this kind of idea that we're getting used to volatility, we're getting used to what's coming out of the Trump administration, alongside still good news that the U.S. economy is humming along, is helping the U.S. equity market notch another record.
Valerie Teitel, thank you very much indeed. Let's bring in another perspective on these markets right now. Angel Ubida, who's head of economic research for global fixed income and macro at Citadel. Angel, good morning.
Good morning.
Thank you for joining us in the studio. I want to start then with the Fed. The markets are repricing around possibly fewer than 2 cuts from this Federal Reserve. And Valerie was talking about the relative strength of the labour market. And there's a clear tension now in terms of the data that we're seeing out of the US and the perspective of the US president. How are you factoring in? How are you starting to push out your views around the Fed and what to expect towards the end of this year?
Listen, I think the Fed will do what it needs to do, regardless of all this political pressure. Inflation has been well behaved, and so it might be able to take some insurance against a deterioration in the labor market. And that's what the markets are expecting.
When does that insurance come through?
Whether it's 1 cut or 2 cuts, it doesn't really matter, right? What it's going to do is put the economy in the right footing, and we think, at some point, if the next couple of inflation numbers are good, they might be able to cut rates in September, and that's fine.
Okay. Do you worry about Fed independence?
I don't worry about Fed independence in the sense the Fed is a very strong institution, right? This is not just about the Fed chair. It's a very strong institution. Now, it is important that it remains independent. It's important that it remains independent for monetary policy. And I hope and expect that this will continue to be the case.
In terms of your wheelhouse when it comes to fixed income, the Treasury markets have been relatively well behaved in the last week or so. Yep. Yields have been relatively contained. There's been a little bit of upside pressure, a little bit of selling, but nothing dramatic. Is that the picture that continues through this year? As you look at the curve, do you see further steepening?
Listen, it's all going to depend on the behavior of inflation, right? So far, we've seen a little bit of pass-through from tariffs that has been offset by some softness on services and in other parts of the CPI. If this continues, fixed income markets will probably continue to be reasonably well behaved. A little bit of a steepening if the Fed cuts rates, but that's about it. But there is uncertainty. We continue to have all these trade deals that are coming. We don't know how they are going to look like at the end of the day. There is a little bit of risk in the long end of the curve, definitely.
What would a 15% tariff deal between Europe and the US do to that view?
Listen, a 50% tariff deal basically means that trade shuts down.
15% tariff deal?
15, 1, 5. No, 1, 5 is fine. 1, 5 is fine.
As in, if we get a kind of Japan-style deal between Europe and the US?
I think that would be as expected, and we would expect a continuation of this environment where the tail risk has been cut.
Yeah.
And then markets and companies start making their own plans about this new environment with this level of tariffs.
Europe's economy, the ECB, was that a hawkish hold from Christine Lagarde and the ECB?
Listen, it was the first hold in a series of meetings. So I think we need to understand it in that way. So what Christine Lagarde said, today we are on hold, we are watching and waiting, let's see what we do at the next meeting. It was the right explanation for what they did yesterday.
Are there deflationary risks for Europe, given the strength of the euro?
I think there is a risk that inflation undershoots the target in a persistent manner. Whether that is a persistent deflationary risk over the next 2 or 3 years remains to be seen. It is a risk, and they should take insurance against that.
And given the fiscal stimulus that's coming through in defence spend from Germany, given the strength of the euro and the trade flows, and if we get a trade deal with US, do you start to think about an ECB that is hiking in 2026?
I don't know if hiking is the right concept, but they could stay on hold for an extended period of time while they see how events unfold. And again, they have an inflation forecast that is going to be under 2% for the next 18 months, right? Yeah. They need to be a little bit careful about that.
You put out a note talking about the need for Eurobonds in Europe. I don't know if we have the political consensus for that right now, but what is the case for Eurobonds as Europe faces up to some of these challenges?
Listen, the case, I think, is threefold. If Europe wants to have a strategic autonomy, it needs to have a strong financial market in addition to a strong security and defense. And you cannot have a strong financial market without a strong safe asset. Just imagine the United States without treasuries. This is what Europe is today. The second point, there is a strong demand for European assets around the world. We have this new environment, geopolitical environment, where global investors want to rebalance their portfolios away from U.S. assets. They want an alternative. Europe should offer that alternative, and that alternative is a Eurobond. And the third point, you may have noticed, the ECB has shifted this stance about the international role of the euro. It used to be neutral about it, neither promote nor discourage. Now it's actively promoted it. Christine Lagarde gave a very good speech in Berlin a couple of months ago, where she laid out the case for a strong international role of the euro. That requires having Eurobonds. Otherwise, the euro is not going to be an international currency because there isn't a clear asset into which investors can invest.
Don't you just buy the German Bund in that scenario?
Too small. It's too small. It's just 4 trillion euros.
Yeah.
You need something that is big, that shares the benefits of a safe asset across all European assets, and that's what Eurobonds would do, and we have them. The EU bonds and bills that were issued to finance the next generation EU already exist. They have an infrastructure, they have a futures market, they are accepted in repo. Next year, the EU bonds are going to be the biggest issuer in Europe in terms of flows.
Yes.
So they just exist.
To finance defense spend.
Well, to finance everything, to finance, the current operations of next generation EU. What we need to do now is to come to an agreement that having a strong, big, deep, and liquid safe asset is good for Europe. Go ahead and do it.
Do you have a view on the gilt markets here in the UK as we think about October and the strains on this Chancellor?
Listen, the gilt market still has a little bit of risk premium, right? Whether it's deserved or not is a different conversation. There is a little bit of risk premium. Inflation is higher in the UK than in other areas. That is true. And there are question marks about the stability of public finances. So that's what we have. And as we go into October, we'll be watching very carefully what the next steps coming from fiscal policy.
How on edge, given that risk premium that is still priced into the gilt markets, how on edge is the market as we lead up to that event? How finely balanced is this?
Listen, it's finely balanced, but also I want to insist, it's not just the state of public finances, it's also the behavior of inflation. We have a central bank, the Bank of England, that is still have rates reasonably high, and it's still cutting rates reasonably slowly. So there is a combination of those two factors, the worry about the inflation outlook and the worry about the public finances.
A more challenging situation, arguably, for the BOE than the ECB. Indeed. Angel Ubida, Head of Economic Research for Global Fixed Income and Macro at Citadel. Thank you very much indeed for those views, that analysis going from, of course, the ECB to the Fed, all the way back here to the UK. Coming up, Europe's biggest car maker cuts its outlook as US tariffs eat into sales, talking of tariffs and trade, but German business confidence rises. More on that next. This is Bloomberg.
Loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Welcome back. Volkswagen shares are up, despite it cutting its outlook for the year. Europe's biggest car maker says US tariffs are weighing on its Audi and Porsche brands.
We made 6 to 8% margin, and currently we are faced with 25% tariffs.
Yep.
So this is clear we need a good solution, and a solution that fits both the needs of the American administration, but also the European automakers.
The VW CFO, Arno Antlitz, speaking to Bloomberg's Guy Johnson, who is, of course, on the ground for us at Wolfsburg. What do you make of the shares rising, Guy, and what else the CFO had to say about the challenges going forward for VW?
The challenge is unknown at this point. That is the issue, Tom. And in some ways, actually, Volkswagen is guiding us to a deal that looks very similar to what Toyota got as a result of the Japanese negotiation only a few days ago, 15%. They've given us a range. It's basically 10% up to around 27.5%. Basically, you back out the current 2.5%, you get to a 25% range, 25% level. Basically, the midpoint of that is, let's call it circa 15%. And it's interesting, Oliver Blum, the CEO, was on the call earlier on, basically pointing us in that direction as well. And it seems as if the business is basically saying we could probably manage that And that seems to be the tone at the moment. So in some ways, we are getting some quantification, some quantifying of what the hit is likely to be, because they're basically guiding at the top end of the range. There's a 200 basis point margin hit. And at the moment, actually, it's weird. Companies are being given a pat on the back by the market if they can give the market something in terms of detail surrounding what the tariff impact is going to be. Companies that can't, and we saw that only a few days ago. Texas Instruments was a company like that, GM to a certain extent as well. If you can't quantify it, you take a hit. Volkswagen has had a stab this morning at trying to quantify what the hit is going to be as a result of tariffs, and the extension beyond that being kind of what kind of investment we might have to see in the United States. And I think to a certain extent the market's going, okay, that's fine. We know there's going to be hits. You're giving us some clarity on what we can do on a kind of sequential basis around this. And as a result of which we can maybe take some of the risk off the table. And that, I think, is probably the reason, Tom, why the shares are picking up a little bit. The market can kind of work with this and understand it. You don't have to price in the worst case scenario because the company's giving you something at least to work off in terms of being able to plug into your models.
Yeah, and the CFO, of course, talking to you and saying, look, we're trying to be as transparent as possible, giving that range to you, giving that range to investors. And to your point, the market seems to be rewarding that now with the stock up a little over 3%. When it comes to the Chinese market, Guy, it was interesting. We were speaking to Horst Schneider, the autos analyst. He was saying when it comes to Tesla, VW is probably best placed to take market share from Tesla. When it comes to China for VW, what is the picture there?
So I asked him at the end of the interview, he didn't play that sound a little bit earlier on today about China, and I said, look, Arno, the message seems to be coming from Beijing that actually the competition, the fierce competition that we are seeing in China needs to come to an end. And that certainly seems to be the message coming out of Beijing, this overcapacity, this brutal price war. And he was like, yeah, I think that probably is the case. That's the message that we're getting as well. And I think, again, that should be taken as a positive. It's been absolutely brutal in China, which has been in the past a key market for Volkswagen. And even at the margin, if that price war starts to abate a little bit, if it starts to just become a little bit easier to navigate and understand, then again, that's just kind of at the margin, as I say, a piece of good news for Volkswagen this morning. The other thing to remember as well is that here in Europe, they're actually doing okay. Actually, the turnaround in the core brands like Volkswagen and Skoda are actually doing all right. Normally, Tom, this factory behind me wouldn't be working during the summer, but actually the demand for the products that they're selling on the line, that's the Tiguan line here, is actually fairly good. So there are positives from what we've had out of Volkswagen this morning, despite the fact we've had this margin guidance cut.
Yeah, glimmers of light, maybe. Looping back to the trade piece, Guy, to what extent are they prepared to ramp up investments in the US, given the pressure from the Trump administration, given that pressure in terms of a trade deal? Are they prepared to put more money to play?
Yeah. I think they're going to have to, Tom. And I think there's a recognition of that. They just don't know yet what that number looks like. I spoke to Arno about this, and you heard it in the tape a little bit earlier on, who played on opening trade. I pushed him a couple of times on it, and the answer is, we don't know yet. They're not there yet in terms of figuring all of that out and getting an idea of how much they're going to have to invest. Now, Toyota, their big kind of global competition, has invested a lot of money, north of 60 billion into the United States. Volkswagen's nowhere near that at this point and will probably have to push, therefore, fairly hard. Now, they're doing a bunch of things. They are investing. Remember, they bought a stake in Rivian, so it's going to be interesting to see what they do with that and how maybe they put more money into that. Maybe they buy that. I'm just speculating here. I don't know. But you've also got this new product coming through, which is going to be the Scout, which is a kind of storied brand in the United States, which has got a lot of history there, and they're hoping that that's going to take off as well. Now, that was going to be an electric vehicle, but they're going to add a range extender to that, just to give it, I think, a bit more breadth in terms of the offering that we are likely to see. But I think without a doubt, Tom, there is going to have to be more investment in the United States, particularly with Porsche and Audi struggling in the way that they are at the moment with the tariffs. Those are the two brands that are most exposed. Tom, from the factory here in
Bloomberg's Guy Johnson.
What a fantastic scene, as you say it is. Back to you.
Yeah, love the backdrop. Great stuff. Thank you, Guy. Now, to a broader lens on the German economy, because German business confidence has risen, but not by as much as expected. The Ifo Business Confidence Index rose to 88.6 in July, up from 88.4 in June. Clemens Fuest, the president of the Ifo Institute, joins us now. Clemens, what is the current health of this German economy? To what extent is sentiment being powered by expectations of a deal with the US?
Good morning. Yes, that's a factor. There is the hope now that there will be a deal with the U.S. And maybe also less uncertainty about how things will be going on and what tariffs will be. So that's one factor. The other factor, of course, is the debt package decided by the German government. So there is the infrastructure fund that will have an impact. Companies hope they will benefit from that. And there is the investment booster, so incentives, new tax incentives to invest that have been introduced. And we see in the data that investment goods producers are actually showing improved data. So their business situation improves and their expectations are boosted by that. So there seems to be an impact. But this is more domestic factors rather than the tariffs, where there is hope, but also continued uncertainty, of course.
What do you think? What is your best estimate, Clemens, you and the team at the Ifo Institute, in terms of what a 15% tariff deal between Europe and the US, if that's what we get, what that would do for the prospects of the German economy through 2025 and into next year?
It would be something German exporters could live with. So, of course, exports will become more difficult as a result of this compared to the situation last year or before Trump. But, we would avoid a massive negative impact. So I think a 15% deal, which is stable then, would also stabilize the economy and at least wouldn't make prospects worse. We shouldn't forget it's not a very good deal for Europe. But given the threats of much higher tariffs, I think that would be good news. The question, of course, is will this be reliable? But I think it would be an improvement compared to what we had in recent months.
Are we getting closer when it comes to investment decisions from major corporates in Germany? Are we getting closer to a point, if we do get a trade resolution, if we do get a deal where more capex will be put to play, is there a sense that corporates are keeping dry powder on one side until they get more clarity, and then we get an impulse in terms of capex spend at some point this year into 2026?
Yes, there will be an impact. I mean, at the moment, as I said, we are seeing a positive impact coming from the change in tax incentives and the prospects of higher infrastructure investment in Germany. Also, the prospect of higher spending on defense. So that's something that's driving capex at the moment. But of course, a deal would help because under this enormous uncertainty, companies have little choice. They have to postpone projects. And I think if that resolves, if that uncertainty disappears, some investment projects will be coming forward. Of course, the question is, does the uncertainty really disappear? How reliable is the U.S. government when they make a deal? That's a question, but I think if there was a deal, it would help.
Okay, Clemens Fuest, the president of the Ifo Institute, in that modest uptick in terms of sentiment coming through when it comes to the business community of Germany, amidst all those questions, of course, about potential deals between Europe and the US. Clemens, thank you very much indeed, as always, for the context. Coming up, France says it will recognize the state of Palestine, adding to pressure on Israel over the war in Gaza. More on that next. This is Bloomberg.
Africa has been silent in telling those global stories. And that's where we have a mind full of stories that we can mine and mine and mine for years to come. And I think investors realize that, and they understand that there's real potential. And as I said earlier, independent films are making a huge comeback. So you're looking at your $5 million movies, your $6 million movies, and this film fund that we're setting up is looking at films, we're looking at financing films between a budget of $2 million to $8 million. So we truly believe that we will get a return on investment. And it's about managing expectations. We're not saying to investors we're going to go out there and we're going to sort of start making films that are going to bring you $1 billion return on investment. That's not to say there can't be outliers. The world has seen this happen time and time again.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jumana Bersachi in Tehran, and this is Bloomberg.
Good morning and welcome to The Pulse. I'm Tom McKenzie in London. These are your top stories. President Trump says he will not fire the Fed chair as he clashes with Jay Powell and pushes for lower rates during a rare tour of the central bank. The global stock rally hits the brakes as uncertainty over US monetary policy snaps a 7-day winning streak. Plus, tariffs weigh on European earnings. Both VW and Puma cut their outlook as trade concerns mount, but VW shares rebound. Now, French President Emmanuel Macron says France will recognize Palestinian statehood in September. He made the comments as pressure grows on Israel to ease the humanitarian situation in Gaza. Let's bring in Bloomberg Horizon's anchor Jumana Bersachi for the details. So, Jumana, Macron saying that France will recognize Palestinian statehood in September of this year. The UK Prime Minister, Keir Starmer, under pressure from many of his own backbenchers to do the same. Why is this happening now, Jumana?
Yeah, well, the backdrop to all of this, of course, Tom, is that there were hopes that maybe a ceasefire would be agreed to once again between Hamas and the Israeli side. But as we found out in the last 24 hours, negotiations have broken down and the U.S. have fully withdrawn their teams now from Doha. Steve Witkoff, the U.S. Middle East envoy, saying that Hamas are not acting in good faith. So that is the backdrop to this announcement coming through from the French President Emmanuel Macron, saying that they're moving to recognize Palestinian statehood as soon as this September on the sidelines of the UN General Assembly. I should say, though, Tom, in the past year, there have been several European nations who've pushed forward with this, including the likes of Ireland, of Spain, Malta, Norway, and in total right now, there are 147 countries around the world who do recognize Palestinian statehood. There is now also an increasing amount of pressure on the UK Prime Minister to do the same. We know that Keir Starmer will be having a call with his counterparts in Germany and France today to talk about the humanitarian crisis on the ground right now in Gaza, but stopping short, of course, of that full recognition. Now, it is also important to note that the U.S. Secretary of State, Marco Rubio, put up a post on X saying that this is a reckless decision by the French and only serves Hamas propaganda and sets back peace. In addition to that, Israel also commented, the Prime Minister's office, saying, we strongly condemn President Macron's decision to recognize a Palestinian state. Such a move rewards terror and risks creating another Iranian proxy. So this is the latest vis-a-vis Palestinian statehood. But of course, on the ground, there is a dire humanitarian situation with the UN Food Agency warning that 100,000 women and children are suffering from severe acute malnutrition. The Gaza Health Ministry reporting a rise in hunger-related deaths 33 in the last 48 hours.
Yeah, indeed, it is a dire situation, one that the head of the WHO has described as a man-made situation as well, with mass starvation. I'm quoting from the head of the WHO. And Jemana, this is, of course, having an impact on many people seeing these images, these deeply distressing images out of Gaza, and people are expressing their opinions in the world of finance, and we've seen an example of that today.
Yeah. Yes, absolutely. So you're referring to a situation where the global head of short-term interest trading from Citi, Akshay Singhal, put up a post on LinkedIn with a picture of a starving child alongside a caption. The caption itself was deemed inappropriate and in violation of Citi's policy. A spokesperson said that the social media post by one of our employees that is inconsistent with our code of conduct. The post has been removed, and we are reviewing the matter. The individual in question is currently on paternity leave, unclear what happens to his role. But really, Tom, it speaks to the polarizing nature of this conflict, the extreme difficulty that exists in marrying your political positions with your professional backdrop, your work. And in this situation, it appears to be the case that this individual did violate Citi's code of conduct. That being said, we spoke about this earlier in the week. 25 nations have put a letter and a statement forward, including, we were speaking about it, the likes of France and Canada earlier this week, warning about the very dire humanitarian situation on the ground in Gaza, saying that it is reaching breaking point now. And really, there is a lot of pressure on Israel right now to help alleviate some of those humanitarian strains. Israel, for their part, has said that the 25-country statement that was released earlier this week was disconnected from reality. Hamas is to blame for starting the war and failing to release the hostages, and the reason that the food is not being administered is because it is still under siege by Hamas. So, indeed, a very fraught situation still, and one that continues to polarize people all around the globe.
Bloomberg Horizons anchor Jemana Besetchi, thank you for that important update. Now, switching focus, US Treasury Secretary Scott Bessent will meet his Chinese counterparts in Stockholm next week for their third round of trade talks aimed at extending a tariff truce and widening the discussions. Let's bring in Bloomberg's Brussels Bureau Chief Suzanne Lynch with the details. What can we expect then? It seems that there is momentum to these talks between China and the US. What are you and the team watching for?
Yes, well, the fact that Scott Bessent is coming to Europe for that talk early next week is being seen as a positive sign. He himself has said that he expects the truce, if you like, that was agreed back in Geneva in April, for that to be extended. That had been due to expire on August 12th, so we are expecting an extension of some kind. I think the mood music has been quite positive from the United States over the last few weeks vis-a-vis China. There's possibly talk of a summit at some point between President Trump and the Chinese president, maybe by the end of the year. But of course, the US is going to have some asks. For example, this continuing issue about the deficit with China. America wants China to buy more of its goods. Although we have seen some progress on the other issue that has annoyed a lot of manufacturers and indeed the US government, which is exporting of rare earth magnets to the United States from China. And we did see some moves by China to boost those exports. So that's a kind of another positive sign that things are going relatively well at the moment.
Okay, relative. It is relative, isn't it, to your point, in terms of that caveat. But we'll watch for those talks next week. Meanwhile, we're going to get talks, maybe some discussion between the UK Prime Minister, Keir Starmer, and Donald Trump, who's going to be arriving in Scotland this weekend. Can we expect any progress in terms of that UK-US trade deal? It's been signed, of course, but there are a lot of big questions that remain, particularly when it comes to tariffs on steel.
Yes, this is an interesting kind of diplomatic challenge now for the British Prime Minister and the government. Donald Trump is arriving in Scotland later tonight for a personal tour. He's going to be playing some golf, so let's keep an eye out on who may join him on the golf course in Scotland. But yes, the UK has made it clear that it wants more clarity. It wants a deal on the steel element of that trade deal it already signed with the United States. In particular, the US has been requiring or asking that steel has to be melted in the UK to apply to be able to get lower tariffs. But this is proving difficult, particularly for Tata Steel. So the British side are going to want to try and get some agreement on this. It's going to be difficult. They have escaped that 50% tariff, but they want to bring it right down. So we're expecting some kind of meeting between the Prime Minister, Keir Starmer, and the US President on Monday. No press events so far scheduled. Let's see. But they are hoping to make some progress on that early next week.
Okay, Brussels Bureau Chief Suzanne Lynch, thank you very much indeed. With what to think about when it comes to the meeting between the UK Prime Minister and his counterpart, of course, President Donald Trump, in Scotland this weekend, and looking ahead to China-US talks next week. Now, a group of 4 traders, meanwhile, will appeal convictions that saw them jailed for fixing benchmark interest rates after the UK Supreme Court overturned, of course, the conviction of Tom Hayes this week. So 4 traders will be appealing those convictions that saw them jailed for fixing benchmark interest rates. We're talking about ex-bankers from Barclays and Deutsche Bank amongst those 4. This, again, is according to the law firm representing them, Hickman and Rose. The 4 were jailed for fixing LIBOR and Euribor, but of course, now we have seen Tom Hayes' own conviction quashed by the Supreme Court, so this legal action continues. Back to the equity markets now, and earnings. Puma shares have plunged after the German sportswear maker slashed its forecast for the year amid weak demand and growing concerns about the impact of US tariffs. The company expects to report a loss in adjusted earnings before interest and taxes this year. Switching focus to what is happening in terms of AI and developments in the healthcare space. In the race to transform healthcare through artificial intelligence, one startup has received a major boost. Clinical tech company iDoc has secured a $150 million financing round, bringing total funding to $370 million US. The funds will be used to speed up developing an AI model to help physicians with clinical decisions, and it's already having an impact on the ground. Very pleased to say we're joined now by the co-founder and CEO of iDoc, Elad Wallach. Elad, good morning. Thank you for joining us. What does this fundraising round mean for what you and the team are able to do as you push your products out?
Well, Tom, first of all, thank you for having me here. I am extremely excited about this funding round, not just because of what it says to iDoc, but what it says for the industry as a whole. Our mission in iDoc is to reduce diagnostic errors and improve quality of care. Each one of us in our lifetime, we will likely suffer from something like a diagnostic error. The Hopkins University published last year a study showing that we have every year in the US alone 800,000 people a year suffering from either a diagnostic error or a permanent disability. You add to that the problems we have with access to care, and really you see that our potential is human. We have to break through with that. And we have amazing physicians, but they need all the help they can get. The power of this raise is really accelerate what AI can bring to the market. The way AI has been developed for clinical care in the past was disease-specific, one at a time. And despite having profound impact for every disease, it was very slow. This foundation model aims to bring a technology that in 3 years will cover practically every relevant disease state that can be identified and support physicians in their care delivery.
Every disease could be covered within 3 years. And look, Elad, you founded this company back in 2016, so well before all the hype around ChatGPT. You're shipping into hospitals in the US right now. Give us a sense of how much demand you're seeing and what it's doing in terms of changing those diagnostic outcomes.
Yeah. So first of all, we're a global company. We're analyzing today over 45 million patients a year. So pretty significant scale, deployed in over 2,000 hospitals. But I want to maybe bring this home with an example of a use case. So pulmonary embolism, to those that don't know, is a blockage in the arteries of the lung. It's a very critical disease. And today, the problem that exists is that we have such massive shortage of physicians that we have huge backlogs of cases that physicians need to read. So for example, if you do a scan of your chest, a chest CT, and you have an unexpected pulmonary embolism, you could be waiting for days, if not weeks, to get your diagnosis. So I want you to imagine the phone call you're gonna get, 7 days after you did your study. You actually have something very acute. You should come to the ED right away. Obviously, very deadly and can risk every patient. With this technology, you can basically prioritize this patient and be the physician aide to help them get to the right patients very, very quickly and effectively get them almost real-time results and get them the care that the patients need. Now imagine doing that at global scales for hundreds of millions of patients and now can receive better care.
Elad, what are the biggest roadblocks to scaling this technology? Is it regulatory? Is it adoption? Is it reluctance from physicians? What's holding back greater scale and greater shipping of this product across hospitals?
This is why I'm so excited about this raise, because the problem was actually technological. Physicians love the solutions. If you get it in their hands, they are grateful for every help they can get, and they are really the heroes. Regulation is challenging. Everything has to be FDA cleared and CE marked, but it's possible, and we've been through this a dozen times, and the agencies are collaborative. The problem is that developing something that is clinical grade is so tough and so difficult. It would have taken us, before this foundation model, every disease to cover would have taken us 2 years. And we were probably the company that is fastest in the world in development of these FDA-cleared solutions. With this new technology, the foundation model, you can actually develop new diseases in a matter of 1 to 3 weeks. Imagine the potential for us to get to the coverage with this.
What do you do when it comes to questions around data security, privacy, and medical confidentiality? How do you integrate that into your products?
So you have to be very attentive of when you develop these products to all of these problems and more. One of the problems, by the way, that we pay the most attention to is bias. So when you train your models, you have to be develop them an incredibly diverse data set. So our data set is global. And I think there is a recognition that you have to really train on multiple varied patient population in order to ensure that the quality is there. You don't want to create or have AI solutions exacerbating existing biases.
And Elad, in terms of the size and scale of this market, what are you telling your backers? You've just raised, as we said, $150 million US. How big could this be? What's the potential scale of this market longer term for you and the company?
I think this is one of the biggest market potentials in the world. Look, to give you a sense, if we try to quantify in the US alone this problem of 800,000 patients with permanent disability, if you're trying to quantify that, that is a problem worth anywhere between $500 billion to $1 trillion annually to the US. And that is not even factoring access, problems, et cetera, et cetera. It's a massive problem, which is why I am so excited to bring this technology. And by the way, to bring this foundation model to market, we've partnered with the tech Goliaths, with NVIDIA and with Amazon. We're very proud to work with them to foster a whole ecosystem around this because it's such a massive undertaking. No single company can do this alone.
Okay. Elad Wallach, thank you very much indeed, the co-founder and CEO of IDOC, with that raise and the partnership with, as you mentioned, NVIDIA and Amazon as well, with that diagnostic solution powered by AI. Coming up, LVMH shares rebounding this morning after a tepid earnings report. We're going to focus on the sector and look ahead to numbers from Kering and Hermes next week. That is next. This is Bloomberg.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise,
with some fun along the way.
This is Bloomberg Surveillance.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Welcome back. So we had the earnings dropping from VW. We've been speaking. Guy Johnson to the CFO. Of course, the company has cut its outlook, but the stock has rebounded. Look at that. The gains coming through for VW, up 3.8%. This could be linked to a comment from the CEO of the business saying that he expects around 15% tariff levels from those EU-US talks. That's according to the CEO, Bloomer, who made that comment at around 8:45 a.m. UK time. We still await, of course, details on that potential trade deal, but it seems that maybe investors are latching on to a view. 15% could be something that this is a company that could weather ultimately. So the stock turning around after being down in the session on the back of that cut to the outlook, now up 3.8%. That's having a ripple effect across the auto space. Mercedes-Benz are jumping 2.2%. As you can see, Stellantis as well up 1.4%. And Renault, which is seen as one of the companies more resilient to the tariff and trade impact, currently up 1.8%. So the whole sector is getting a lift on the back of this. Again, it is expectations around trade and tariffs, it seems, that's fueling the upside for autos. In the luxury spells, LVMH shares rebounding as well this morning, despite a tepid earnings report. You saw sales actually falling more than expected. The numbers crossed towards the end of the day yesterday. Demand for the company's luxury products slumped in China and Japan, key markets, of course, as shoppers held back. Let's bring in Erwin Ramborg now, Global Head of Consumer and Retail Equity Research at HSBC. Erwin, what were your takeaways from the earnings that came through from LVMH?
I think it was quite brutal, to be honest. I think it was a sign that luxury overall is misaligned. You've got macro issues. You've got what we've called greedflation, so this idea that a lot of handbag, notably companies, increase prices way too much, way too quickly, and you have a lack of creativity. But as you said, the stock is up, and it might be a bit counterintuitive. I think the stock is up because the market is basically calling the trough. I think everything that's gone pear-shaped for the past few months is probably not getting worse from here. Traditionally, long-onlys look at valuation. Traditionally, hedge funds look at margins. The reality is the way this sector works is sales momentum. As you said, sales were a miss yesterday, especially on what counts, which is fashion leather. But this might be the trough. What I mean by that is tourism in Europe is terrible, but probably not getting worse. Japan, you alluded to, was collapsing. That collapse is broadly behind us. American consumers are likely now being boosted by equity markets being at all-time highs. And the all-important Chinese are probably doing less bad. They're not rebounding. But as one CEO in the space would say, you can't do minus 25 on minus 25% forever. At some stage, you find a level. The savings ratio in China is very high. The appetite for luxury is still there. They just didn't have the motivation. Hopefully that starts to mend. And so I think what the market is playing now, at least in the short term today, to explain this share price rebound at LVMH is the trough in terms of sales decline.
That's really interesting. What would you need to see? What would investors need to see, do you think, to turn that from a short-term story to a longer-term upside for the stock? Which of those pieces is most important to really lock in?
I think the moment you start to see proper growth again for the sector is when you have both of the important clusters, meaning the American consumer and the Chinese consumer, growing very decently at the same time. And in our assessment at HSBC, that won't happen before Q2 26. As I said, the Chinese are on the mend. They're still declining, but quarter after quarter, less so. The American consumer is doing very well at home, not so much abroad. Likely because the euro dollar is a bit curbing the enthusiasm when tourists come to here to Europe. And remember, you had a sort of post-election bump last year in the US, starting early November 24 and up until Valentine's Day 25. So again, we're seeing the Chinese quarter after quarter doing better. We're seeing the American consumer being involved at home, not abroad. Both might start to grow very decently starting in Q2 26. So if you're a long-term investor, Q2 26 isn't that far away. If you're a hedge fund thinking for the next 2 weeks, wait it out.
What is the assumption? How much is priced in, do you think, more broadly across the sector when it comes to tariffs? Is there an assumption being made by the markets at this point that you get 15%? Is that what's being priced in right now?
I think, it's interesting because tariffs can be relatively easily offset at the P&L level for luxury. Remember, these are essentially retail-heavy companies with gross margins at 70% or above, depending. And so at the P&L level, tariffs are not an issue. Tariffs are an issue very clearly at the psychological level. I believe that indeed we're probably looking at investors thinking anywhere between 10 and 20% we can live with. Very clearly, we're not in a scenario of escalation to 50 and Europe fighting back with retaliation. I think we are in an environment, from what I'm picking up from investors, where we get a resolution between now and the 1st of August.
How much pricing elasticity do you see for the sector into the back end of 2025 and 2026?
So it varies greatly, but as I said, one of the themes right now is greedflation. This idea that a lot of the soft luxury, meaning handbag brands, increased prices way too much post-COVID. I think they increased the prices way too much because in the post-COVID era, people were queuing to buy up your stuff. And so you thought, oh, if they're queuing, presumably I have pricing power. And if they're queuing, presumably they like what they're seeing. You were wrong on both fronts. She was queuing because she had been stuck at home. She was bored out of her mind. She had accumulated some savings and she just needed a breather. But she's not ready to pay up that much. And she certainly doesn't want your existing product. She wants something that's a bit fresh. So again, as I mentioned, this is a handbag issue. There are exceptions. I think Hermès was very reasonable in terms of price increases. I think the hard luxury space, meaning jewelry and watches, were also quite reasonable. And that's why you're seeing an outperformance of Richemont, for example, with Cartier and Van Cleef being reasonable. That's why you're seeing an outperformance of Hermès.
Okay, really smart analysis on this luxury space. We're running short of time, but we appreciate it. Erwin Rumborg, who is Global Head of Consumer and Retail Equity Research at HSBC. Don't forget to catch the latest edition of Bloomberg Next Africa. Meanwhile, this month's show comes from the G20 Finance Ministers meeting in South Africa. The brief is next. This is Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Let's talk about this villa. Very traditional. A lot of things of the past.
I live my very first independent life in the farmhouse. And I built it by the memory of the farmhouse, the philosophy they believe, yin, yang, 5 elements, the concept of the life, of the happiness. They build this kind of roof, like boat, and man and woman, and bowl of rice. Everyone should be happy if have somewhere to live, something to eat, and someone to love.
So you're defined a lot by your past experiences.
Yeah. Actually, I'm a lucky man because not everyone should have the experience of the war and peace, poor and rich, technology progress, the change during my life, rich by experience.
There's an appreciation for what you have now.
And therefore, peace is the most important thing for today, for Vietnamese, and I think for human beings of the world.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
It is 5 a.m. in New York City. Good morning. I'm Matt Miller in for Danny Berger. Here's what you need to know. Renovating rates. President Trump says there's no need to fire Fed Chair Powell over cost overruns at the Federal Reserve, focusing instead on interest rates. And digging in the dark, Intel shares get hit after the CEO struggles to show investors a clear plan to turn the business around. Plus, losing steam, a 7-day global stock rally hits the wall as markets gear up for the Fed's decision next week. In terms of what we see in futures right now, you can see that we're looking at a slight gain here on S&P futures. We did have an all-time high yesterday, but just barely, as the S&P was the sole of the three benchmark indexes rising. NASDAQ futures right now little changed, and Russell futures gaining about 0.2%. So we have come to new heights in terms of index levels, but it looks like the markets are pausing for now to see what happens with both tariffs as well as interest rates. Yesterday's meeting between President Trump and Jerome Powell with an entourage of Fed critics was absolutely fascinating to watch, and we're going to share that with you today. In terms of what you see in yields in the market right now, the 2-year yield rising just slightly to 392, even slighter gains on the 10-year, but over that 440 level, solidly at 441.57 right now, and the 30-year yield at 495.95. In terms of the stocks that we want to watch, let's get you over to Valerie Teitel in London for a rundown. Val?
Hey, good morning, Matt Miller. Let's start with a check on Intel. As you mentioned, it wasn't a pretty story in those earnings after the bell yesterday. Those shares are trading down near 6% in pre-market trade. This comes as the CEO was just failing to convince the market of his turnaround plan, warning of pressure on second-half margins and talking about significant job cuts. So we're in the red when it comes to the chip maker Intel, down nearly 6%. Let's move on to what is a crazy session in Europe, Matt Miller. We are talking about Volkswagen this morning. They cut its margin guidance. LVMH missed on sales, but both of those stocks are now decently in the green. Why? We heard from the Volkswagen CEO saying that he expects a 15% tariff on autos coming out of these U.S.-EU trade talks, and that's led to positivity across the tariff-exposed sector. So we're seeing Volkswagen having a decent turnaround, up nearly 4%. LVMH, it was decently in the red this morning, now up over 4%. Lastly, let's end on another U.S. stock, that is Deckers. They came out with earnings that surprised the market expectations, saying demand for their UGG boots is still strong. Those shares are very much outperforming this morning in the pre-market, up over 11%. Matt.
All right, Valerie, thanks very much. Valerie Titel there in London with a look at some of the stocks moving in the pre-market and some of those that we're going to be focusing on really moving markets themselves. Volkswagen, an example there. We're going to catch up with Banu Baweja of UBS on this equity market, and then later this hour we're going to discuss all things Fed and the U.S. economy with Jose Torres of Interactive Brokers. First, let's get to some of the other top stories trending on the Bloomberg terminal this morning. The Bank of Japan is said to be seeing the possibility of another rate hike this year after the U.S. and Japan struck a trade deal. Bloomberg sources say BOJ officials view the deal as reducing a key source of uncertainty, allowing them to focus on the actual impact of tariffs. Morgan Stanley has become the first U.S. company to tap China's panda bond market. The offering is at 2 billion yuan, or close to $280 million, with 5-year notes priced at 1.98%. Bloomberg learns that proceeds from the sale will be remitted overseas to support the bank's operations outside of China. And Thailand is warning that the armed military conflict with Cambodia could potentially develop into a war. The acting prime minister told reporters that the severity of the clashes was escalating, endangering civilian lives as the dispute enters a second day. Now, the main focus for market watchers today will be President Trump's trip to the Fed. He downplayed any suggestion that he might be firing the Fed chair, Jerome Powell, over cost overruns at the Federal Reserve renovation.
It's a big move, and I just don't think it's necessary. And I believe that he's going to do the right thing. I believe that the chairman is going to do the right thing. I mean, it may be a little too late, as the expression goes, but I believe he's going to do the right thing.
For more on that, I'm joined by Kasia Klimasinska, Bloomberg's D.C. breaking news editor. So, Kasia, it does look like the president has dialed back his rhetoric. They've seen something at the construction site that, I guess, justified to some extent the $2.5 billion project.
Good morning. Yes, what an extraordinary trip. It only happens once in about 20 years. President Trump visited the Federal Reserve headquarters in downtown D.C., very close to the White House, and he met with the Federal Reserve Chair, Jerome Powell. An interesting timing, given that the Fed is meeting next week. And, of course, President Trump used that visit, this discussion, to emphasize he wants to see interest rates going lower. And as we just saw, he said he hopes that the Fed will do the right thing. At the same time, he signaled that he sort of understands why the costs are so high with this renovation, and he doesn't see that in its own, the spending on the renovation of the Fed buildings, as a reason to fire the Federal Reserve Chair, Jerome Powell.
How was the mood? What were the vibes? Was there any interesting interaction between the president and the Fed chair, whom he has called a loser and a stiff?
Indeed, it was very interesting, really worth watching TV. Go and play it on social media. Is worth taking a look. The two men were talking. They traded some barbs. President Trump showed Powell a list of costs, and Powell was sort of upset, saying that those calculations are not right, that they include a building that has been finished 5 years ago. But then President Trump kind of ended on a conciliatory tone. He said he doesn't see a reason to fire Powell, that he now sort of understands, he has a better understanding of those costs, that, you know, he himself is a real estate guy, he knows projects like this, but he also said that in other circumstances, if it was his project, he would fire the project manager.
So what was Powell's response? What did he say? I mean, this meeting has been hotly weighted.
Exactly. So Powell is in a really difficult position here. He really can't win. He's in this so-called blackout period because the Fed is meeting next week to decide on the interest rates. So he really tried not to comment too much. But he defended his position. Again, he kind of said those cost calculations are not accurate. He stood his ground there, and he obviously avoided commenting on interest rates.
All right. It's definitely something we're going to be watching over and over. Kasia, thanks so much for joining us. Kasia Klimasinska there from Washington, D.C. Now, the increasing cost of President Trump's tariffs have weighed on corporate earnings, with Volkswagen lowering its outlook as it impacts their Audi and Porsche brands, which led shares to initially fall, but now have strongly rebounded after the CEO, Oliver Blume, said the company expects 15% tariff levels from the EU-US talks and is offering an attractive investment package to the U.S. Bloomberg's Guy Johnson spoke to the CFO earlier on the company's margins.
We made 6 to 8% margin, and currently we are faced with 25% tariffs. Yep. So this is clear we need a good solution, and a solution that fits both the needs of the American administration, but also the European automakers.
Joining us now is Bloomberg opening trade host himself, Guy Johnson, who is outside the Volkswagen factory in Wolfsburg, Germany. And Guy, interesting that, this Blume headline seemed to move markets, but really Volkswagen is talking about a range of expectations, aren't they?
Yeah, they don't know, Matt. It's pretty clear they don't know. I think Oliver Blume, the CEO, would probably settle for 15%. Remember, 15% is the number that you could argue his biggest competitor, Toyota, got out of the Japanese deal. So everybody's now waiting to see exactly what the European deal is going to look like and whether or not it is, let's call it circa 15%. So as you say, there was a range this morning. It went basically from 10 up to 27.5 in terms of the tariff, but that includes the existing tariff. So let's call it 10, maybe a little bit more than 10, up to around 25. You do the maths, we're roughly in the middle at somewhere around 15. 200 basis points is the hit, though, at the top end of that range. So you can kind of do the calculation on what the margin hit will be if we get circa 15%. But look, Matt, the market just wants clarity right now. The market is rewarding companies that can give a sense of direction now on what is anticipated and what the numbers look like with some degree of precision on what the tariff hit is going to look like and what the fallout is going to be in terms of the numbers. You saw Texas Instruments the other day, couldn't really tell the market what was going on. Volkswagen's maybe had a better stab at it this morning, and now we're getting a little bit of clarity around that 15% number. The share's popping quite aggressively off the back of that.
Guy, I guess investment in the U.S. is what Donald Trump wants to see, and Volkswagen does have a plant here in Chattanooga, but Audi and Porsche, their most profitable brands, don't produce almost anything at all here. What was Arno telling you about that?
So he definitely knows, and he was clear, but he wouldn't give me some details on it. He knows that this is a business that's going to have to invest more in the United States. So remember, they have bought a stake in Rivian. They've got this Scout plant that is going to be coming on track as well. They've got the Scout project, which is going to be something they're going to be pushing forward with. So there are investments going in. But Toyota has done north of $60 billion into the United States. Volkswagen is way behind on that, so it does need to invest. And Audi is the obvious brand name that needs some help here. If you could find a way of allowing Audi to produce in the United States, that would go a long way to solving some of the margin problem that they face at the moment. Remember, brands like Audi and Porsche used to produce double-digit margins. They are way off that right now. The tariff story is going to make it really hard to get back to those kinds of numbers. Maybe the only way to do it, Matt, is to get 911s maybe being built in the United States, but certainly Audi's being built in the United States. That would solve maybe that problem.
No one wants to buy a 911 that was made in the U.S. The point of that car is that it's built in Stuttgart-Zuffenhausen. Guy Johnson, thanks very much for joining us. Guy, there at Wolfsburg, Volkswagen City in Germany. Coming up, we're going to speak with Banu Baweja, chief strategist at UBS, next, and get his take on these record highs. This is Bloomberg.
to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
The new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television, top experts, great questions.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Alberta, Canada, and this is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Wednesday, the Fed decides.
It's not just about the economics, it's about the politics.
The Fed is in policy purgatory.
It's going to press on the dual mandate.
If the Fed wants to maintain its credibility, I think it makes sense to stay where they are right now. Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
He's under fire. They're coming out of the trenches after him.
How do they justify how this is not political?
Tune in to Bloomberg Surveillance. The Fed decides, starting at 1:30 p.m. Eastern.
This is Bloomberg Brief. I'm Matt Miller in for Danny Berger here in New York City. Quick check on what we're looking at in terms of futures. Very little change on the benchmark S&P futures right now, but we did hit, of course, an all-new record high yesterday at the close. The Bloomberg U.S. Dollar Index rising slightly, almost to 1,200 right now, 1198.92, and the 10-year yield continuing to inch higher right now at 441.97, so trading just around 442 this morning. Banu Buweja of UBS writes this, quote, markets continue to climb the wall of worry. The gap between economic fundamentals and the lack of tariff fear priced in equity markets is growing. Banu Buweja joins us now. He's chief strategist at UBS. And Banu, do you think these markets are too complacent right now about the tariff effects?
I think the markets are trying to understand the tariff effect, and there is a degree of complacency. How do we say that? If you look at the earnings expectations of this market, I mean, for the U.S., they're about 12 to 14%, not just for the next 12 months, but also for the coming 24, 36 months. So the CAGR over the next 2 to 3 years, both for the Magnificent Seven and also for the remaining 493 companies, so this is not just a Mag 7 point, are very high, right? It's detached from economic growth reality, which is that U.S. consumer has basically stalled in the first 6 months. So the market's really looking ahead to some sort of a renaissance in the U.S. economy, and we don't see what the big catalysts for that are. So we think earnings expectations are a little bit removed from reality. But what also is quite interesting is that the valuation multiples are extremely high as well. They're somewhere between 22.5 and 23 times forward earnings, and earnings which, as I've just discussed, are not realistic. So these are very high valuation multiples. The long-term average of valuation multiples around 16.5, we're not likely to get to because of the massive retail interest that we have seen. And our sort of rough numbers tell us that retail interest is responsible for about 3 to 4 turns on the multiple going higher. So that's the intercept shift just in the valuation from the retail interest. But if you were just to look at the situation objectively, we are in a situation where both valuation multiples and earnings expectations are very high at a time when the U.S. economy could be going through a phase. This is not a structural problem, but going through a phase where the growth inflation mix is likely to deteriorate in the second half of this year. So I think one can safely say that there is some complacency.
I wonder first about the consumer, Banu. We were talking recently with Anastasia Amoroso, who told us, I think citing some tax foundation data, that the average consumer is going to see a 5% rise in after-tax incomes this year. Have you seen any data pointing to numbers that big?
I haven't actually, and I've seen data that points to the opposite. So if you look at real PCE, and we have data from December onwards, May, that's the last data point, the numbers are actually lower in absolute terms. So not just is this a low growth rate, this is a zero or a slightly negative growth rate. And moving forward, real disposable income growth, if you look at the 1 month, 3 month annualized changes of the real disposable income, they don't look anything like rising aggressively. In fact, the last number has been quite weak. So I would argue that real disposable income in the second half of this year is likely to come down. That it's coming on the back of very strong growth in the previous years and in the first quarter of this year. That I would completely agree with. But the delta from here on over the next 12 months, I think that's what we need to focus on, not where the consumer was in 2023 or 24, but where it's going to be in the next 12 months till the end of 2026 or even going into 2027. I think there is pressure on real disposable income growth because with these tariffs, even though they're not 25 to 30%, they're 15%, the effective tariff rate in the US is going to be somewhere between 16 to 18%. That should lead to inflation going higher, right? And maybe not to 5%, but inflation could go towards 3.5 core PCE, and that I think will tell on real disposable income growth. You look at the quits data, you look at wages, and that's telling us that nominal wage growth is coming down. So nominal wage growth coming down, inflation going up, that is a hit to real disposable income growth.
Banu, one of the most fascinating things, I think Wall Street is aghast at the meeting between President Trump with his entourage and Fed Chair Powell yesterday at the Federal Reserve. Listen to what they had to say about cost overruns, the potential of firing the Fed chair, and interest rates.
Well, I'd love him to lower interest rates, but other than that, what can I tell you? We had a little talk about it, and I thought it was a very productive talk. He'll be able to tell you at his next meeting, but I will say that he did say the country's doing really well. You know, his term comes up soon. I think he's going to do the right thing. Everybody knows what the right thing is. Even people that believed in, the higher rates, they're all on board. They all want to see the interest rates come down. It's very important.
So it looks less likely that we're going to see Powell ejected from his chair at the Fed. And I guess those who believe in Fed independence will have less reason to be worried. Banu, what's your take on that and how much is priced into the interest rate curve?
Very little in terms of the Fed independence being compromised. I wouldn't say nothing is priced in, because if you look at the last 1 month, you have seen real yields come down, which is, the market worrying about growth, but inflation expectations, including at the 10-year, which has got nothing to do with tariffs. Tariff inflation is not going to last for 10 years. It's going to last, it's a one-period hit. It should last for about a year. So if 10-year inflation break-evens are going higher, at a time when oil prices are very low, that really is because the market has begun to worry a little bit about Fed independence. But these are not, we're not 40 basis points. We're talking about moves which are high single digits. So the market's just about began to worry about this. I think it's safe not to worry about it too much, because I think for all of its faults, I think many in the administration do completely understand the hit to the bond market if you see Fed independence coming under a cloud. And they have revealed their cards in April when they were quite worried about the bond market. At that time, it was not the stock market that spooked them on tariffs, it was the bond market that spooked them, and Scott Bessent got his say, and they did pull back on the tariffs. So that really does lead me to believe that they are not likely to make any rash decisions. That there will be sustained pressure on Chair Powell, I think that is a given. So far, he has not relented, and so far he has not resigned. We don't know what's going to happen there, but we certainly do believe that this administration is not likely to forcibly push Powell out. And there are very few means of doing that, by the way. That they're going to continue to put pressure, that's fine, but to eject Chair Powell from his position, that's unlikely.
Banu, great to get some time with you. Thanks for joining us. Banu Bueja there. We're going to bring you more from that presidential meeting with Fed Chair Jay Powell. This is Bloomberg.
AI should be for everybody, from leaders to the working on floor. And we can save 90% of time, 50% of workforce. AI is core in centers of change. And therefore, we invest heavily to AI. Actually, we started more than 10 years ago because we think the machine in the past helped our hand and legs. Now the machine helps us in brain.
Are you betting all your money in this right now?
When the OpenAI appear, immediately I asked whole corporations study how will you bring generative AI to their job.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
This is Bloomberg Brief. I'm Matt Miller in for Danny Berger here in New York City. Time now for your front page news. First up on the Wall Street Journal, corporate America shouldering the bill of President Trump's tariffs. Companies from General Motors to Nike to the local florist are absorbing costs. For now, the U.S. has collected an additional $55 billion in tariff revenue this year. And the New York Times reporting that Israel and the U.S. are pulling back from talks with Hamas. President Trump's special envoy to the Middle East, Steve Witkoff, said negotiating teams were being recalled. He also said alternative options are being considered on how to bring home Israeli hostages held by the militant group in Gaza.
Another art museum of the Guggenheim. Now, Louvre's big enough. Why do you need a Guggenheim as well, right next door?
I think it's a great question. I think the beautiful thing about the UAE and Abu Dhabi is we live with over 200 nationalities. And in doing so, they have become a part of the country's and the city's fabric. And we need to celebrate that. So we need to celebrate everybody's identity, everybody's background, everybody's heritage, everybody's history. And what a beautiful way in doing so in these beautiful institutions. These museums are educational institutions and they're community institutions. So we wanted to curate really a story where you come to Saadiyat Cultural District and you, if you allow me to curate the story, you start off at the Natural History Museum. And at the Natural History Museum, you get a glimpse and you get an understanding of how we came to be, how our Earth came to be, how our universe came to be, from a scientific perspective. Once you leave the Natural History Museum, you go to our National Museum, the Sheikh Zayed National Museum. There, you understand the history of this great land, not just the history of the country, but the people of this land that have been a part of this land for over 300,000 years. You get a glimpse of what the past and the present and the future looks like here in the UAE. From there, you maneuver yourself to the Louvre Abu Dhabi, which is a beautiful universal museum. It is universal in its thematic approach. So there, you basically see a part of you on an equal pedestal with the entire world.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
It is 5:30 a.m. in New York City. Good morning. I'm Matt Miller. Danny Berger is on assignment with your Bloomberg brief. Here's what you need to know. Renovating rates. President Trump says there's no need to fire Chair Powell over cost overruns at the Federal Reserve, focusing instead on interest rates. And digging in the dark, Intel shares get hit after the CEO struggles to show investors a clear plan to turn the business around. Plus, losing steam, a 7-day global stock rally hits the wall as markets gear up for the Fed's decision next week. In terms of what we're looking at right now, futures are little changed, haven't moved. NASDAQ futures and S&P futures both hovering around the zero mark. Russell 2000 futures moving a little bit higher, about 0.1%, but not a lot to see there either. In terms of rates, you see them inching higher really across the curve. The 10-year yield right now at 441.97, the 2-year and the 30-year moving less. In terms of the stocks we want to watch, let's get over to London for that. Bloomberg's Valerie Teitel is standing by. Valerie, what are you watching?
Hey, good morning. I'm Matt Miller. Want to start on Intel. It reported after the bell yesterday, and it wasn't good news for this chip maker. The stock is down nearly 6%, with the CEO really failing to convince investors about this turnaround, warning that second-half margins are going to come under pressure and talking about significant job cuts as it tries to turn around the chip maker. So Intel in the red. I do want to flip over to the European session. Some very interesting price action going on. We had pretty bad results from both Volkswagen and LVMH. Those stocks opened up in the red, but they are now very much in the green. And this comes after the CEO of Volkswagen says that he expects a 15% tariff rate coming out of the U.S.-EU trade negotiations that is having a positive impact across both tariff-exposed sectors. Remember, Volkswagen is the second largest car maker in the world by sales volumes. So the CEO saying that he is expecting a cut to those car tariffs is rattling the market to the upside this morning. Lastly, I do want to end on another retailer out of Germany. This is Puma, falling 17%. Some analysts calling it a major profit warning coming from this sports retailer. They are warning about margins, warning about the impacts of tariffs, and also warning about the impact of a stronger euro on its bottom line. Matt.
All right, Valerie, thanks very much. Valerie Teitel there looking through some of the big movers this morning. Let's get to Jose Torres right now of Interactive Brokers. He says he's optimistic on the economy, writing that the U.S. economy is likely to accelerate in the months to come as a rise in relative certainty bolsters confidence among corporate executives and consumers alike. He's a senior economist at Interactive Brokers, and he joins us now. Jose, it's really interesting because I think if you had told us in March tariffs would be 15%, that would be a sky is falling moment. But now it seems low. Trump has moved expectations so much. And in fact, it looks like those tariffs will be spread out between the exporter, the consumer, the corporate buyers here, and the consumer. How do you see that affecting the economy?
Good morning, Matt. Great to see you. I don't see a significant impact. I think it's going to be similar to Trump 1.0, where we saw inflation uncertainty, inflation bumpiness take us up to 2.9% on CPI, only to retreat back to the mid-twos. You know, goods as a percentage of the overall inflation picture, core goods, that is roughly just 20%. Also of the economy. So I don't think that tariffs between 10 and 20% on global trade partners are really going to move the needle that much. When we look at yesterday's data, we saw initial unemployment claims fall for the 6th consecutive week to 217,000. That is the safe zone. That is expansion mode. And then when we look at the services PMI rising to a 7-month high, you know, that points to a tight labor market, strong hiring, significant consumption, and together, that bodes well for consumer spending going forward. We think that the expansion has legs. Earnings growth is strong from here, and much of the uncertainty from early April at this point seems unreasonable, and really bullish animal spirits and bullish winds from here. As far as what we're looking for, also looking for roughly 2 interest rate cuts from the Federal Reserve this year, according to our IBKR forecast trader. And that's really going to help broaden out the progress, Matt, because we're going to start getting some more positive contributions from the manufacturing sector, which has been expanding sometimes, contracting others, and then the integral real estate sector, which has been in a recession for roughly 3 years now.
Jose, what do you see in terms of effects on the consumer here? Anastasia Amoroso was on a couple of days ago saying she thinks the consumer is going to have roughly 5% more after-tax income due to the one big, beautiful bill. However, we just spoke with Banu Baweja of UBS, and he thinks the consumer is going to have less real income due to the effects of inflation. So how does it look to you?
Well, I think that the consumer is going to do well. One thing we've learned over the past few years is not to count out the American consumer. When we look at the labor market and wage gains, which have been propelled now due to immigration restrictiveness, that really helps the lower and middle income cohorts. And then, Matt, we look at the capital markets and we look at the equities doing so well, that really helps the upper income consumers. So really across the board, we're looking for continued expansion. Of course, there's going to be some affordability pressures at the lower end because of this inflationary episode, and inflation still remaining in the mid-2s, not at the Fed's target yet. That's probably going to continue. I don't think that we get to 2% inflation for quite some time. I think we're going to be tolerating slightly above target price pressures. But overall, I think that the consumer is going to do terrific because of job markets and capital markets.
In terms of margins, if companies continue to eat these tariffs as they have, they're going to shrink. What do you expect for earnings?
I think earnings are going to do well. You're right. In some categories, in some aspects, like your colleague was mentioning earlier, there's going to be some firms that are caught in the crosshairs. But those corporates that are more diversified, that are more spread out, I think they're going to do fine. I think earnings are going to continue to grow. I think margins can stay wide. We don't necessarily need to have expanding margins, but as long as they're stabilizing and the top line is growing, and maybe we can sustain a little bit of margin pressure and still grow the bottom line overall. I think that's what we're looking for here. We have a lot of supply side benefits that are coming up, like you mentioned earlier: lighter taxation, milder regulations, onshoring initiatives, subdued energy costs driven by heavy production levels. All of that is really disinflationary and positive for growth, and we're going to see that translate to the bottom line. And that's why we're seeing investor sentiment so buoyant and this market doing so well after 23 and 24 delivered gains in excess of 20%.
Yeah, and a 28% rise thus far since the bottom in April. Jose, thanks so much for joining us. Jose Torres there from IKBR Interactive Brokers. Let's take a look right now at some of the other top stories trending on the Bloomberg terminal this morning. The Bank of Japan is said to be seeing the possibility of another rate hike this year after the U.S. and Japan struck a trade deal. Bloomberg sources say BOJ officials view the deal as reducing a key source of uncertainty, allowing them to focus on the actual impact of tariffs. Morgan Stanley has become the first U.S. company to tap China's panda bond market. The offering is for about $280 million, according to Bloomberg sources. Proceeds from the sale will be remitted overseas to support bank activities outside of China. And Thailand is warning that the armed military conflict with Cambodia could potentially develop into a war. The acting prime minister of Thailand told reporters that the severity of the clashes was escalating, endangering civilians as the dispute enters into the second day. Coming up, President Trump says it's not necessary to fire Jerome Powell. Your D.C. update next. This is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
Now we're playing.
Yep, now we're playing.
First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5.
Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
There's no pressure. No. We want to have, his term comes up soon. I think he's going to do the right thing. Everybody knows what the right thing is. Even people that believed in, the higher rates are all on board. They all want to see the interest rates come down. It's very important.
No pressure at all. That was President Trump speaking yesterday after taking a tour of the Federal Reserve building. For more, Bloomberg's Kasia Klimashinska joins us now from Washington, D.C. And Kasia, it did look like there was a little bit of pressure.
Good morning. Indeed, a fascinating trip. President Trump took a walk across the Fed headquarters here in downtown D.C. that are currently under renovation. The cost of this renovation is $2.5 billion, which attracted some ire from the White House officials, including Trump himself. But yesterday he got to tour, he got to see some asbestos removal, some other upgrades that really are pretty costly. He said he sort of understands why this is so expensive, and really that is not the major issue for him. The most important issue is to lower interest rates. He reiterated this call yesterday. We are less than a week before the next Fed meeting on Wednesday, when the Federal Reserve is expected to keep the borrowing costs unchanged. But again, there was this exchange. Trump spoke to reporters. He also spoke to Powell privately. They very likely discussed interest rates.
And he spoke to Powell on camera, even kind of nudged him in the arm there a little bit. Was there tension?
Indeed, there was a visible disagreement. Powell was clearly very uncomfortable in this situation, but on cameras, they mostly talked about the cost of those renovations. It's $2.5 billion. I think at some point, Trump tried to suggest that it's even higher, but Powell quickly dismissed those accusations, saying that those higher costs include another building that has been finished a long time ago, 5 years ago. So yeah, a very tense exchange, but in the end, clearly President Trump tried to strike a more conciliatory tone. He said that the renovations themselves are not a reason strong enough to fire Powell, so Fed chair will most likely see it until the end of his term in May. But Trump also mentioned to reporters right there in front of cameras that he is talking to other candidates, that he has 2, possibly 3 people he is looking at for the Powell replacement next year.
In terms of the replacement potential, what does that list look like right now? I know there's a couple of Kevins who could be up for the chair. Waller obviously is already there and could be promoted. Scott Bessent must still be in the running, I imagine. What does it look like, Kasia?
Yeah, so this is all, I think, part of this flat the zone strategy. President Trump himself keeps saying he wants the interest rates lower. Then he points to those candidates, as you mentioned, the two Kevins, Kevin Hassett, Kevin Walsh. Then those people go on networks as well. Kevin Hassett has been talking to Bloomberg and other networks, also calling for lower interest rates. As you also mentioned, Scott Bessent is most likely also one of the candidates, although he himself is actually part of the process. It looks like he is interviewing those other candidates, Kevin Walsh, as you mentioned, Christopher Waller. Waller also recently went on TV and said he also thinks that interest rates should be lower.
All right, Kasia, thanks so much for joining us this morning. Kasia Klimasinska there out of Washington, D.C., talking about President Trump's trip to the Federal Reserve, meeting with Jerome Powell himself, tapping him there on the arm, saying, lower interest rates, buddy. All right, let's get to the stock market here. One of the stocks that we're watching this morning is Intel. Shares extending declines after the CEO announced Intel will cancel some factory projects and take a more conservative approach to future spending. That overshadows its more upbeat sales forecast. Joining us now is Peter Elstrom of Bloomberg Intelligence. Peter, does it look like Intel really has no clear path forward? I mean, have they not laid out a plan that investors can get a hold of?
Yeah, it was an interesting report. You've got a new CEO at Intel, but you have that same sense of disappointment from the company. As you mentioned, the shares are down today. They came out with numbers that were, not terrible. Lip-Bu Tan, the new CEO, is articulating a strategy that's quite different from what Pat Gelsinger has talked about in the past. He came in, there was hope with the board certainly, and also with investors, that this was going to be a new strategy that was going to help Intel rebuild. This is, of course, the pride of the U.S. technology industry for a long time, one of the leaders. It's at the cornerstone of the Washington efforts to try to rebuild the domestic chip industry, but it's struggling quite a bit. So Lip-Bu Tan talked about how he does not subscribe to this belief that if you build it, they will come. The company under Gelsinger invested a lot of money into infrastructure, especially their foundry initiative, where they want to do custom-made chips for customers, much like TSMC does, which has been very profitable for them. Their big customers are NVIDIA, of course, and also Apple. So they want to move into that area. Gelsinger was very committed to this idea that they were going to own their own factories, they were going to get into foundry, they were going to restore that pride in manufacturing that Intel once had. Now Lip-Bu Tan is saying he's not going to move in that direction. He said in the past they've invested too much too soon, and he's going to back away from that. But he's not really articulating an alternative strategy that sounds like it's going to be a growth strategy for the future. And I think that's what we're seeing with some of the disappointment from investors this morning.
When he came in, Peter, it kind of looked like they had a cleanup guy who could get assets ready for a sale. Is asset sales still on the block here, on the list of possibilities?
Yeah, that's a possibility. We've done a lot of reporting around this. There are some non-core assets that they are talking about selling in particular. One of the big questions is whether they're going to remain committed to this foundry strategy. Again, foundry has become a very big business. TSMC really innovated that model. They came up with it. They've been able to benefit. They've become a trillion-dollar company, the first one ever in Taiwan. Because of that strategy. Intel, which for a long time had a big lead in manufacturing, was not able to capitalize on that, partly because they wanted to build their own chips. So now they're trying to repeat some of that process. They're trying to expand in that area. Under Gelsinger, they were very committed to that. Now, Lip-Bu Tan is saying that instead, they're going to take it very slowly. They're going to see if they get enough demand for those, foundry services, if they're going to get enough customers, and then they'll be able to expand it a bit more. Now, this comes as there have been some pretty positive reports about their new production technique. This is called 14A. They've been making some progress. It seems like they're getting better at some of the foundry business, but they still need customers to trust them, to bring them business, to be able to make those chips at their new foundries and then expand from there.
All right, Peter, thanks so much for joining us. Peter Elstrom, there of Bloomberg Intelligence, talking to us about Intel. Let's get now to a Bloomberg News exclusive. Our own Danny Berger spoke with Lowell Barron, the new CEO of Brookfield's real estate business, in his first interview since he took the position last month.
our highest conviction is still in rental housing, and it's been for a while. And while that may not be completely contrarian, there's a chronic undersupply of housing across the world. Home ownership, as you know, in the U.S. is really out of reach for most people. So people will continue to be renters for longer, and that means apartments, single-family rental, student housing, all the forms of rental housing are really interesting. But what we have seen in that sector is a real repricing that happened as interest rates moved up. We saw a real repricing of those assets. So today there's an ability to buy them from sellers that have to get liquidity, that can't handle their debt maturities. Values have come down, and so we can buy at attractive values and lean into what we think is really good fundamentals.
This industry is also grappling with another force coming in, and that's the likely allowance of private capital assets into 401ks, into retirement funds. Opinions vary here, but does real estate, a less liquid asset class, may be more risky for a more retail type investor? Does it have a place in retirement funds?
Look, my opinion would be absolutely yes. I think what we've seen, most of our investors are institutional investors, but when you just look beneath the surface of that, who are those investors? They're the pensions, the biggest pensions around the U.S. as an example, but who are they investing on behalf of? It's the firefighters and the teachers and the policemen and the government workers. They're getting great access to lower risk, higher returning private real estate assets, but why shouldn't everyone get access to that in their retirement accounts? It really doesn't, the way it sits today doesn't necessarily make a lot of sense. I think where we're heading to is a lot more logical, and there's a place in everyone's sort of allocation of their retirement portfolio for private real estate.
Well, you know, I'm sure you've heard this argument before, because the critics love to say, oh, everyone's just going to use this as a way to dump all their bad assets into retail. What do you say to those arguments to assuage any concerns that that is ultimately what ends up happening?
Like I hear that argument. I feel like as a responsible owner of real estate who's investing on behalf of those same kinds of people just through their pensions, it's no different. We're going to invest that capital into the same private real estate assets, the same strategies, and really we don't view it as any different. It's just a similar but varied source of capital.
Just before we let you go, it's been this environment where Brookfield, as a global behemoth, you've seen globally appetite really ebb and flow for American assets just because of the political volatility. Where do we stand now? Are we in a place where some of that volatility has ebbed? Is there still from international investors a desire for American assets? Or is political instability still upheaving some of that?
I think the main force would be that international capital believes it needs to be invested in the U.S., that the U.S. has the deepest and most liquid capital markets, and they need access to that, and it's an economy that continues to grow. On the margin, we are seeing a little bit of that noise. I'd say that some of our international investors who are asking the question or considering whether they back out a little bit. I think we may see a little bit. It'll come to the benefit of investments across Europe and Asia. So obviously as a global investor, we get the benefit of moving our capital around the world. But on the whole, I would say I don't think it's going to have any major impact.
That was Brookfield's real estate CEO, Lowell Barron, speaking with our own Danny Berger. Coming up, we're going to get you set up for your trading day and the weekend ahead, including the president's visit to Scotland. This is Bloomberg.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Matt Miller at the Circuit de la Sarthe in Le Mans, and this is Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
The new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hordern in Buenos Aires, Argentina, and this is Bloomberg.
Now let's take a look at what's ahead today. At 8:30 this morning, we'll get U.S. durable goods orders for June. So watch the EcoGo screen for that. We're going to get earnings from Skechers as well as Phillips 66. Oil is higher today, and President Trump is scheduled to leave for Scotland at 8 a.m. I'm sure we'll bring you the takeoff there and give you the story around it as well. In terms of the movers, as we told you, Intel is extending post-earnings drops as the CEO failed to provide a clear turnaround plan for investors. Decker's Outdoor higher after an earnings beat. Barclays raising their price target there for the stock to $134 from $128. Paramount also rising after the FCC approves its Skydance acquisition. And take a look at the 10-year yield moving slightly higher this morning. You can see New York crude also up 30 cents to 66.33, and gold at $3,346 a troy ounce.
cidade estava sitiada.
Nisso eu começo, eu não sabia o que fazer. Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home there, they are suffering. And someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
nisho talya ki kon ahmale pa ahmata suara pang ahmale pa manchang lenya ay kun mamanya. Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
I think we've had a great run. I think investors should feel good about that.
The AI theme has kicked back in.
The AI bullishness is there. I don't think that that has changed.
Overall, these foundational supports are what's driving markets.
I do think investors do need to prepare for what could feel like a very different second half.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. 4 consecutive record highs on the S&P 500 with U.S. earnings kicking into high gear. The spotlight shining brighter on central bankers as they debate the need for more rate cuts with a little extra pressure from President Trump. Earnings, meanwhile, painting a mixed picture of the U.S. consumer. John and Anne-Marie are off today doing some personal research into the travel industry, but I am not alone, and we are all lucky for that. Danny Berger is joining me for the next 3 hours. Danny, just another quiet week in the decade that is 2025.
Yeah, 2025, it's been so quiet. This week, quiet. Everything from hard hats to Powell getting slapped on the back from Trump to companies warning of billions in tariff hits. You wouldn't know it by looking at this market. To your point, a 4th consecutive all-time high, the 10th all-time high in less than 2 dozen sessions, and which, by the way, during all that time, the S&P hasn't moved more than 1%. The longest streak it's done that since October of last year. It is as if the summer melt-up is in full force.
Yeah, summer melt-up is the right way to put it. Just each day eking out just a little bit more in terms of gains, and we are getting some color around corporate America and, frankly, global corporations and how they're adapting and adjusting to tariffs. It's a mixed picture. It's really a lot of strength for the most part overall in the United States, but across the world, a little bit more in terms of potholes.
It's so true, but I think some of the animal spirits are back, and you get this from a lot of the financial firms. There was Blackstone earlier in the week. John Gray was speaking to the FT saying that confidence has been restored, that the animal spirits are back, that M&A boom is coming. Goldman Sachs, we also learned this week, isn't going to do their second round of job cuts as planned. So that combined with a market that's rallying, even though there are pockets of weakness, we can look through it because of the animal spirits, because of this confidence that seems to be restored.
And we'll get into the meme stocks and some of the evidence of froth there, as well as the margin pressure that people look at in terms of just how much leverage there is being built up in the system. But I want to speak up to what Michael Hartnett was talking about with his bubble concerns, where he said, when you have the idea of loosening fiscal policy at the same time as loosening government regulations around the financial sector, this is when you end up with true bubble risk. So he started to raise this in a note this morning. What do you make of this sort of idea that down the road this could be problematic, but in the near term, well, it's unclear what this means?
Well, kind of the best thing you can do when a bubble is starting is go long, is ride the bubble. That's kind of the trade to do. But of course, in the long term, it's an issue because of leverage, which you highlighted. Other things get dislocated. It also brings to mind something Ian Lincoln said earlier in the week, that as stocks start to hit a record high, as you get retail traders who are putting it all in and gambling on these types of meme stocks, that you get back into this environment that maybe you need to start asking, is a wealth effect coming in that's just going to exacerbate inflation, and exacerbate inflation at a time where we don't know what tariffs will do in terms of stoking prices. So maybe that needs to be another factor on the Fed's mind as they try to navigate where policy goes from here.
Next week is a big week. We've got 38% by market cap of the entire S&P 500 reporting earnings. We have, of course, the Fed's meeting. A lot of eyes are going to be on that, particularly from the White House. And then we've got the jobs report all coming together at a time when people are starting to worry about a bubble, and that means maybe you need to get in even more so right now. In markets right now, very quiet. You're seeing not a lot of action. Stocks basically fluctuating between gains and losses, a little bit down on the NASDAQ. You can see bond yields creeping a little bit higher, particularly on the front end after yesterday's ECB decision that really suggested maybe they could stay on hold. Coming up this hour, we're going to be speaking with Max Kettner of HSBC as stocks look for a 5th straight day of gains. Jason Thomas of Carlyle on the impact of AI-related CapEx boom on the U.S. economy, and Tom Fitzgerald of TD Cowen following mixed results from the airlines. We begin this hour with stocks looking for a 5th straight day of gains, fluctuating between gains and losses following a busy week of tech earnings, trade deals, more of those on the horizon. Max Kettner of HSBC joining us now. Max, the last time we spoke to you, after being a raging FOMO bull, you really pulled back a little bit. So where are you as we look at sort of new records being made every single day? Do you lean in or do you lean out?
Yeah, good morning, Lisa. No, still very much leaning in. Of course, we wrote a note this week where we explored what could go wrong, but very much stressing could go wrong. It's not, I really don't really subscribe to the notion of this being a bubble. I think it would be a bubble if there wasn't growth behind it, if there wasn't earnings behind it. But the reality is, look, don't even look at the Q2 reporting season. Let's look at the last reporting season. You know, we had a way above average earnings beat rate. We had way above average surprise factors, and it's starting once again. We again have in the Q2 reporting season pretty healthy beat rates, pretty healthy surprise factors. When we look at AI, we look at tech, once again AI CapEx plans are actually exceeding expectations. Remember, 6 months ago, we've been all very, very worried around DeepSeek, what that means for CapEx plans. And not only in Q1 has that in the S&P 500 exceeded expectations by 10%, we're starting in Q2 once again with that exceeding even higher expectations. So to me, none of that smells like a bubble. It would be a bubble if there was no, you know, if let's say people were to slash these CapEx plans, if we didn't see particularly great earnings beat, if we already saw a big negative impact on margins, on earnings from tariffs. None of that really seems to be the case yet. So with that earnings power behind it, I think the rally can stay for at least through the summer.
That said, Michael Hartnett's point here is that given all the strength that you're talking about, why should central bankers be cutting rates? The idea that even though we are seeing this strength, this resilience, this lack of any kind of pain relative to the tariffs and some of the fears that we've seen heading into this year, we continue to see record highs, and yet we still see central bankers talking about rate cuts. How predicated is the idea of a further melt up on this idea that we are going to get dovish central bankers?
Yeah, look, I would be worried a lot more if, let's say, the 30-year was approaching 5.5, if the 10-year was already above 4.7, 4.8%. One of the models that we look at internally is what we call the danger zone when it really starts hitting risk assets, when the level of yields or the increase, the velocity of the change in yields is simply starting to be too much for risk assets to stomach. That sort of level on the 10 years starts at around 470, 475. So, you know, we're a good 35, 40 basis points away from that. If we were already at that level, I would totally agree. I think then I'd be like, you know what, it's a bit tricky, because if indeed we get a bit more hawkishness, yields further up, that indeed would be stoking a little bit of fear on spread valuations, on equity valuations. But we are quite far away from that kind of level. So that's number one. Number two is I think risk assets don't really care as long as the idea of rate cuts keeps being alive. That is totally fine. Do we really, do equity investors, do spread investors, do we really care whether they're going to cut in September or whether it's only December? That's probably a rates trade. It's a trade whether you've got the receiver or the payer for September on. Fine, yeah, if you've got some trade on the front end on. But for risk assets overall, particularly with that backup in yield that we had in the last couple of weeks, it doesn't really matter as long as the Fed says, look, down the road in the next 12, 18 months, yeah, the next step is going to be a cut. That's totally sufficient for risk assets to rally further.
Max, what does that mean as to how risk assets would react? For example, next Friday we get jobs data. If you start to see some real deterioration in the labor market.
Yeah, look, if we were to see some real deterioration in the labor market, fine. Of course, we could have a little bit of risk off, but bear in mind, I don't think that would be particularly sustained. And I actually would say, even if the Fed on Wednesday, for example, was to sound a little bit more hawkish, again, yeah, fine, maybe the front end goes up a bit and that puts a bit of pressure on valuations. But other than 2, 3, 4% down, I have real trouble both with weakness in the labor market and with a more hawkish Fed, that really changes the picture. Because once again, it's the growth, it's the earnings picture that is really, really solid. And that really, I think that really puts into question that notion of this being a bubble, right? That really, really puts it into question. I think we would need to see proper weakness in the labor market. You know, the unemployment rate going up to like 4.3, 4.4%. That is then where we'd be calling into question the validity of this rally, right? Before that, I think it's just a tiny bit of correction, a pretty healthy correction in this way up in risk assets.
Max, not to put too much weight on his note, but again, part of Michael Hartnett's point was that what we're seeing is central banks globally loosening policy. What we're seeing is governments globally putting stimulus. I mean, just look at Europe and the spending that's going to happen there in terms of the military and defense. Max, what you're describing, to what degree is it a global phenomenon?
It is indeed, yes. I do think, I mean, it's Europe and US, it's other jurisdictions as well. And of course, what that means is, it means probably for the foreseeable future, for the next couple of quarters at least, we will continue to have a pretty strong and pretty high nominal growth world. What do you do when there's a higher nominal growth world? And what do you do if perhaps inflation does remain a little bit stickier and does remain a bit higher? What's your ultimate hedge? Well, it's equities, because equities is the one asset class that exposes you to nominal cash flows. It's a nominally growing asset class. So if indeed, yes, we were to see in the next 12, 18 months, perhaps in the US in particular, inflation a little bit higher, I wouldn't be really throwing in the towel, because the counter to no rate cuts, or not as many rate cuts as markets have priced in right now, the counter to that is a continuously strong nominal growth world, which is really good for equities in particular.
I love how much the idea of a bubble seems to have triggered you this morning. It seems like we're trying to put our tinfoil hats on and you're like, this is ridiculous, how could you? I do wonder though, it goes to this idea of people looking for havens, looking for a ballast in their portfolios, which has also kind of triggered you to think about bonds in that same kind of way. And we saw that in your recent note. What have you found in terms of what the new haven is and how different it is than say 5 years ago?
Yeah, look, I think what is different definitely is around the dollar. The dollar probably is no longer that big safe haven. One of the key risks that we are worried about in the second half is perhaps a retightening of the labor market because of immigration flows going into reverse, certainly going the other way from where we were in 2022 and 2023. And that, of course, would lead, perhaps this retightening of labor market would lead to a repricing of rate cut expectations on the one hand, but it would also lead to a negative impact on growth. So that would be the worst of all worlds, where US growth would go down, but we also have a tighter labor market that constrains the Fed. In that environment, you know, the dollar probably doesn't perform as well, because you are going fully into some sort of stagflationary concerns. What performs well there? It's still, you know, things like gold. It's still things like the Swiss franc. Those, I think, particularly on the gold side, where we are really, this is pretty much the only safe haven we are overweight at the moment in our tactical asset allocation views. That still very much reigns supreme, because you have these continued geopolitical risks lurking in the background. You've got perhaps those stagflationary concerns also coming back in the second half. And then the only one really hedging against that is gold, and perhaps a little bit also the Swissy.
Max Kettner of HSBC, thank you so much. As we do see gold on an absolute tear this year at the expense possibly of the dollar. We're not sure, but there is a sense that maybe we are seeing a haven play there. So interesting, and I'm glad that you really keyed in on Michael Hartnett's note also. I thought it was interesting because it's predicated on this idea that there is this global easing cycle. Right after we got an ECB meeting where they were pretty hawkish, they at least tried to be, and talked about how they're in a pretty good place, almost taking off the prospect of further rate cuts this year.
Yeah, sounding a lot like Fed officials saying that we are in a good place. I think it just goes to show that when there is the risk of inflation volatility, it's really hard to continue with the whole great moderation. That's what it was predicated on. The fact that maybe we got lucky that there weren't supply shocks, that central banks were independent. Those are the two very same narratives that are being tested right now. So it begs the question, do you need more premium for bonds? And if you do need more premium in bond yields, can equities stay where they are right now? It's these big questions that I think has a lot of people nervous to continue riding on this wave of optimism.
We'll be getting into hard hats and construction zones in just a minute. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. We are staying on hard hats, actually. President Trump put on a hard hat and toured the renovations at the Federal Reserve with Chair Powell. And there was that tense moment when the president claimed the price tag had jumped from $2.5 to over $3 billion. Following the tour, Trump said there wasn't cause to fire Powell, but reiterated his call for the Fed to cut interest rates. Meanwhile, at least $1 billion worth of NVIDIA's top AI chips made it into China in just 3 months, despite U.S. export bans. The Financial Times citing sales contracts, company filings, and saying Chinese distributors sold restricted processors through a black market channel. Washington has since reapproved sales of NVIDIA's H20 chip, which performs below the restricted B200. And LVMH sales fell in the second quarter as demand slumped in Japan and China. Revenue at its fashion division, which includes Louis Vuitton and Dior, tumbled 9%, which was worse than analysts expected, while first half profits slipped 15%. Shares are down more than 25% over the past year. That's your Bloomberg Brief. Lisa?
Thank you so much. Yahira, up next, agree to disagree.
It looks like it's about 3.1 billion. It went up a little bit, or a lot. So the 2.7 is now 3.1.
I'm not aware of that.
Yeah, it just came out.
Yeah, I haven't heard that from anybody at the Fed.
A made-for-TV moment in the Fed Reserve's new building. John Lieber of Eurasia Group joins us next. This is Bloomberg Surveillance.
Politics to the world of business. Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Trying to eke out a 5th straight day of gains after 4 record closes, but each of those just inching upwards, as Danny was talking about earlier. Just really some knowledge in the markets. Not doing a lot today, although we are seeing a little bit of a pop in the Russell 2000 in the bond space, just creeping a little bit higher on the front end of the yield curve. And frankly, this is a worldwide phenomenon after yesterday's ECB meeting, heading into the Fed's confab next week. Under surveillance this morning, agree to disagree.
We're just taking a look at what's happening. You know, it's It's a tough construction job. It looks like it's about 3.1 billion. It went up a little bit, or a lot. So the 2.7 is now 3.1.
I'm not aware of that.
Yeah, it just came out.
Yeah, I haven't heard that from anybody at the Fed. You're including the Martin renovation. You just added in a third building is what that is. That's a third building.
Well, no, but it's a building that's being built.
No, it was built 5 years ago.
It's part of the overall work. So, well, I'd love him to lower interest rates. But other than that, what can I tell you?
Here's the latest. President Trump continued questioning the cost of the central bank's renovation in a rather awkward exchange with Fed Chair Powell. Trump also reiterating his belief that the Fed should lower interest rates. Bloomberg's Mike Shepard joins us now. Mike, other than having sort of an awkward marital spat over renovations, what did we learn yesterday?
Well, we actually saw the president try to lower the temperature a bit on this question of whether he would or would not proceed with trying to dismiss Jerome Powell as Fed chair. After the tour, and despite that tense moment with the Fed chief, he indicated, look, that the building doesn't really rate quite as what some in his administration have considered to be a firing offense. We even saw Jay Powell take issue with the president's number there right in front of the press. And that's not usually the kind of challenge that Donald Trump takes kindly to, but he took it in stride. And then afterward, again, addressing reporters, really made clear that he just wanted one thing, Lisa, and that is he simply wants interest rates cut. And this has become a central theme of his economic message. In addition to tariffs, in addition to tax cuts, he wants to see rates come down for the sake of home buyers and businesses. And he tried to make that call pretty clear yesterday during this visit.
The whole flood the zone type of approach where you throw a lot of things into the same ball. Bloomberg's Mike Shepard, thank you so much. As always, joining us now, John Lieber of Eurasia Group. John, the fact that we did see a conflating of these two ideas, first of all, taking issue with exactly what the renovation costs were, but then just lower interest rates. How unusual is this, and why are markets still continually shrugging off this sort of unconventional, at least verbal intervention with the central bank?
Yeah, it's definitely unusual. I don't think we've ever seen anything quite like this. I mean, it's pretty clear that at least within the last few weeks, Trump has wanted to fire Powell and is taking the idea really, really seriously. It's the only reason this building is a controversy. It's the only reason the OMB sent the letter, which was accusing Powell of malfeasance, which would have allowed Trump to fire him for cause. But I think what we saw yesterday, we can call it the Eccles building truce, because it's clear that Trump's moving on from this idea. I think that Treasury Secretary Scott Bessent and others have really prevailed on him that firing Powell would be very bad for his presidency. He toured the building. Doesn't look like Versailles, despite what he's been told by some other folks. And I think that this issue is largely going to go to rest, and markets are probably right to ignore it for now.
Yeah, really underscoring it's not Versailles, given just the location they were talking in the hard hats. I don't think you'd be wearing that in Versailles. John, what does it mean as to what we expect from President Trump here? Do you truly believe he's moved on from this topic, or is this a president that's going to continually try to jawbone Powell?
No, he's not moving on. He thinks he should have the power to control interest rates, and I think that's one of the big dangers next year after Powell's replacement has been announced, is that either you have a Fed chair that's much more open to intervention from the president, or you have markets that believe that the Fed chair is open to intervention from the president. And I think that the key date to watch right now is the next Fed meeting on July 30th. If they don't cut rates then, I think expect this theme to come back up, and Trump's going to tell them that he wants them to lower rates again. But I just don't think he's going to fire him. So I think this is more of a 2026 story. It's more about what happens after Powell. And for the next year or so, we're going to continue to hear Trump talk about this, and you're going to continue to hear markets correctly ignore it.
John, does that mean we're already set up in a scenario that for 2026, whoever the Fed chair is that there's already a loss of credibility, that we're already questioning the political nature and swayability of who comes in next after Powell?
Yeah, I mean, a lot of the clients that we speak with raise this concern that they think whoever Trump ends up choosing is going to be someone who's told him behind the scenes that he's willing to do the stuff Trump wants, which is cutting interest rates at a time the data doesn't support it. So I think that's a credibility challenge for the next Fed chair. It means that they're going to have to take additional steps in order to anchor inflation expectations. This could mean that they have to raise rates, and that could risk when they wouldn't otherwise. that could risk Trump's ire in that situation, or you just have markets who don't believe that the Fed chair is going to do what they say they're going to do. So this is a huge problem for next year. One factor that I think matters a lot is that whoever the chair is going to have to find a majority on the board. So it makes it much more difficult for the president to put somebody in who's purely pliable, because rates are subject to a vote of the FOMC, and that is going to make it harder for a pure Trump loyalist to get his or her will as chair on the board.
I can just imagine an investor listening to this conversation and saying, you guys are still worried about this because we've moved on. We've stopped looking at the potential conflict of interest at the Federal Reserve. Yes, this is an unconventional president, but we're looking at the idea that we've got tariff agreements, that we have the one big beautiful bill, and frankly, we feel pretty good to keep propping up equity valuations. Have we gotten some certainty, even as there is this very unconventional approach to the Federal Reserve that largely the market is kind of shrugging off?
Absolutely. I mean, I think that the August 1st deadline is relevant because we'll know where the tariff rates are going to end up landing for most U.S. trading partners. It looks like the U.S. and China are headed towards a summit later this year. And the only way that's possible is if you get agreement around where the Chinese tariffs are. And so I think that a lot of the uncertainty that was prevalent earlier in the year is really being washed out of the system right now as the world is getting used to the United States having a roughly 15% average tariffs, which is a massive increase from where they were at this time last year, yet the markets don't seem all that bothered by it. So I do think going forward, that even with the headwinds and the frictions of higher tariffs, you have a lot more certainty, and that's probably good news going into the rest of the year. The question, however, is going to be, when does the economic data start showing inflation or the effects of Trump's immigration policy? We haven't really seen that yet. It may not come, but it does feel like if you just look at this from the pure policy perspective, there's another shoe that could drop here.
How much are clients taking at face value some of these deals? The idea that these are the rates that are going to stick?
I think for the most part, these are seen as credible. I think that the Trump administration has been very clear in its messaging that it doesn't want to be litigating tariffs in the second half of the year. Scott Bessent said over and over again that he wants these deals to be done by Labor Day. And I think that even if there's some, you might see, one of the challenges here, I guess, is that the purchase agreements may not come through. Trump might retaliate with higher rates, but the deals that are being agreed to are the deals that they think are going to stick. And I think that's probably right.
John Lieber of Eurasia Group, thank you so much. And this does seem to be what people are focusing on much more than concerns around the Fed, because evidently you say something enough and the market just becomes numb.
Yeah, and you announced 15 baseline tariffs instead of 10, and you hit all-time highs. I think it might underscore that August 1st maybe isn't the big scary deadline for markets that we once thought it would be.
It might be the big scary deadline, though, for Volkswagen and for Puma, and we'll be talking about that in just a minute. Coming up, though, we'll be talking with Jason Thomas of Carlyle ahead of more Magnificent Seven earnings next week, really driving the optimism amid this AI CapEx boom. Plus, Yahira Anand with your morning movers as Intel falls on turnaround concerns as they don't promise the same kind of growth tied to the foundry.
Bloomberg launches our inaugural 25 African startups to watch list.
About 2.5 years ago, we created a solution. We are able to generate refrigeration using the sun and water. We're able to store energy in the form of ice, as opposed to storing energy in the form of lithium batteries. We're integrated in every refrigerator, a pay-as-you-go technology, allowing individuals and small businesses to be able to pay as low as $10 to own a refrigerator.
Uncover is a women's wellness brand that is specifically made for women of color. It's based in Africa, which is the most underserved beauty market in the world. We are making Africa a priority and not an afterthought. We believe that the population on this continent deserves to be formulated for, heard, and we are giving this consumer a voice.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life.
I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
4 straight days of record highs at the close, although each of these record highs, just to give you a sense of the incredible zest underneath it, yesterday's record high was up 0.07 for the S&P 500. Meanwhile, if you take a look across the board this morning, not doing anything, as it hasn't been for quite a while. The Russell 2000 getting a little heat up, 0.2%. What you can see in the bond space is interesting, especially after yesterday. At the front end, a bit higher. At the long end, a bit higher, as people price in the idea that maybe central banks globally will remain on hold. 2-year, 10-year, 30-year, across the curve, across the globe, inching ever higher with 30-year German bond yields at the highest levels since 2011. 3 hours away from the cash open, here is your morning movers with Yahira Anand. Yahira.
Hi, Lisa. Build it and they will come is no longer the strategy over at Intel. Take a look at shares. They are down 7.3% after its new CEO, Lip Bouton, said he was scrapping major factory projects and called spending at the company excessive as it tried to revive its foundry business. But investors apparently not sold on this vision. And they also did not like that Intel guided lower on margins and that it didn't give a clear path when it came to competing in AI. Next up, we have shares of Paramount. They are rising 1.7% after the FCC approved its merger with Skydance in a deal mired in controversy. Just a week ago, we were talking about how Paramount canceled Stephen Colbert's show, with some thinking that it did this in order to get this deal over the finish line. But whatever you think about that, the deal is done, and Sherry Redstone, whose family has run this company for decades, will be stepping down from the board upon its completion, and David Ellison will become chairman and CEO. That is some succession-level drama. And we end with Deckers. It had a blowout quarter. Shares are up 13%. This is the company behind Uggs and Hoka sneakers. Sales jumped double digits for both brands, but it's not all smooth sailing from here because this is a shoemaker, so of course it is heavily impacted by tariffs. And while it was mostly able to avoid that by front-loading shipments, Deckers is warning that price hikes may be coming as those costs start to catch up to it. Lisa?
Thank you so much, Yahira. So interesting to watch the retailers as they adjust to the potential tariffs. On our radar this morning, there is only one story. It has hard hats and is made for television. President Donald Trump downplaying his feud with Fed Chair Jay Powell after touring the central bank's renovation project, despite some moments of tension.
It looks like it's about 3.1 billion. It went up a little bit, or a lot. So the 2.7 is now 3.1.
I'm not aware of that.
Yeah, it just came out.
Yeah, I haven't heard that from anybody at the Fed. You're including the Martin renovation. You just added in a third building is what that is. That's a third building.
Well, no, but it's a building that's being built.
No, it was built 5 years ago.
Well, I'd love him to lower interest rates. Other than that, what can I tell you?
We're going to play this over and over again today because it really is quite something. And I've got to say, Danny, it leaves me with this impression that it did feel a bit like two people arguing in a sort of congenial way about something that we all have argued about, home projects, given the fact that there tend to be some issues that come up.
Well, I mean, kind of the hilariousness of this was that the Fed worked so hard to try to dispel the issues with the building, putting out memos, changing their website. Literally all it took was for the two of them to get together, put on their silly little hard hats, slap each other on the back and laugh, and afterwards you have Trump tweeting out, it is what it is, our country can handle the high costs. I thought another little amusing detail was the Wall Street Journal. They're reporting they got a tour from various Fed officials of the building. Apparently, there's an oval entryway, and before Trump had come, they wrote on it the Oval Office. They thought it'd be a funny joke, but then they spray painted over it because they were scared they were gonna anger Trump. These are federal officials who were so nervous, and then you get this really jokey attitude once they're both there.
Yeah, let's see how nice that attitude will be, though, next week if they do not cut rates on Wednesday. That will be the Fed meeting, and we are expecting them to hold rates steady, although with two potential descents. Meanwhile, real question of what the outlook is going to be, not just for U.S. companies, but globally. Volkswagen lowering its financial outlook for the year, citing the escalating cost of President Donald Trump's tariffs. The company's CFO telling us here at Bloomberg, quote, "We need a good compromise." It felt like the tone at European companies a little different than those in the U.S.
And especially when you think about what just happened in Japan. With the trade deal there, with getting car tariffs, those sectoral tariffs down to 15% for them, Toyota goes off to the races. But of course, one of the big differences is Toyota makes some $60 billion worth of cars in the U.S. Volkswagen isn't doing this. And I thought Matt Miller had a really good point earlier this morning that you could say, hey, Porsche should start opening a U.S. factory and making cars here, but no one wants to buy a Porsche 911 built in the U.S. The whole point of them is that they're luxury cars. You buy them in Stuttgart. So how much can Volkswagen really shift over to the U.S. anyway?
That feels like a very personal point from Matt Miller. That's all I can say.
None of us are buying 911s.
Exactly. None of us are actually buying 911s or going to Stuttgart to view the different models, although some of us, I assume, all right. Meanwhile, looking at this story, and this is something Yahaira was just talking about, Intel CEO failing to convince investors that the company's turnaround plan is still on track. The chipmaker reporting an upbeat revenue forecast, but adding the company will cancel some factory projects and take a more conservative approach to spending. Those shares lower by 7.3% in pre-market trading, and they also talked about some serious job cuts.
Serious job cuts. Spending is going to be reined in, really in opposition to what we're hearing from all the other big tech. And I know that this is a very Intel-specific story, but I wonder if you can look at it and say, look, you have all of these companies spending so much in capital expenditures. We know CapEx cycles are boom and bust. What if more companies start going the way of Intel? Are we now developing this really fat set of distributions from the spending that we're getting? And if more companies need to cut back, does it hurt that much more? Again, I know Intel has its own problems, but could it suggest something that might come down the road for others?
It also speaks to the winners and the losers in the tech stack, and the idea that Intel possibly delivered better than expected earnings from bringing forward demand ahead of tariffs, but doesn't have a growth strategy, and frankly is still hinged on the PC world that is undergoing a lot of transformation and doesn't have a sense of promise for the future. And that really goes to the question of how much are people looking way beyond these current earnings to what is your forward-looking dream, the dream of AI, the dream of agents, the dream of technology to back it up in terms of energy and other infrastructure.
That's why I don't know is not a good enough answer for a lot of these companies. A chip maker earlier in the week said, we don't know how much of our sales were a pull forward. We have 100,000 customers. We don't know. Markets didn't like that because they want to know. They want to know that what we're seeing now, and I think across the board, isn't just that pull forward and you have a plan in place.
Let's stay with this, the idea of CapEx and what this means for some of the big tech earnings. We get more Mag 7 earnings next week, and we are going to see potentially if some of those AI investments are paying off. Jason Thomas of Carlyle writing, the job displacement, productivity gains, and agentic economy expected to upend our world have yet to materialize. The current AI-related CapEx already accounts for more than 1/3 of the second quarter 2025 U.S. economic growth. Jason joins us now. Jason, always wonderful to speak with you. Thank you for being with us. And to me, this is the big question that so many people have underestimated for 2025. How much are we actually seeing that AI tailwind come into practical effect versus still remain a promise?
Well, I think it's interesting because when you think of AI, when you discuss AI, it's almost exclusively about the future and what it means. And that, I think, distracts from the present, just how important all this spending is. Stacks, servers, GPUs, physical construction, and of course, electricity, related energy needs, related applications. And this, you have 4 companies now that are intending to spend over $300 billion this year. About 6 are spending over $400 billion. This went from something that is market significant, stock market significant, to something that is now GDP significant. And also, I think, underappreciated, it's also increasingly significant for bond markets. Because, if we look a decade ago, these large companies, they were largely virtual companies. Prior to the pandemic, this class of businesses, only about 20% of their book value was property, plant, and equipment. Most of it was really just cash, security holdings. Now, property, plant, and equipment accounts for over 70% of their book value. There's an industrial feel to some of these businesses as they ramp up their capital spending, and that huge surpluses that they used to generate, that providing liquidity to the rest of the economy, is now being rolled into to capital spending AI.
So, Jason, just to sort of bleed through into the market, what you're saying, the industrial revolution that so many people say is taking place, are you saying that is the physical world sucking capital out of financial markets, in particular the bond market, leading to higher yields?
Exactly. Again, what's so interesting, I think, is that these companies have really exercised an option to change strategy. In the past, it was typical to generate $100 billion of cash from operations, reinvest maybe 12 to 15 billion, and then that free cash flow would, of course, lead to a massive war chest on the balance sheet, or it would fund huge share repurchase programs or special dividends. Today, that revenue is being diverted to CapEx. And so this raises really interesting questions, such as the cash generation potential. We saw in Alphabet's earnings a big divergence between net income and free cash flow. It also raises industrial era questions about capacity utilization. And also, what is the economic rate at which this new capital depreciates? Is there functional obsolescence when you're investing at the frontier of new technology? How quickly does it arrive? So these are, again, very interesting questions. But from the bond market perspective, when you look at the cumulative cash flow surplus of the corporate sector this cycle, it's down 75% from where it was a decade ago. So the last cycle, there's a question, very large deficits. Why was it so easy for the Fed to fund itself? Well, of course, QE is the simple answer. But I think behind that, you also had, again, this enormous corporate savings glut. Some of that was cyclical, the scars from the GFC, but a lot of it was that most of the growth in earnings and revenues were attributed to, again, these virtual businesses that could grow revenue without incremental hiring, incremental investment, and they've changed strategy.
So, Jason, it's some serious tailwinds and changes we're talking about. But as you underscored, it's only a handful of companies. It's only 4, maybe 6 companies, hyperscalers, that are leading this charge. Is there a concentration risk in this, that these trends are being driven by a small cohort that for now are being rewarded by markets for spending? What happens if that changes?
Yes, of course there's concentration risk. There's concentration risk in the stock market. There's concentration risk in the economy. Again, as capital spending and GDP become more dependent on these continued outlays. And I think that people talk about the Mag 7, of course, and it's the share, I think, 15% of global stock market capitalization, almost a third of the S&P 500 market capitalization. But I think that what's more concerning, to me at least, is that these are not a diversified set of businesses operating in completely different sectors with completely different strategies. They're all basically pursuing the same end goal at the moment. There's some variation, of course, but in general, it's a concentrated bet on the same AI future. And everyone has to hope that ultimately it pays off, because again, it's not just of significance for the stock market or investors in these particular companies, but again, it has very significant spillovers on the rest of the economy today as well.
Well, some of those spillovers, Jason, which has been widely talked about, is what it does to this labor market. And there it's unclear what's really showing up. You see it in some of the earnings. ServiceNow, the management platform tool, the CEO there saying yesterday, we're slowing down the hiring in jobs that are, quite frankly, soul-crushing, which I think is maybe a nice way to describe replacing people's jobs with AI. Jason, is it showing up anywhere?
I think that most of the change in the labor market that we observed in 2025 was related to tariffs, just the shock, the uncertainty. And I think what was so interesting about that was CEOs really not panicking. After April 2nd, I think there was this intention to project a sense of normalcy, to look at competitors and see if there were any missteps, if they could take market share. And part of that had been, yes, perhaps slowing the pace of hiring, but it was just interesting when we look through our portfolio that there really not much of a reduction in open but unfilled positions. There really wasn't the pullback that I think many people expected. So the labor market has held up reasonably well. And of course, on the other side of that, you have inflation. That continues. If you look at core PCE over the last 12 months, still probably 2.6%. So, it is this interesting moment where I think that inflation's a bit stickier. I mean, of course, some people look at the last 8 to 10 weeks and tell me inflation is only up by 1% annualized rate. But, of course, there's not that many prices in our economy that reset that regularly, whether they're fixed for contractual term or just other frictions. So it's a 12-month inflation benchmark, and it's still elevated. So, next week, I think, is a time when the Fed is very reasonably going to keep rates steady.
Jason, you're making an argument for why stocks can outperform and bonds cannot. The idea that the promise of the future and all of this investment and the profitability is much more attractive than credit markets that people say, or I would say government bond markets. Credit markets might be slightly different. Is that accurate? Is that kind of the way you think of the world right now?
There is, of course, the convex upside of earnings, of the potential of AI. And that is what equity markets are ultimately betting on. Whether that materializes or not is a separate question. But there is that upside there. And I think also just the potential for inflation. When you have businesses that can increase prices proportional to the overall increase in the price level, that also provides an inflation hedge when you're investing in businesses. The fixed income markets, that's a different story. Right now, if you look at the size of the U.S. fiscal deficit, it's consuming about 40% of the savings of the private sector. That is the savings of the household sector plus the free cash flow of the corporate sector. This is up about 50% from where it was in the past cycle, the 2009 to 2019. So this is just enormous funding needs. And I think that people have to be, concerned about the potential to be inflated away. Eventually, the Treasury may try to term out more of its debt issuance. And what is the market clearing price when the share of federal funding actually moves in the direction of 10-year notes, 30-year bonds? So I think certainly a lot of questions there. And I think the other big concern, bonds historically have hedged equity market risk. That was the experience really since 2000. What we've seen since the Fed started hiking rates in 2002 is that stock and bond returns have been positively correlated. Right. So those Treasury holdings that you thought were protecting you, that would rise predictably when stocks sell off, are actually selling off at the same time. And we saw that, of course, in April, which many people attribute to the decision to suspend the initial Liberation Day tariff schedule.
Jason Thomas of Carlyle, thank you so much. A lot to think about and really insightful comments there. We really appreciate you joining us. Right now, let's get you an update on stories elsewhere. Here are your Bloomberg Brief stories with Yahira Anand. Yahira.
Hi, Lisa. Israel and the U.S. are withdrawing teams from ceasefire negotiations with Hamas, citing the group's unwillingness to agree to terms. President Trump's envoy, Steve Witkoff, said Hamas showed a lack of desire to end the war. Israeli Prime Minister Benjamin Netanyahu said any deal must include Hamas surrendering and giving up control of Gaza. Sticking with the Middle East, French President Emmanuel Macron says France will officially recognize a Palestinian state, becoming the first G7 nation to do so. Macron says France remains committed to, quote, just and durable peace, while calling for an urgent ceasefire. U.S. Secretary of State Marco Rubio criticized the move, stating in a post that it sets back peace. And shares of Puma are plunging 17.6% in German trading. The company slashed its profit forecast in the face of weak demand for its sports and exercise gear amid growing concerns about the impact of U.S. tariffs. This is the third major rout this year for the company. Shares are down over 50% so far this year. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, bumpy airline earnings.
Business demand dropped off at the start of the year. That seems like it's bounced back to what we were expecting it to be. Premium and higher end leisure sort of stayed consistent throughout it. The biggest impact for the consumer was in low end leisure.
Tom Fitzgerald of TD Cowen joining us next. This is Bloomberg Surveillance.
You missed it on Bloomberg Insight.
Losing a few people is not actually that unusual. These companies are constantly pulling people, in both directions. The real question is, can it turn around Meta's fortunes? It's about who is leading in terms of adoption, in terms of B2B use cases, B2C use cases in different countries. And we're seeing Chinese companies certainly making a strong showing across many of those fields, even if, I would say that the US is still generally in the lead. But what we've seen at the company level and at the product level is actually that continued decoupling. So I think it's a pretty safe bet that is going to continue to be the case.
Not to bring up the past, but you've criticized Sam Altman. I'm just wondering whether you've made peace with Altman on the back of that drama.
So we haven't actually interacted since the time. I'm sure at some point soon we'll end up at the same event, and the AI world is pretty small, but no, haven't had a chance yet so far.
Don't miss Bloomberg Insight live weekdays.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Stocks looking for direction ahead of a huge week. A lot of people parsing through myriad earnings we've gotten, particularly from the travel and leisure sector. Under surveillance this morning, bumpy airline earnings.
Business demand dropped off at the start of the year. That seems like it's bounced back to what we were expecting it to be. Premium and higher end leisure sort of stayed consistent throughout. It never really dropped off. And the biggest impact for the consumer was in low end leisure. And that's come back some in July, but not as much.
Here's the latest. Mixed results from airlines. American and Southwest cutting their outlooks for the full year as Delta and United reinstate their full year guidance. Joining us now is Tom Fitzgerald of TD Cowen. Tom, what's your takeaway after the earnings we've gotten so far about the tale of two halves when it comes to airlines?
I think we're seeing some green shoots among airlines that have diverse revenues and airlines that are more exposed to premium travel, corporate travel, and long-haul international. Even with American, they did have much better results than Southwest reported yesterday, and I think it's because of exposure to revenue streams like that. And I don't think the airlines, whether it's Southwest or the other low-cost carriers that have yet to report, I don't think they're out of the woods yet, so to speak, in terms of the volatility we've seen in 2025.
Tom, what do you do with something like American when they give you an estimate going forward for earnings that's as low as a loss of 20 cents or as high as 80 cents a share? What do you do with a gulf like that?
Yeah, it is a wide range, but it's the airline industry. It wasn't, I think part of the problem was sell-side estimates were broadly too high. I mean, a lot of what they guided was pretty close to where our numbers were. So I don't know if it's maybe the outlook isn't as bad as the gap between what was guided and what people saw on their Bloomberg or FactSets yesterday.
Well, still, you noted that the ones that are doing better have their premium travel, and we've seen airlines invest more into premium travel, expand the seating there, for example. But it's an industry that sometimes is bad at looking beyond the moment. We learned that in the bounce back from COVID when they were unprepared for it. Tom, what is the risk that airlines are investing into premium as we might be hitting a precipice where consumers start to pull back on spending?
That's definitely a risk for sure. I think there's also a chance that maybe we see some reacceleration at the, or at least among higher income cohorts, whether it's, the reconciliation bill that was passed recently, or, there's potential for Fed cuts in 2026 or even the second half of this year. That's positive for risk assets. I remember back in April, there was concern about with the stock market having fallen so much that you'd see this negative wealth effect, and that would flow through into premium traffic demand. So I think you could see the reverse and see a positive flywheel effect from here.
Tom, how much do we see the airlines that cater to wealthier individuals doing better, and that's just going to be the path of travel going forward?
I think so, and I think if you look at their dominant share in positions or cities like New York or Los Angeles, it's not like these are easy markets to get in and out of, even though the assets, the planes are mobile. Getting into the right markets and having the right fleet to service the ideal demand, that takes years in advance, and it's like turning an aircraft carrier. United didn't get here overnight.
Tom Fitzgerald of TD Cowen, thank you so much for your time. I've got to say, I honestly, Danny, see some of these airlines and they're like, look at our premium offerings. It's amazing. You have seats that massage you while they go back and then paint your nails. And then don't look at the back of the cab because you know what, whatever, who cares?
I know, but they've got us all hooked on, I guess, the free manicures or whatever. So now when people travel, they're like, I need to pay up for it. I experienced the good life and I'm not going back.
Well, but it's just so interesting because you can tell a different story about the consumer if you look at Delta or if you look at Southwest. Delta, totally solid, coming back, business traveler coming back, people still looking for that front first class type of seat. But if you take a look at Southwest, it paints a very different picture of the American consumer.
It does, but I have to say, it feels like it is an industry that is so sensitive to consumers to the point where Delta talked about using AI in its pricing. And you got all these airlines pushing back. American Air, the executives came out saying, this is going to erode customer trust. It's a bait and switch if you use AI to do pricing. I mean, they were already doing dynamic pricing. I'm not sure how much it changes things, but you just get this sense that they are being so careful if it is a consumer being more picky now.
Yeah, I do want AI to give me therapy during travel, and I think that they're working on that. Coming up next, Alicia Levine of BNY Wealth, Krishna Guha of Evercore, Francisco Blanche of Bank of America, and Chen Zhao of Redfin. This is Bloomberg Surveillance.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
There is a nice confluence between the long-term investor and what we're trying to do. We have an operating principle that's in our handbook, take the long view. When we went public, we put a timeline up on the screen for the whole company in an all-hands meeting. And that timeline went from founding to 100 years out. And the IPO was one dot in 1 year on that timeline. And we tried to orient the employees to, this is a wonderful event, this IPO, but it's a moment in time on a very long journey.
This is a company that you want to exist in 100 years.
We do.
Wall Street doesn't think in...
No, they think in like hours. Yeah. And what I've learned of Wall Street, and particularly Wall Street investors, when they say they are long-term investors, that means they'll keep your stock for like a month. there has been one instance where I did something that was just for short-term stock, and I felt so bad about it that I don't think I'll do it again.
What was that?
There was one quarter, a few quarters ago, we were not going to beat the quarter. We were going to probably just hit it. And so far, we beat every quarter. So we were all like, wait, what? Our perfect record. We're like a 4.0 student that is going to get a B for the first time. This is not good. And I decided that for a short period of time, at the end of a lesson in our app, we would show 2 ads instead of 1. Turns out that that by itself was good enough to beat the quarter, but it's bad for the product. It's not good. After that, I never doing that again.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
The new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
We have yet to see the actual effect of tariffs.
15% is the new 10%, 10% is the new 0%.
It's still possible to believe that these tariff rates are still only going to be temporary.
Markets have correctly assessed the tariff situation as benign at the end of the day.
The bigger picture, I think, is the market's coming around to is less about the tariff and it's more about how the new era of globalization comes to fruition.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Heading into a massive week of earnings, 38% of the S&P 500 stocks inching up to new record highs for 4 straight consecutive sessions, and a big Fed rate decision with key economic data ahead. John and Anne-Marie are off today, but I am so happy to say Danny Berger is alongside me today. And Danny, it seems like people are looking past the noise with the Fed, as much as the hard hats are interesting. They're looking past the noise with tariffs and looking straight to corporate America that is ascendant.
82% of the companies we've heard so far have beat on earnings expectations. Yeah, a lot has been said about the bar being low, but in some ways, the bar isn't low. It's a stock at all-time highs. And we look at that and we get confidence. The confidence maybe just slightly kneecapped by the fact it's just inching up higher. 22 sessions so far without a gain or loss of more than 1%. That is the longest stretch since October of last year.
So next week, we've got 3 parts. We have the earnings part with Magnificent 7 coming out, a massive slate to just finish up what we heard from this week. We have the Fed decision on Wednesday. Watch Truth Social for President Donald Trump and his response to what likely will be a hold. And then we've got economic data. What are you watching most closely?
I want to see if this market reacts to economic data, because it's not reacting to trade disputes. It's reacting positively to earnings. That story seems to be continuing on. But if we start to see cracks, if we start to see signs that things like tariffs and lack of confidence is finally starting to hit, is that going to be the thing that jolts this market awake, that gets us to move up or down more than 1%? Because at the moment, things like an August 1st trade deadline really are not registering.
In some ways, people are looking more at the corporate earnings for some sort of sign of how the consumer is managing through some of these tariffs. And I find it fascinating to see an increasing divergence between what we see in Europe with the likes of Volkswagen and Puma versus what we see in the United States with the likes of Alphabet, as well as a host of other even retailers coming out with relative strength.
Yeah, a lot of strength, despite the fact people thought that maybe some consumers would start to pull back. But the unevenness, as we were just talking about, even is within industries. You see airlines, some doing better than others. Within the food and beverage space, you see Chipotle doing poorly, but then you see Domino's doing well. It's a lot of haves and have-nots right now, and it's a picture that's increasingly complicated that hopefully we'll get some sort of signal from as the next week progresses on.
Did you get the free burritos?
I didn't get the free burritos.
I heard that they had free burritos, free roast chicken, or
completely
fried
missed out on
chicken,
that.
They didn't really.
Food tastes better when it's free, so I'm upset I missed out.
Well, I think a lot of people did, and that's part of the problem. Right now, you're seeing markets fluctuate, although maybe going to head toward a fifth straight record close. We are seeing the S&P futures gain about 0.1%. Meanwhile, you do see yields higher across the world as central bankers maybe aren't going to cut rates as much as maybe President Trump would like. And you are seeing a little bit of dollar strength following better than expected data yesterday coming out of the jobs market. Coming up this hour, Alicia Levine of BNY Wealth following yet another record high. Krishna Guha of Evercore as President Trump visits the Fed with a hard hat, and Chen Zhao of Redfin on the softening U.S. housing market. We begin this hour with stocks on a 4-day winning streak. Alicia Levine of BNY Wealth writing, the pain trade is higher as the market shrugs off lingering tail risks on monetary policy and the labor market. Alicia, I am so pleased to say, joins us now. Alicia, great to see you as always. The pain trade higher despite the fact that they're the likes of Michael Hartnett of Bank of America warning about bubbles.
Yeah, no, look, I think it's true. I mean, it's not hard to go into a room of economists or bond traders who are extremely negative, and yet at the same time, we see markets marching higher. And I think that's because, you know, if you think about, let's go to the Wayback Machine of April 2nd to April 8th, the worst case scenario was pretty much priced in at over 3 trading days. We were down almost 20%, which essentially is telling you a recession is very close to happening. And to your point, the market has pretty much gone to sleep on the tariffs, whether it's 10% or 15%. And I think we're going to have to revisit that one day. But for now, we're in a place where whatever happens with the tariffs, whether it's August 1st or not, there's a lot of, you know, the sky is falling, but the market's not seeing it this way. And ultimately, the resilience of the U.S. corporate sector, which we're not going to call it American exceptionalism, we will call it American dominance. If you think about what's going on in the European earnings this morning, is just showing you that the earnings are coming through. So what do we see? Earnings came down dramatically April, May, and even to June for 2025, 2026. And then in the last month, we've seen a stabilization and a tick upward. And once those earnings expectations start ticking upward, it pulls the market higher. And this, because in the end, a price on the S&P is a multiple times earnings. We've done the multiple part. We went from 18 times to 22 times forward earnings as earnings fell, and now we're going to get higher earnings going into 26.
Is it American exceptionalism, or is it American dominance, or is it tech dominance? And that's why you're seeing the sort of division between the haves and the have-nots, even within the United States and the corporate world, with those who are actually implementing true technology solutions versus those that are a bit behind.
So I'd say it is about tech, and I think it's something to keep an eye on. The question of whether, you know, the CapEx spend, so Google spending another $10 billion on CapEx, et cetera, whether that goes into earnings and ROE, right? And that's the big question out there. I think for the market, that question must be answered in the positive. Otherwise, there is risk in the S&P here, because if you do communication services, tech, and let's even say financials, you're at 53% of the S&P. Those are growth. Those are highly growth, a very friendly market for financials as well. So yes, it is about tech. But we can't ignore it. We can't say, well, it's all about tech, so it doesn't matter. I mean, it does matter, right? And that's what's been driving the markets really for the last decade, the last 15 years, is that kind of dominance. The other parts of the world, when you look at other markets, you just don't have the same exposure to technology. And as a result, you're in a tech moment. It's the same trade as it was before COVID. It's the same trade as it was after COVID. We had a little pause, but it's the dominance of these companies. The free cash flow is what's driving their earnings.
Well, one of the interesting things for the tech, and Jason Thomas of Carlyle was on with Lisa and me moments ago, basically saying that these companies have changed. They're not asset light anymore. They're almost industrial players with the amount that they're spending. Just that very fact. Does it mean we need to value these companies different? Because part of their appeal had been that they were very asset light and maybe less exposed to things like rates.
It's actually a really interesting question. I think it's an interesting way of framing it. I don't think you're going to see that yet, but I think what you will probably see is the manufacturing PMI ticking upward as the investment in grid and the investment in energy power starts kicking in, because some of this CapEx is going towards that as well in order to sustain the output, which is AI and juicing, the rest of their businesses. So it's an interesting way of looking at it, but I think that this is going to also help the industrial economy. And don't forget, the multiples are lower than where they were. For most of these companies, the multiples are actually lower today than they were in January, particularly for a Google.
What does that mean for 2026 if you put that headwind together with the one big beautiful bill that gives tax benefits, but also the headwind for tariffs? Are the former enough to outweigh that to produce more growth?
So the number-wise, it is, right? And that's why actually I think it's going to be hard for a next administration to take the tariffs off, and something we actually all have to think about when we do our long-term views and our capital market assumptions going forward, because there is a lot of spend there. I think the excitement over some of the immediate expensing and the way CapEx is treated in the tax bill was not spoken about by corporate America because they needed the bill passed and didn't want to create a political football, if you know what I mean. But I think the results are actually very clear, and I think you're going to see a boom on the industrial side as it's also linked to energy power and growing out the grid. So you're going to have manufacturing and you're going to have grid. That's all industrial. Cyclicals are outperforming now. So it's actually really interesting.
This is way too positive. I'm putting on my tinfoil hat and going under the table and going back to what Michael Hartnett said and reading it over. Oh my goodness, this is a bubble, and this is going to be on the heels of fiscal largesse, the idea of governments pulling back on regulation, and you have the monetary pressure on the likes of Fed Chair Jay Powell with the hats coming on and going through the renovations and having a marital dispute. Bigger retail, bigger liquidity, bigger volatility, bigger bubble from Michael Hartnett. Why do you reject that?
It's not that I reject it. I think that there's enough resilience out there to get through it. The risks are real. I think the yield risk is very real. I think the issue of how clients and investors find protection in their portfolio is very real. That's a very real conversation that we're having. How do we hedge the risk with the bonds, and where do we go in the curve here in order to do that? That's very real. I think the conversations are not positive for the bond market. The current conversations that we're having, that's very real as well. I think the spending is difficult. Look, we've sat here and talked about it. The deficit and debt and the inability of Washington to deal with it is a very real thing. As an investor, though, it comes back to the same problem with what do I do with the 10-year, right? It comes back to the term premium, and we're frightened of it, and where do we invest? So the conversations about the macro all come back to the investing problem, right? And how do you build out a portfolio with that? And that's the task that we face. Like, how do we do that in a world where we know there's risk in inflation and we know that there's risk in bonds?
This is a fascinating discussion. Max Kettner really touched on this earlier this morning from HSBC, saying that they've found that gold is probably the best hedge, maybe the euro to some degree, but not necessarily going to those staple bonds. I just wonder if increasingly, and what I'm hearing from so many different investors is that stocks are safer bet than a lot of government bonds right now because of that prospect for growth, particularly if they're hedged to technological advancement. And bonds aren't going to protect you because the risks are just utterly different this time around.
So we think the risks are there, but we think there's value actually in the belly of the curve, the 5 to 7 year. So that's where we would go. I think the traditional go out to 10 years, that's a different conversation. And our clients are actually very sophisticated and understand this because they have businesses in the real economy and they understand borrowing and what it means. So we do that. We do think commodities are a good hedge here as well. Alternatives as well. I mean, this is where alternatives come into the portfolio as a way, non-correlated to stocks and bonds, to hedge some of those issues out there. In the end, when the entire world, and Bloomberg talks about hashtag Liz Truss moment, it's probably not going to happen because it's there, but it doesn't mean it's gone forever. And I think that some of the issues out there are clearly lurking. So we have to be aware of that, right? We have to be aware of that. I think we also have to be aware that the lower quartile of the income scale has been suffering with higher rates. That's very true. I think that's why you see the political pressure coming on. These are people who live short, right? They borrow short. And so they pay rent, they don't own homes, they don't have the benefits of financial assets, so that's something to be aware of as well. I mean, that is a risk too.
Alicia Levine, always a pleasure having you on the show. Thank you so much for being with us. Alicia Levine of BNY Wealth here this morning. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. We start with the check on Intel shares. They are down 8% in the pre-market as investors react to comments from CEO Lip-Bu Tan, who sparked concerns that he was more focused on cost cutting than restoring the chipmaker's technological edge. As for the scorecard's second quarter earnings missed analyst estimates, but they did give an upbeat third quarter sales forecast. Meanwhile, Paramount shares are rising 1.5% in the pre-market after the FCC approved its merger with Skydance. The decision ends a years-long saga that included settling a lawsuit with President Trump, as well as concessions on diversity initiatives and news judgment. And pro wrestling legend Hulk Hogan died yesterday following a series of medical issues. Hogan, whose real name was Terry Bollea, began his wrestling career in Florida in the 1970s and became a megastar in the 80s with the rise of the WWE Federation. He went on to star in the reality show Hogan Knows Best in 2005 with his wife and 2 kids. Hogan was 71. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, agree to disagree.
It looks like it's about 3.1 billion. It went up a little bit, or a lot. So the 2.7 is now 3.1.
I'm not aware of that.
Yeah, it just came out.
Yeah, I haven't heard that from anybody at the Fed.
Krishna Guha of Evercore joining us next. This is Bloomberg Surveillance.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Futures building on 4 straight days of gains. S&P futures marginally higher this morning, up 0.1%. NASDAQ futures were lower, just fluctuating here. And Russell 2000 up 0.2%. That optimism is being baked into bond markets as well. Yields higher as people ratchet back expectations for how much central bankers are going to have to cut rates ahead. Under surveillance this morning, agree to disagree.
We're just taking a look at what's happening. You know, it's a tough construction job. It looks like it's about 3.1 billion. It went up a little bit, or a lot. So the 2.7 is now 3.1.
I'm not aware of that.
Yeah, it just came out.
Yeah, I haven't heard that from anybody at the Fed. You're including the Martin renovation. You just added in a third building is what that is. That's a third building.
Well, no, but it's a building that's being built.
No, it was built 5 years ago.
It's part of the overall work. So, well, I'd love him to lower interest rates. Other than that, what can I tell you?
Here's the latest. President Donald Trump and Federal Reserve Chair Jay Powell disagreeing over the cost of the central bank's renovations. Trump continuing his call for lower interest rates ahead of the Fed's meeting next week. Bloomberg's Mike Shepard joins us now. Shep, how much are we seeing the sea change actually shift in the White House to seeing Jay Powell as something of an asset, a punching bag, if you will, ahead of what might be a volatile fall?
Well, it certainly is a sea change, Lisa, from when the president first appointed Jay Powell to the job all the way back in 2017. And he really hailed him as somebody who would be an excellent steward of the economy. Of course, that message has changed and evolved. Even during his first term as president, Donald Trump began questioning whether he had made the right choice, expressing misgivings over what he saw as Powell's reluctance to cut interest rates at the time. That tune has not really changed from Donald Trump, even in his second term. And what we've seen the president do is escalate that message publicly and in so many different fronts, too. This is part of his strategy of flooding the zone. Not only has he visited the Fed and really called the Fed chair out over interest rate policy, he's challenged the Fed chair over mundane matters like the renovation project on the Fed's headquarters, alleging that it is rife with cost overruns, and some of his allies and the president himself have wondered whether maybe that could be cause for removing him. It's come amid this call by the president for Powell and the central bank to cut interest rates. They're not expected to do so at the meeting coming up next week, but before year's end, we may see 2 cuts by the central bank when it comes to its benchmark lending rate. And Trump's pressure campaign works for the president on a couple of different levels. One, once the Fed actually acts and reduces interest rates, it gives him room to claim victory for doing so, for pressuring the Fed into acting. 2, it also sets the Fed up potentially to become a scapegoat. Should Trump's tariffs and debt-inducing tax cut law actually inflict some harm in the economy, the Fed could be set up perhaps as the fall guy in this case. And then third, it actually sends a message to whoever succeeds Jerome Powell as Fed chair. Remember, his term expires in May of next year, and the person who succeeds Powell in that job will have one mission, if you take it from the president's word himself. It will be to cut, baby, cut when it comes to interest rates, Lisa.
Mike Shepard of Bloomberg, thank you so much, as always. Joining us now to continue the conversation is Krishna Guha of Evercore. Krishna, how much does this really complicate the decision on Wednesday for the Federal Reserve and how they message it, considering that there'll be a real-time commentary coming from Truth Social?
Well, it certainly doesn't make their life easier. I think we already know that Waller and Bowman, both of whom were appointed by President Trump in his first term, are likely to dissent next week in favor of an immediate rate cut. That's not going to have any effect at all on what the Fed actually does. They will, of course, not cut rates next week. But it's a sign of the pressures on the FOMC. I think the question really is, of course, around the September meeting. At the end of the summer, will the Fed cut or not cut at that meeting? I think Trump is trying to build pressure to try to make sure that they do move ahead with a cut then. I think that is very likely penciled in as the base case plan, but it is in Powell's mind data dependent, depending on what they learn over the summer.
Krishna, it begs the question, if the next Fed chair that's appointed is someone who leans much more dovish, that wants to cut rates as Trump wants to cut rates, does it matter if that's already the direction of travel?
Well, sure it matters, because, the question is not simply, is the Fed cutting rates, but by how much? And is that cutting proportionate, reasonable, relative to what we're learning about the condition of the economy? If it is, market's going to be just fine with that. But if it looks like the next Fed chair is cutting a lot more aggressively than economic conditions warrant, then you're in trouble. That's when you'd see inflation expectations moving up. That's when you'd see yields moving higher, the yield curve steepening. All things, by the way, that I don't think the president actually wants to see.
Right. So firing Powell or trying to replace him with someone hyper-dovish would be counter to what this White House wants. Krishna, there are other methods, though, to change the makeup or at least change what the Fed does. In the 70s, we saw this, a mandate to include a dual mandate to focus on inflation alongside the labor market. This is a Congress that has been pushing Trump's bills through. Is this a risk? Because could they re-look at the Fed and try to make them and reshape them in a more populist image?
So I don't think we should rule anything out right now. Up to this point, though, the Congress, specifically the Senate, has taken quite a sober and traditional approach to the Fed. You have not seen, Senate majorities, trying to censure Powell or do anything else to undermine Fed independence. In fact, quite the opposite. You've seen a number of Republican as well as Democratic senators emphasizing that an independent Fed is in the national interest. And what I would say is if there were to be any reform of the Fed's mandate, the traditional Republican line is that you should get rid of the labor side, focus only on inflation. But that's exactly the opposite of what the president wants right now.
Krishna, does the president have a point, though, when it comes to lowering interest rates to benefit lower-income individuals in particular? And maybe this isn't something that the president has expressed, but a number of investors have, which is that the lower-income cohort is struggling. They're the ones that tend to borrow short when it comes to credit card bills, when it comes to auto loans, and they're less sort of benefited by the other aspects of the economy that are doing really well. What's your argument against that?
So I think it is a very fair observation, and to the extent that that's what's motivating the president, I would very much respect that concern for low-income folks. But here's the problem. The Fed sets one interest rate for the economy. It doesn't get to pick an interest rate for low-income people and an interest rate for high-income people, an interest rate for NVIDIA and an interest rate for the mom-and-pop store. It has to pick one interest rate that in aggregate balances supply and demand in the economy, keeps the economy in a position where underlying inflation is going to settle at 2% when the tariff shock is over. The labor market will stay in balance. It is always and everywhere the case that the interest rate that the Fed is maintaining will be a bit too high for some people, a bit too low for others. But the question is it the right one for the economy as a whole? Because they only get to pick one rate.
Krishna Guha of Evercore, thank you so much. Very much looking forward to the next time you come on. It's a really compelling point. And Danny, this is something that a lot of people have pointed to. How do you create a rate structure for an economy that's increasingly bifurcated?
It's a problem that we've been grappling with for some time. And it's the reason why people are talking about cuts, that sure, on a headline level, the labor market looks okay, but underneath the surface, there are real issues. The problem is that while that conversation is happening, stocks are at an all-time high. Corporate America is doing really well, and elsewhere, the data is holding up. So it is this dichotomy that makes you feel kind of insane talking about cuts right now.
Well, and it's not exactly as if the president is making this argument when he's wearing hard hats, talking about renovation costs, and then saying, you know, what you really could do for me is just lower interest rates. It doesn't feel like it's the same kind of cohesive economic argument.
No, it certainly doesn't, but it makes for a really great meme that I'm looking forward to it living on very long in many different forms.
All I can say is that President Trump is the ultimate producer. He creates incredible made-for-TV moments. Coming up, Yahaira Anand with your morning movers as meme stocks mania pushes American Eagle shares higher across the board, accounting for a greater and greater proportion of overall trading volume, even though they comprise just a tiny part of the overall market cap.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Looking for a 5th straight day of gains after 4 consecutive record highs at the close for U.S. equity markets. Continuing that feeling right now with futures, S&P futures up about 0.1%, Russell 2000 futures up 0.2%, and bond yields creeping just a touch higher, 2 hours away from the cash open. Here is your morning movers with Yahaira Anand. Yahaira.
Hi, Lisa. We start with American Eagle shares. They are up 1.3% as it becomes the latest name to catch some meme stock momentum. But this time, there's a real catalyst. The company just launched a new campaign with the ultra-popular actress Sydney Sweeney, and it has traders on Wall Street bets buzzing, especially because it has high short interest, which makes it a prime target for these traders. Next up, we have Coursera. Those shares are soaring, up nearly 30% now after a strong quarter. The company blew past revenue estimates in the second quarter, and that's thanks to booming demand for its courses around AI, not just for people like you and me who want to learn to code and learn AI, but also from enterprise customers who want to upskill their labor force. And take a look at Mattel shares. They are rising now 3%, but that is after plunging yesterday on bad results. The company behind Barbie saw sales in its dolls category fall 19%. I guess people really took seriously President Trump's comments that girls just need one doll instead of many. Anyway, Mattel also gave a cautious outlook, just showing you how investors are quick to punish companies that don't guide well. But as I said, a little bit of a give back this morning. Lisa.
Thank you so much, Yahaira. Right now on our radar this morning, President Trump downplaying his feud with Fed Chair Jay Powell after touring the central bank's renovation project, despite some moments of tension.
It looks like it's about 3.1 billion. It went up a little bit, or a lot. So the 2.7 is now 3.1.
I'm not aware of that.
Yeah, it just came out.
Yeah, I haven't heard that from anybody at the Fed. You're including the Martin renovation. You just added in a third building is what that is. That's a third building.
Well, no, but it's a building that's being built.
No, it was built 5 years ago.
Well, I'd love him to lower interest rates. But other than that, what can I tell you?
It just really doesn't get old, Danny, each time we watch it.
It is so excellent. I'm sorry. It is really hilarious. I know we're talking about really serious and threatening things like Fed independence, but you know what it kind of reminds me of? It's like when Trump was talking about that he was going to go tour Fort Knox and do an audit and make sure all the gold is there. There was so much noise about that. And then it kind of just petered off. I wonder if this is going to be the same thing, where he gets all this noise about auditing the Fed building. He goes face to face. They kind of have their marital spat. They figure it out, and then he moves on. He even put on Truth Social shortly afterwards that, it is what it is, and we can afford it. It's clear that Powell is his punching bag. He's been able to maintain him, and so maybe we kind of move on just to the occasional tweet, please lower interest rates.
I wish that they had toured Fort Knox and shown us all of the gold there, because that was actually something I was kind of interested in, just on an intellectual level. I do think it does have more import, though, and the idea that next week this does heighten some of the attention to the Fed meeting on Wednesday. Wednesday, when we will be getting a live blog, I'm sure, from the president, and they are likely to hold rates steady, not do what the president wants.
Well, also part of the problem is that now, even regardless of who becomes the Fed chair in 2026, the credibility is already being questioned before we even know who it is. So regardless of that person, are we going to judge inflation expectations that should be higher? Because we think it's someone who's going to come in and cut, again, regardless of who it is.
People's minds are spinning, and so they are just tuning this out. They're not tuning this out. The FCC approving Paramount's merger with Skydance. The chairman saying Skydance vowed to ensure that the new company's programming includes diverse viewpoints from across the political and ideological spectrum. A real question here about whether this is related to some of the recent programming changes and what this means going forward for both of these companies.
And what it means for corporate America, quite frankly, when it comes to things like M&A. Brendan Carr, the FCC chair, very clearly said that the reason that this was approved is because CBS and Skydance made commitments that they would have unbiased journalism and wouldn't establish DEI practices. This is a corporate America that hated Biden policies, that made it so difficult to get deals done. So there's ideological inconsistencies. It was an administration that came in and promised a more light regulatory touch. This isn't it if you're still demanding things from companies.
Yeah, and you really raise a great point. At what point are ideological questions and demands sort of the necessity that companies have to engage with in order to get some of these deals approved? Meanwhile, meme stock mania making a comeback. Traders targeting American Eagle, as we were hearing from Yahira, after the retailer announced a new campaign headlined by actress Sydney Sweeney. Shares of Open Door, GoPro, Krispy Kreme, and Kohl's also seeing a surge this week. All I can say is that pair of jeans and a picture of them, it seems to be the most profitable picture I've ever seen in my life.
I mean, it's like the bro thing has come back to life. One of Palantir executive put out on X a picture of like a Mad Men meme saying, oh, hear me out, Palantir should hire Sydney Sweeney to hawk their products. So it's this weird thing, and people are saying, it's 2021 again. But is it really? Because we don't have the stimulus checks circulating around and people in their basements with all this free time able to trade all these meme stocks. So I just wonder how long lasting it is. If it is long lasting, you get real concerns about the structure and leverage that comes along with some of these YOLO punts. But for now, it's just a little flare up. I think the concerning thing will be if it lasts longer.
I find it fascinating how sophisticated it is, looking at the short interest of particular companies and then saying, actually, we could squeeze this short out. And that's one of the things that people are examining to understand which will be the popular stocks on the Reddit talk chains. Meanwhile, turning to the economy, U.S. new home sales remaining weak in June, and sales of previously owned homes falling to a 9-month low, with buyers put off by higher prices and borrowing costs. Bloomberg's Michael McKee joining us now. Mike, a lot of people have pointed to the housing market as being anathema to all of the happy talk that we hear in the rest of the economy. What's going on here?
Well, you know, President Trump, as you mentioned, is arguing for lower interest rates, and it's a sentiment shared by realtors and home builders, even though that's not the entire problem. But mortgage rates are an issue. You mentioned existing home sales at a 9-month low. Actually, they're at a 3.93 million annual rate, and only one other time, 2023, did they finish below 4 million since the National Association of Realtors began tallying these numbers some time ago in 1999. So it is a real problem, and it is the problem that is supposed to be solved by lower interest rates. I was talking with Walt Schmidt, who's a mortgage strategist at FHN Financial, and he said we probably need to get down somewhere below 6%. Somewhere between 5 and 6% might be the magic number that gets people out of their houses. Because right now, everyone is holding on. We know what happened during the financial crisis and after, as the interest rates went to zero from the Fed. Mortgage rates went way, way down. Some people got mortgage rates that begin with a 2. Do you want a 2? You're not going to get it again. But you can see the effective mortgage rate, that's the white line there, is the rate that people are paying on average here for mortgages. And you can see what the rate is today in blue there, and that's the major difference between why we can't get anybody out to buy houses. But home builders will tell you it's not just that. It's also having the land and having the ability to build new homes. And at this point, they're not doing that either. New home side, there is a very low level of homes under construction. That's one of the worst situations that we have seen in 5 or more years. So right now we've got a combination of issues, interest rates being too high, zoning and other problems in cities, and just no houses being sold, and that's usually the area that responds the most to Fed rate cuts. So a lot of people with their fingers crossed besides the president.
Michael McKee, thank you so much. Great reporting as always. Let's continue the conversation. Chen Zhao of Redfin writing record high home prices and near all-time high monthly mortgage payments are causing many buyers to reconsider their purchases. Chen joins us now. And Chen, you wrote that in June alone, just over 57,000 home sale agreements nationwide were canceled. How does this pair with the stories of strength and economic resilience that we keep hearing about?
Yes, thanks so much for having me today, Lisa. So what Redfin found in our data is that in June, about 15% of the signed contracts for buying a home were canceled. And this is a little bit higher than what we saw last year when it was around 14%. And also the previous year, and which is also an increase from the years past. So we've kind of been gradually seeing this proportion tick up. And what's really interesting is that that's just a national average. If you look in certain markets, especially in the Sun Belt or in Florida in particular, that proportion is actually closer to 20%. So when we talk to our agents, what we're finding out is that this is really predominantly because of two reasons. One is that, consumers are a little bit nervous. There's been a lot of economic turmoil these past few months, and even though consumer sentiment has sort of bounced back from those troughs, it's still quite a bit lower than where it was last year. So people are nervous. And then the second reason is really just that if you look across the country right now, most of the country is in a buyer's market. The housing market has really shifted. So last month, Redfin, we used some of our proprietary data to release a new metric on how many active home buyers there are out there. And what we found is that right now, there's about 34% more home buyers than home sellers. And you really have to go back into the aftermath of the financial crisis to see a proportion that high. So right now, what does that tell us about home buyers? It tells us that people have a lot more choice. So what we're hearing from some of our agents is that, you have a nervous consumer, but they also have a lot more power than they've had over the last few years in the housing market. And when a better home comes along, sometimes they're backing out.
Why are prices still high then? You'd figure that in that sort of scenario where it's a buyer's market, home sales are hitting 17-year lows, that it would be a market that would, I guess, work properly and bring down prices with it.
So we are actually seeing that right now. So we do see that home price growth is slowing down. So if you rewind back to the beginning of the year, home prices were growing probably 5-6% year over year. Right now, it's down closer to about 1 or 2%, and you're seeing that momentum continue. So I mentioned that metric about the ratio of the number of buyers to sellers in the housing market, and what we've seen is that if you look at that and then you compare that to price growth, it actually leads home price growth by about 3 to 6 months in a very reliable way. So what we can say is that we really expect that by the end of this year, home prices are probably going to be pretty flat. And they might even be slightly negative year over year. And that is really important for home buyers because, incomes are continuing to increase about 4% a year, right? Inflation is about 3%. So in that environment, when nominal home prices are flat or maybe slightly declining -1%, that means that even when mortgage rates are staying pretty high, buyers are getting a little bit of a break on affordability.
So how much do mortgage rates have to come down to boost prices again, to get activity back in the flow and to get builders back on the front lines?
So I think that mortgage rates is one part of this equation, right? We are definitely not expecting mortgage rates to come down into those 3s or 4s again. It is possible that I think in the more medium term, you might see mortgage rates coming down into the 5s, maybe the mid or high 5s. And if that is the case, I think after 3 years where you've seen mortgage rates close to 7%, that will feel like a significant break. And that emotional part is actually pretty important for a lot of home buyers. But it's not just mortgage rates, it's also home prices, right? Because buyers are focused on what is my mortgage payment. So I think if you have mortgage rates coming down a little bit, and then at the same time you get that price easing that I'm talking about, that could really start to spur some activity in the housing market.
Chen Zhao of Redfin, thank you so much for being with us. Chen Zhao there, who runs her economics team looking at the housing market. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahaira Anand. Yahaira.
Hi, Lisa. Alphabet's Google has sealed a $1 billion deal to provide cloud computing services to software firm ServiceNow. Sources telling us here at Bloomberg, ServiceNow committed to spending $1.2 billion over 5 years as part of the agreement. Earlier this year, Google also added OpenAI as a customer and secured a $2.5 billion commitment from Salesforce. Meanwhile, federal officials are considering putting a lien on Harvard's property over allegations of mishandling of anti-Semitism on campus. The proposal was included in a memo revealed in last week's court filing. So far, no lien has been filed with authorities. The White House would not say whether it dismissed the idea of that lien. And a development in the Coldplay Kiss Cam saga. Astronomer HR Chief Kristen Cabot has resigned just days after the CEO, Andy Byron, stepped down. The company announced it launched a formal investigation into the scandal that placed both on leave. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. The memes, of course, live on. Up next, the president's push for cheaper crude.
We're #1 in the world in oil, and we're drilling, and today it hit $64 a barrel, which is great. And that'll help stop wars, actually, if you want to know the truth.
Francisco Blanche of Bank of America joins next.
AI should be for everybody, from leaders to the working on floor. And we can save 90% of time, 50% of workforce. AI is core in centers of change. And therefore, we invest heavily to AI. Actually, we started more than 10 years ago because we think the machine in the past helped our hand and legs. Now the machine helps us in brain.
Are you betting all your money in this right now?
When the OpenAI appeared, immediately I asked whole corporations study how will you bring generative AI to their job.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Bringing you up-to-the-minute energy news whenever and wherever it happens. I'm Joanna Bersecci in Vienna, and this is Bloomberg.
You can't stop the optimism. It just keeps getting filtered into markets in this slow grind higher in a July that has slowed down quite a bit. Right now, you're seeing just that marginal grind higher in S&P futures ahead of a massive week next week. 38% of that index market cap will be reporting earnings. Under surveillance this morning, the president's push for cheaper crude.
You know, we have the most oil of any country in the world. We're #1 in the world in oil, and we're drilling, and today it hit $64 a barrel, which is great, and that'll help stop wars, actually. If you want to know the truth, it's going to help stop wars. And we hope to get it down a little bit more. It's one of the reasons that inflation's in check.
And that's certainly something a lot of people have been commenting on. Here's the latest. President Donald Trump keeping up the pressure on oil producers to maintain lower energy prices. Francisco Blanche of Bank of America writing this. We project Brent and WTI to average $67 and $64 a barrel, respectively, in 2025. Francisco joins us now. And I guess that you could ask, why are prices not lower, considering all of the supply that we see coming out of the Middle East and this push for drill, baby, drill in the United States?
Thanks for having me, Alyssa, once again. Yeah, you know, it's funny, right? So we're getting a weaker dollar, we're getting slightly lower oil, potentially lower rates at some point, right? It's all going according to plan. I do think one of the issues that has been supporting oil has been the seasonal strength of the summer months. But as we go into the second half of the year, we are going to likely see lower prices, and that's because inventories are most likely to build outside of China. Remember, in the second quarter, we had a surplus, but 97% of those barrels were stored in Chinese strategic reserves. And can you blame them after all the volatility we've seen in the Middle East, Russia, Ukraine? So the Chinese are acutely aware of the geopolitics and the fact that they're the biggest oil importer in the world. So 12 million barrels a day. So they have a huge exposure, whether it's the Strait of Hormuz or Malacca. They still rely heavily on oil despite all the electric vehicles that they keep pushing into their market. So I think that's been part of the story. My sense is they'll keep building inventories, but they almost have 40% of all oil stocks globally at this point, crude oil stocks, that is, right? So I do think second half of the year, the surplus is going to be close to 200 million barrels. And eventually we're going to spill out from Chinese inventories into the Atlantic Basin, into the US and Europe. And that's what's going to allow prices to come off. How much are we going to come off will depend on how much OPEC Plus keeps pushing barrels out. Because we've seen the rig count in the US is already coming down, is down 15%. So my sense is that we'll see lower prices, but not necessarily prices crashing.
Given the geopolitics and given the supply-demand dynamics that we were just talking about, how divorced is the price of oil from an economic cycle that seems to hinge on a new industrial revolution that 10 years ago would have included a huge use of oil?
Yeah, this is a very, very good point. And when you think about the energy demand we're seeing today, it's in some places in the U.S. is astronomical. I mean, Texan power demand is up 5.5% year on year. I mean, you can barely find an emerging market that's growing at that pace, right? I mean, this is like insane. So I think if you look at the next few months, the majority of the demand, and probably the next 2-3 years, the majority of the demand for energy is going to be still renewables, also natural gas, which is what makes us relatively constructive on Henry Hub, and even into the summer on TTF, European gas. But for oil, it's not going to touch it immediately. It's going to take a little longer. I'm not even sure, oil is a transportation fuel for the most part. So it's kind of left by the wayside in this AI revolution for more energy at this stage. Maybe later on it may not, but for now it is.
Can you talk about that later on point? What could it eventually look like?
Well, I mean, I think if you look 5 years out, the demand growth rates we're seeing for energy, they're going to be pretty hard to meet. And remember how we've evolved 2 years ago. The big tech companies were looking for clean sources of power. They're like, oh, we just want to use super clean power and then, renewables and this and that. And then they said, well, maybe renewables and nuclear. And now it's like renewables, nuclear. Now it's like, oh, just give me any power you can find because we really need a lot of power. I mean, we need, so there's talks about building 10, 15 gigs of power in Pennsylvania. There's you have the eastern border is going to need a lot of power. Texas already, growing beyond belief, and even other parts of the U.S. where you have these data centers, Pacific Northwest, you're going to have a lot of growth. And then eventually Europe as well. And the U.S. has a capacity problem. The U.S. needs to build those power plants. Europe, because it's destroyed its energy consumption in the last couple of years as a result of Russia-Ukraine, actually it does have the capacity. So it's going to be an interesting balancing act in the next 2-3 years for power too.
Well, just on that point, we finally have a ban on Russian imports coming into effect for Europe. And Total Energies, one of the biggest energy players in Europe, was saying, look, we have a tightening diesel market because of this. Right. How played out is this? Is there going to be more stress and tension in the market and tightening of supplies as the ban really starts to come into force?
There could be, certainly. And you also have to ask yourself, okay, so there's this ban on secondary resale, because the issue is, of course, Europe doesn't want to buy diesel that has come from originally Russian crude oil, which, as we know, is going mostly into India, but also into China, right? So Europe's been buying oil from refiners that actually do purchase Russian crude, and that's been one of the issues. But Europe still purchases 15% of its gas directly from Russia, right? So that goes for Belgium and France and Spain and Italy, and does it make its way into Germany too? So Europe is trying to really cut its dependency on Russia, but it's a tough thing to do because, again, only 3 years ago, or 3.5 years ago, 50% of European energy, oil, gas, and coal, came from Russia. So they're trying to do it progressively, and in the process, it's not been helping European industry, but that's kind of, I guess, part of the price that Europe is ready to pay.
Francisco, before we let you go, I'd love a comment on gold, excuse me, the solid gold, the solid oil that we've seen in terms of just how people are treating it. We've seen prices double since 2022 to more than $3,000 an ounce. And I just wonder how much higher you see it going as you hear an increasing amount of people point this out as the haven asset, as there are real questions around fiat currency.
Right, so we have to be clear, just like we are bearish on oil and we're constructive on gas because of the power story, we are bullish on gold as well. We think gold is eventually going to get around 4,000 over the next per ounce over the next 12 months. Having said that, gold needs more investor demand. The story has been mainly a central bank story, and of course, there was a nice tour yesterday of the Fed building. We saw that, right? So. The pressure is on for the Fed to cut rates, and obviously people are going to question independence, and one of the beneficiaries of that questioning is going to be the gold market, right? So to what extent this this pressure builds on the Fed, political pressure, I think that's what will ultimately trigger a higher price for gold. But remember, jewelry demand for gold is down 20% year on year. So the real beneficiaries year to date of the gold upside pressure have been the other metals, the other precious metals like silver and platinum and palladium. So gold is doing well. It's still picking up momentum, but it's already a $20+ trillion market, right? There's $20+ trillion worth of gold out there. Remember, U.S. Treasury is in the hand of the public. 20 trillion or so, right? In the U.S. public. Now you have the foreigners, which own another 9 trillion. But gold's gotten very big, and to get another leg up, you need lower rates. When this happens, and particularly if those lower rates come on the back of political pressure, I think gold will get another leg wind.
All I can say is we saw a tour of the Fed. I would have loved to see a tour of Fort Knox. That's all I can say.
That's where they should meet next time,
exactly.
Powell and Trump at Fort Knox.
I would like to see that tour. Francisco Blanch of Bank of America, thank you so much.
All right,
great to see you, as always. Coming up in the next hour, David Stubbs of Alpha Core, Brian Vaccaro of Raymond James, Greg Dacko of EY, and Vishal Kanduja of Morgan Stanley. This is Bloomberg.
How much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico. This way or that way, it will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates and complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
Now we're playing. Yep, now we're playing. First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5. Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Alberta, Canada, and this is Bloomberg.
I think we've had a great run. I think investors should feel good about that.
The AI theme has kicked back in.
The AI bullishness is there. I don't think that has changed.
Overall, these foundational supports are what's driving markets.
I do think investors do need to prepare for what could feel like a very different second half.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. 90 minutes until the start of trading, grinding upward ahead of a massive week of earnings, with 38% of the S&P set to report next week. A big week for the Fed as well. Central bankers preparing to hold rates steady despite pressure from the White House. And of course, all eyes on the jobs data to end the week. Danny Berger in John and AMH are off today. Danny, it is wonderful to have you. Can we make it day 5 straight consecutive days of new record highs in the S&P.
Considering this is a market that is, not paying attention to anything or doesn't care about anything, sure, why not? And the fact that earnings have held up, it's reminiscent of where we were to start this year. Expectations that M&A is going to get better, hitting all-time highs, even meme stocks are back. It's led to some to say, like Michael Hartnett, that it's the makings of a bubble, something that Max Kettner at HSBC said, what bubble? Fundamentals are good, we can keep going higher.
Well, let's dig into that. Michael Hartnett making the argument that if you have governments that are deregulating some of the investment landscape for particularly retail investors, and you have central banks that are dropping rates, even though there is this strength in the economy, you are going to get those animal spirits that can get over their skis. A lot of people not really seeing this as the case, and frankly, one of the things that's interesting is people have been ratcheting back their expectations for how much central bankers around the world are going to cut rates rates because of the strength that we're seeing in the economy.
I think that's so important because one of Hartnett's tenets is this idea that it is global central banks that are pushing back, that are starting to cut rates and allowing these things to go on as spending continues in governments. What happens if we get more of what we got from the ECB, saying we're in a good place, we don't need to continue to cut? Does that mean that for all these fears of a bubble, they're just not there if it are central banks that are starting to pause?
Well, right now we're looking at the potential for also a Fed chair to have a pretty awkward Fed meeting next week, especially after the image that we have replayed on repeat, just simply because it was made for playing on repeat, which is the hard hats, et cetera. On Wednesday, we do get that Fed decision where central bankers are largely expected to remain on hold. How fraught will that become, given some of what we heard just yesterday?
I was going to say, sometimes Powell gets up there at a press conference and looks kind of uncomfortable. I think I'm going to retract ever saying he looked uncomfortable, because we saw what it actually looked like to see Powell uncomfortable, kind of chuckling off some of the comments from Trump. But maybe that face-to-face interaction had the net impact of taking some of the heat off, that they just needed to get in a room together, hash it out, put on their hard hats, take off their hard hats. But it's the unavoidable. The Fed chairmanship comes up, and next year, that's going to be the real point of concern. Who comes in next? Is it someone that is going to listen to Trump more acutely and really start to cut rates more than they otherwise would have?
Right now, the market is closing their ears, and they are just saying what we are watching is the earnings, at least when you take a look at the equity markets, the investment that you potentially see coming in from the AI boom. We're seeing S&P futures retrace some of the earlier gains, but still positive, up about less than 0.1%. You're seeing a bit of dollar strength after yesterday's jobless claims came in less than expected, a little bit grind higher in terms of yields, although not that dramatic. Coming up this hour, David Stubbs of AlphaCore following a fresh record high. Brian Vaccaro of Raymond James after Chipotle cut its forecast yet again despite those free burritos. And Greg Dako of EY with the labor market on solid footing, at least for now. We begin this hour with stocks steady after hitting a fresh record high on AI optimism. David Stubbs of AlphaCore writing this: short-term caution given where markets have run to, seasonally weak and thin August markets await. David joins us now. And David, you are probably the first person that we've had on this show this morning that has sounded a note of caution. So congratulations. What kind of response do you get from clients when you say, hold on a second, this has run pretty far, maybe it's time to take a break?
Well, good morning, Lisa. Great to be with you. I think we're just observing, obviously, a pretty frothy set of markets right now. You've covered how many record highs we've hit. The meme stocks are back. And you have the combination of high valuations, low volatility, and very tight spreads across credit as well. And market's just in a particularly joyous place right now going into August, and we all know that liquidity tends to be thin in August. Accidents do happen in August. So look, at AlphaCore, we're not particularly tactical. We're not de-risking notably around this. But just looking at the setup and watching your show all week and how many people have talked about the extraordinary things we're seeing in some of the equity markets, you have to wonder, are we going to see some volatility ahead in the next couple of months? Certainly plenty of triggers for that await us.
Do you have to care about the volatility if ultimately the path is upward? I mean, I guess we hear about people coming on the show and they'll say, yeah, we've got volatility ahead. August tends to be a rocky month and we're going to be in there buying that dip. I mean, can you get very enthusiastic about a dip that you have 15 buyers lined up to buy?
Yeah, absolutely. I think you always have to care about volatility. A lot of wealth management clients will get scared when there's a drawdown. And I think we think about that by incorporating alternatives and private markets at the core of portfolios from the start, always and forever, as it were. And also utilizing alternative strategies, things like uncorrelated managers, to reduce drawdowns in most scenarios, build structurally resilient portfolios. And I think that's our focus. And I think that when you look at a collection of opportunities we see over the next few years, there's a lot to like about the technological innovation we've just had. Obviously a lot of fiscal support. There's a deregulatory impulse in the United States right now as well. Over the medium term, that keeps us invested. But you have to recognize how far we've come at the moment. So I don't think we'd be piling on extra risk here. But I do think we see a collection of themes playing out over the medium term that we want clients to have exposure to. We'll just pair some exposure in liquid markets, great public equities are a great asset class, with those in private markets as well.
David, one of the issues you write about that suggests that positioning is getting stretched is this idea that defenses are getting crushed relative to cyclicals. We were talking with Alicia Levine of BNY Wealth earlier, who said that part of the reason that cyclicals are doing well is because of the massive capital expenditure spend that's coming from some of the hyperscalers, that's inducing more industrials to outperform. Is that not a theme that could endure, or is it really a sign that things are getting stretched here?
Well, I think it's a very enduring theme, but we all know that equity markets can price things in aggressively, and they've come quite a way already. I think that the CapEx AI theme is not just a narrative for the equity market, it's a narrative for the economy. I mean, if you look at the Secretary Bessent's tweet from earlier in the week, talking about the strength of capital expenditures, up around 17% annualized, I believe, in the first half of the year. Look at the data center energy nexus that's at the heart of many thematic investors right now, and we're believers of that in the medium term, for sure. I think the huge question that awaits all analysts is how long does this run, and then how do you pivot your AI investments away from capital expenditures towards the rest of the supply chain, and indeed towards AI. When does that happen? I think it's still years away, don't get me wrong. But I would give one example of positioning where we're trying to take a broader approach than just buying these massive AI plays. We're actually long an active growth manager right now in our equity holdings. Instead of being long the NASDAQ on its own, we're hoping that active managers in the growth theme will not go after the obvious AI plays, but will find some AI adjacent stocks as well as the theme continues to mature. So we're very optimistic about that. We like to play it both through public markets and private markets, as always. But there's just one measure of positioning that we see at the moment, cyclicals versus defensive, and it's come a long way.
David Stubbs of Alcor, thank you so much for being with us. That was David Stubbs there talking about why, even though they do see volatility ahead, they are still optimistic. I think this is an interesting discussion, the idea of private markets and what role they're going to play in the whole AI infrastructure build out, and this argument that it isn't just about taking less risk, it's about another way of investing in infrastructure that has maybe a different maturity profile.
Well, it also becomes a self-fulfilling prophecy if you say private markets offer a better diversification right now, because what we've seen is that private companies are staying private for longer, that public equities are shrinking. I think over the past 5 decades, number of public companies have shrunk by half. So what happens if it's an investor base right now that starts turning to private markets, that for retirement funds, they start turning to private markets? If more capital goes there, does that mean less public companies? And if there are less public companies, does that mean less robust indexes and exchanges? So it could have this snowball effect. And I think it's just something to keep an eye on as more and more people start saying, for our clients, we want them to look at alternatives.
Right now, let's get you an update on other alternative stories this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. Here's an alternative story. President Trump put on a hard hat and toured the renovations at the Federal Reserve with Chair Powell. And as we've been playing all morning, there was a tense moment when the president claimed the price tag had jumped from $2.5 to over $3 billion. In response, Powell said Trump's claim included a building that had already been completed 5 years ago. Meanwhile, Alphabet's Google has sealed a $1 billion deal to provide cloud computing services to software firm ServiceNow. Sources telling us here at Bloomberg, ServiceNow committed to spending $1.2 billion over 5 years as part of the agreement. Earlier this year, Google also added OpenAI as a customer and secured a $2.5 billion commitment from Salesforce. And the Trump administration is suing New York City over its sanctuary city policies. The laws at issue prevent law enforcement from honoring a civil immigration detainer without a warrant. Mayor Eric Adams responded saying the laws go too far and need to be re-examined. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, the morning calls, plus Brian Vaccaro of Raymond James with Chipotle cutting its forecast again. We'll get into the nitty-gritty of free burritos and free chicken and why that wasn't enough to stem some of the weakness that we're seeing in Chipotle Mexican Grill. This is Bloomberg Surveillance.
of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
I have real trouble, both with weakness in the labor market and with a more hawkish Fed, that really changes the picture. Because once again, it's the growth, it's the earnings picture that is really, really solid. And that really, I think that really puts into question that notion of this being a bubble. I think the rally can stay for at least through the summer.
That was Max Kettner of HSBC getting triggered by the concept of a bubble and saying absolutely not. Right now, it is, we're looking at markets that are climbing after 4 consecutive days of record highs. S&P futures up just about 5 basis points. And really a question here about whether we can make it day 5 of new record highs, just with marginal gains every day inching higher for the 5th consecutive day. Time now for the morning calls. First up, Jefferies raising Union Pacific to buy, noting its potential tie-up with Norfolk Southern could be transformational. Those shares up about 0.5%. Next up, Loop Capital downgrading Ulta Beauty to hold, saying its bullish outlook is largely priced in after the fad for 10-year-old girls tends to wane. Those shares lower by about 1.4%. And finally, Bank of America raising its price target on American Airlines to $13, noting slightly better unit and revenue costs. Those shares higher by about 0.6% after having a difficult session yesterday. The earnings not giving the same type of optimism as we heard from Delta and United. Sticking with the consumer, Chipotle falling the most in 5 years after cutting its annual outlook for the second time this year. The company saying its honey chicken launch and burrito giveaways weren't enough to offset a slump in traffic. The story you've been wanting to hear about all morning. Michael Halen, Bloomberg Intelligence senior restaurant analyst, joins us now. What went wrong? Free burritos, honey chicken. What exactly has been the problem right now for Chipotle?
Yeah, you know what? They didn't really give us much color on this call about that. You know, it was a weird call. You know, I didn't think it was a very good one for the management team. It was heavy on excuses, very light on details. You know, they mentioned that honey chicken did really well. So a -4% same-store sales comp indicates their base business is declining pretty rapidly, right? And they said there were no missteps, but in the first quarter call, they said the stores were dirty and the hospitality was poor. So which one is it, right? And when you underperform the index, the black box index, which we use, by 430 basis points, I mean, it sounds like there were some significant missteps here. You know, we suspect value is an issue. You know, they've been investing in larger portion size to address that over the last year. But then at the same time on the call, they say that, you know, we think we provide good value. So honestly, it was a pretty confusing call. I think investors really, you know, have doubts now about their ability to get back to that mid-single digit same-store sales growth.
Michael, I was listening to the same thing on the call when they basically said, we think we provide value, that we're not going to offer something that looks cheaper. We just need to do a better job of communicating the fact that we provide value for the consumer. Is that the right tactic that Chipotle should be taking?
You know, it's hard to say. I mean, a lot of things have to be going wrong when you're doing a -4 same-store sales comp, right? Especially in a restaurant environment, that's not that bad. You know, fast casual same-store sales were up, you know, not a lot, but they were up, you know, 30 basis points in the quarter, right? So if you're underperforming by that much, there's a lot of things going on. On the first, like I said, on that first quarter call, they talked about some operational issues. That's typically where you start to see some slippage, right, is on the operations, and CEO Scott Boatwright was the former chief operating officer, right? So I think nailing those operations probably is the first piece. And in terms of the value, you know, we're not sure. You know, maybe they need to make another investment in the portion sizes, right? Some of the companies that we cover that offer the most food for what you pay tend to outperform. So think Texas Roadhouse, Wingstop, Darden. These companies have the highest food costs of all the companies we cover. People recognize that. They recognize the value that they get for their dollar, and it lifts traffic.
Michael Halen of Bloomberg Intelligence, thank you so much for being with us, and I look forward to parsing through all of the different restaurants and fast casual dining that we all know and love. Joining us now, Brian Vaccaro of Raymond James, which has an outperform rating on and $60 price target on Chipotle. He joins us now. Brian, thank you so much for being with us. I want to start with what we were just hearing from Michael Halen, who was not impressed by the call, and take a step back and just say, how much are you seeing differences in execution during this earnings season between the haves of the fast casual restaurant chains and the have-nots?
Yeah, thanks, and good morning. Nice to see you. I think what I would say is to start would be we need to maintain perspective here. We need to maintain some perspective of how strong Chipotle has been over the last few years, and especially last year in the second quarter. So when you see the down 4% comp, we do need to maintain perspective that they were up against an up 11% last year, which included the month of April up in the high teens. And so this is a business that in some ways caught lightning in a bottle in April with the second year of the return of Chicken Al Pastor. That was a huge hit last year. So the two-year run rates are much less concerning in our view, though it does seem that they have seen a moderating in trends that we need to get a better assessment of and a better understanding of. And I think over time you'll see that. When you see businesses, I'll say this to the general comment, when you see businesses that go from explosive growth and outperformance to a little bit of outperformance, there's always a lot of contributing factors to that to keep in mind. And one of the things that we've talked to them offline about and been asking about is some of their internal guest satisfaction and operational scores. And those metrics continue to show strength. Yes, they had the portion size issue last year, which they addressed in a cohort of their stores, 10 or 15% of their stores, I believe. But I do not believe that they have a value proposition issue at all. In my local market, it is $9.50 for the Chipotle chicken bowl or burrito. And in many of the quick service restaurants or in the area, those value meals start in the $10 to $10.50 range.
Yeah.
So I think from an absolute price point perspective, Chipotle continues to have a very strong value proposition.
What I'm struck by, Brian, is the conversation we're not having this morning. We're talking about Chicken Al Pastor, and we're talking about $9 chicken burrito bowls, but we're not talking about consumers that are pulling back wholesale or any kind of macro problems that these companies are facing. Is that really an accurate portrayal of the landscape, that that the consumer is solid, that any kind of supply chain disruptions are manageable, and that really this comes down to when you roll out your Chicken Al Pastor?
Well, I think so far we have two companies under our belt so far in Q2 earnings season, and we're seeing results that point to a mixed and choppy consumer backdrop with some clear differences between the lower and middle upper income consumer in our view. You know, at a high level, I think the lower income consumer seems to be under pressure. We're expecting to see that in softer sales results for most quick service restaurants this earnings season. And on the flip side, the middle and upper income consumer seems to be doing okay. And we've actually seen some stronger sales trends within the casual dining sector, which we haven't seen in many years. That would be the sit-down category of restaurants like Olive Garden, Chili's, and Texas Roadhouse. those brands, that sector underperformed meaningfully in 23 and 24. And we're seeing that snap back here with casual dining comps that were up about 4% year on year in the second quarter. It does seem that the jobs and income backdrop remains pretty supportive in the aggregate, but the big swings in consumer sentiment are likely weighing and contributing to the choppiness and at times have created a few air pockets through the first half. And we talked about Chipotle on this week's call. They did notice they saw some softness in May, and they attributed that to the big decline in sentiment that we saw more broadly. And obviously that was following the big market pullback in April as well.
Brian Vaccaro of Raymond James, thank you so much for being with us. Right now, we want to shift gears back to the Federal Reserve, responding right now to the visit between President Trump and Chair Powell yesterday. Bloomberg's Michael McKee joins us now. Mike, what's the latest?
It was apparently quite the honorable meeting. The president yesterday posted that he was honored to tour the Fed. The Fed today saying they were honored to have him. In a tweet just posted on social media, the Federal Reserve says they were honored to welcome the president yesterday for a visit to our historic headquarters. We appreciated the opportunity to share progress on the renovation with him and with Senators Tim Scott and Tom Tillis. They're grateful for the president's encouragement to complete this project, and they say they remain committed to continuing to be careful stewards of these resources as we see the project through to completion. Now, this has been sort of a hallmark of the Powell Fed in the Trump years. The president can say whatever he wants, and the Fed either doesn't say anything or responds in a very nice manner. They don't seem to want to pick a fight with the president, other than Powell saying he would not resign. So maybe this brings an end to some of the squirrel aspects of this whole Fed renovation issue. We may not see quite as many tweets on that from the president, and certainly not from the Fed, but I'm sure if the Fed does not cut rates next week, we'll hear from Mr. Trump again.
I'm sure that we will. Michael McKee, stay close. We're going to come back to you in just a minute, and it is amazing how much we have been shrugging this off, because it is a very made-for-TV moment, which is what President Trump does very well, but it does raise a question about this sort of blanket approach to get the Fed to lower rates ahead of next week's Fed meeting.
Right. It's everything kind of thrown at the Fed at this moment, from issues about the construction of this to are they getting things wrong because housing prices are still high and mortgages need to come down. It's something that's been difficult for the Fed to try to respond to, and they've been trying to respond to it in bits, from posting blog posts saying here's why the building overruns aren't that big of an issue, to trying to justify why rates stand where they are. It's something that Powell's going to have to deal with next week. It is real political pressure, but if anything, a lot of comments have been made how that pressure has made Powell more steadfast. That's made him less likely to cut, because he wants to be remembered as a Fed chair that stood up to that political pressure.
Watch the dissent. That's what people are saying. You're going to see maybe Chris Waller, maybe Mickey Bowman, both saying, well, maybe we should have cut. Coming up, we're going to discuss that and more. Greg Dako of EY with the labor market on solid footing. Plus, Yahira Anand with your morning movers as Intel slides with concerns around that turnaround plan. This is Bloomberg Surveillance.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Looking to make it day 5 of record highs at the close, just inching higher. And it is remarkable, as Danny was mentioning earlier, just how little activity there is behind each day of a record high. Right now, S&P futures up by 0.1%. Russell 2000 futures up about 0.3%. In the bond market, a little bit of a lift in yields, priced down after what we saw yesterday from the ECB when they came out and seemed to indicate they weren't going to necessarily cut rates again anytime soon. You're seeing this across the board. It's across the curve, but nothing particularly dramatic. And then when you bleed it out through the currency space, a bit of dollar strength, especially on the heels of some economic data that came out yesterday, jobless claims. With the right kind of downside surprise, you're seeing euro dollar 117.25. Still the calls coming from the likes of George Saravellos of much more euro strength ahead. Economic data has been very much in the forefront, crossing right now ahead of a busy schedule next week. Bloomberg's Mike McKee joins us now.
We have durable goods orders out, and they are down 9.3% after rising 16.5% last month. Now, when you have a swing that big, it's usually because of Boeing and the timing of their orders. I'll check that out for you. Ex-transportation, durable goods up 0.2, also underlining that idea. Capital goods orders leaving out non-defense aircraft were down 0.7, though. That's the part that goes into the GDP numbers, and so that's a little bit worrisome. They were up 1.7% the month before. We will have to see what the problem is there. The Fed is going to be worried about a slowdown, of course. One of the questions about business spending has been, did companies just load up on inventory and spend it down and not put in new orders waiting to see what the consumer is going to do? This will be a discussion point for the Fed next week, but they are not expected, as you have been saying all day, to do anything, not to cut rates at all. What we're going to be looking for is whether or not the Fed is going to see dissents from 2 governors for the first time ever. And the markets are going to be also watching for future cut guidance. There's a lot of feeling they might set us up for a September cut. Looking at durable goods, looking at what we get in terms of jobs next week and saying, well, maybe we're seeing some signs of this or that we want to move on. And I think we can predict that no matter what, Donald Trump is going to be unhappy and will tweet about it either way. We have seen some inflation in the last couple of CPI and PCE reports. We get PCE next Friday too, or next Thursday rather, after the Fed meeting. But the Fed could point to that and say that's why we do not want to cut, which puts the emphasis on those later meetings. July, September, October, December, 4 meetings left this year, 2 cuts priced in. Do we really get that? That'll all depend on the data. And while I look up what happened with Boeing, I just want to say I too am honored to have been here for this show, like the president and the Fed.
Thank you so much, Michael McKee. With a look ahead, right now you're seeing priced into Fed funds futures a 64% chance that the Fed will cut in September. So to what Mike was saying about setting up the market for that September rate cut. Greg Dako of EY writing this: economic activity is decelerating, even as inflationary pressures are reemerging. This tension is likely to persist through the summer. Greg joins us now, and Greg, we just had a lineup of people all saying that the economy is going strong. People are just deciding which fast casual restaurant to go to. And there definitely does not seem to be the same kind of inflationary pressure that many people thought would be the case. Why are you maintaining this idea of a stagflationary push that just hasn't shown up in the data yet?
Well, I think it hasn't shown up in the superficial data, but if you lift the hood, you're going to see the signs of this stagflationary move. If you look at the recent developments in terms of inflation, we estimate that about a third to a fourth of the push in inflation in the month of June was actually coming from tariff-induced price pressures. So it's there, it's slowly starting to emerge, and I've written in the past about the fact that it's not that we're not seeing the tariff pressures, it's that they're taking some time to filter through because businesses have been managing inventories, because they've been using bonded warehouses and foreign trade zones, because the effective tariff rate is not quite yet at the average tariff rate, and there is a gap between those two. All these measures are delaying the inflation pass-through, but make no mistake, it is materializing, and it will affect us with more and more pressure over the course of the summer, which will feed into how consumers spend. And we're seeing these signs of pressures on the consumer already. If you look at retail sales, the categories that were most affected by the tariffs are the ones that are suffering the most.
So what happens then if we feel the real effects later this year and early next year? At the same time, we're starting to get Fed cuts, and you're starting to see the one big beautiful bill, some of the stimulus flow through from that.
Well, I think it's important to distinguish all of the different details that are affecting the economy. There are a lot of cross currents which make for this very confusing economic picture. But the reality is that the economy is decelerating. If you look at the labor market momentum, it is actually decelerating. Slower job growth, more concentration of job growth in a few sectors. We are seeing continuing claims for unemployment that are rising, even though after the hump we saw initial claims come back down. We're seeing the hiring rate at a 10-year low. All of these factors are factors that drive income growth, the key pillar to consumer spending activity. And that is weighed to the downside. So that's going to be a constraint for consumer spending as we navigate through the second half of the year, at the same time as inflation pressures are ramping up. And about that fiscal bill, that is not going to provide a lot of stimulus in terms of the U.S. economy. The major thing the One Big Beautiful does is prevent the expiry of a number of tax provisions from the Tax Cuts and Jobs Act. That prevents a drag on the economy of 1%. But the actual net boost to the economy, we calculate will be around 0.2, 0.3 percentage points of GDP. Not a big benefit for the cost of that bill.
Well, the other factor to put into this too is also what we might see in terms of a supply shock to a supply shock in the labor market, going from something like 4 million people coming into the U.S. a year, a lot of them working age men, going to something like just a few 100,000 per year. Have we started to see the effects, and what will the effects be going forward?
I think that's a much under-discussed topic, the immigration topic, because we are in an environment where increasingly economic activity is driven by supply-side factors. Whereas before COVID, it was all about demand-side factors. Now it's increasingly about supply-side factors. It's the supply of labor. It's the supply of capital. It's the supply of energy. It's trade and logistics. And when it comes to immigration, you're absolutely right. It's been a key driver of economic activity. If we start to see less immigration, that is going to do a couple of things. One, it will weigh directly on spending because there are fewer people that are spending less, in part because they're fearful. And two, it drives lower supply, lower labor supply, which weighs on employment growth, which weighs on your economy's potential to grow. Combined, all of these represent a drag of about 0.3, 0.4 percentage points over the next year. That's more than the One Big Beautiful Bill that we were just discussing.
It's one reason why people are looking at this this miss on capital goods orders that include non-defense aircraft as being particularly notable. Stay close, Greg, for 1 second. Michael McKee, you've got some more details on what exactly was behind that.
It is sometimes fairly easy to figure out durable goods orders when you have these big swings. It's usually Boeing. They reported a decline of 51.8% in new orders for the month of June, Boeing and some of the smaller little private plane makers. And that compares with a 231% rise in the month before, in May. So you can see why we get these big swings. Unless you're Danny Berger, you're not buying a new Boeing jet every month. We also saw a decline in manufacturing orders of 12.8%. That's something the Fed will keep an eye on, along with computers and communications equipment. They both were down on the month, and this may signal that business is sitting on its hands. One last note, capital goods shipments were up 0.4 after a 0.5 rise the month before, and that was double what was anticipated. So maybe we have a little more strength in the second quarter, the rebound from all those imports, et cetera, that we saw in the first quarter. Those numbers will feed into better than expected, perhaps second quarter GDP, which we get on Wednesday when the Fed is making its decision.
Thank you so much, Michael McKee. And Danny Berger is here to tell us all about your selection of Boeing jets that Mike somehow put on your radar.
Apparently every month I'm buying a new Boeing jet. You all are welcome to join, I guess. I don't know where we're going with an entire jet, but yeah.
But you know, what Mike is talking about is actually really important, and this idea that we've heard about so much this morning, which is that it used to be just investment in assets and liquidity-heavy kinds of corporate investment. Now we're talking about real physical investment in this whole industrial revolution. At what point do you see that really offering a boost to both productivity as well as growth that hasn't been accounted for in so many of the more pessimistic outlooks for the U.S. economy?
Well, I've been an optimistic on the productivity front. Despite the fact that I'm quite reserved in terms of the short-term cyclical outlook, I've been very optimistic about the exceptionalism that we were seeing going into 2025 because it was driven by strong productivity growth that was coming from the bottom up. It wasn't yet the AI lift that we're all talking about. It was actually businesses being more efficient with the talent on hand that costs more in today's environment, ensuring longer tenure, better trained employees are better able to contribute to economic activity. And it was this focus on investing in the infrastructure that will support AI. That is often undercounted. And then on top of that, you have a desire to push more industrial policy and focus on driving more manufacturing investment. It won't bring back the jobs, but it will bring back more economic activity and more potential supply. That is right now undercounted, but it is still one of the key pillars of economic activity driving that stronger productivity momentum.
Does that mean for all the fears of growth slowing and inflation picking up that it's not quite stagflation? Because you have some of these forces, it would moderate the worst case scenario?
Well, I think economic activity is a flow notion, right? And so we are still benefiting from a very robust economy. As I was saying, up until the start of 2025, we had an economy that had been growing at a 3% pace with disinflation. Inflation was moving lower. So we had the best of both worlds. We had essentially strong productivity growth supporting a very strong economy and disinflationary currents. We're gradually moving to the opposite of that, a stagflationary environment where economic activity is slowing and inflation is accelerating. And that becomes a headache for policymakers around the world, but including the Fed, which has to balance these divergence pressures in terms of the employment mandate and the inflation mandate.
Considering the pressure from the White House, inevitably, especially next year when we have a Fed chair appointed by President Trump, does this just turn into a Fed that puts more weight on the growth side of the mandate, even if inflation is still picking up?
No, I think the Fed will have to pay attention to both sides of the mandate. That is what it's supposed to do. But it has to determine whether the pressures from tariffs are one-off pressures, which is the argument that Governor Waller has been making. It's the argument that I've been making for a while now, that essentially this tariff-induced inflation is going to be a temporary one, that we are still seeing significant disinflationary currents, in particular from the shelter side of the economy, that inflation expectations are still well anchored, and that we're not necessarily going to see second-round effects because the labor market is softening, and you're not going to see the types of pressure that we saw during COVID with wage inflation accelerating. In my opinion, that opens the window for the Fed to neutralize monetary policy from a slightly restrictive stance to a more neutral stance with some easing over the course of the next few months.
Greg Dako of EY, thank you so much. Just a note that isn't necessarily as sexy as donning a hard hat and going through the renovations, but maybe that would be the conversation that's more akin to what we get in the Eccles building next week. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Anand. Yahaira.
Hi, Lisa. Tesla plans to launch its robo-taxi service in San Francisco this weekend. That's according to an internal memo seen by Business Insider. It reports the robo-taxis will have a safety monitor in the driver's seat who will have full access to the brake and steering wheel. Some Tesla owners will be sent an invite to use the service, according to the memo. Meanwhile, meme stock mania made a comeback this week, and traders made American Eagle their latest target after the retailer announced a new campaign headlined by actress Sydney Sweeney. Shares of Open Door, GoPro, Krispy Kreme, and Kohl's also saw a surge this week as traders piled into speculative corners of the market. And we end on some bad news. A massive heat wave is expected to blanket most of the East Coast today. More than 129 million people across more than 20 states are under life-threatening heat alert. Cities from Washington to New York City and Boston will see highs well into the 90s with a real feel of more than 100 degrees. A few daily record highs may be challenged. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Happy Friday. Go off and enjoy it, I guess, as we all try to figure out how to beat the heat. Up next, setting you up for the day ahead, plus Vishal Kanduja of Morgan Stanley on the impact of tariffs on inflation, one of the elusive questions of 2025. This is Bloomberg Surveillance.
Bloomberg launches our inaugural 25 African startups to watch list.
About 2.5 years ago, we created a solution. We are able to generate refrigeration using the sun and water. We're able to store energy in the form of ice, as opposed to storing energy in the form of lithium batteries. We're integrated in every refrigerator, a pay-as-you-go technology, allowing individuals and small businesses to be able to pay as low as $10 to own a refrigerator.
Uncover is a women's wellness brand that is specifically made for women of color. It's based in Africa, which is the most underserved beauty market in the world. We are making Africa a priority and not an afterthought. We believe that the population on this continent deserves to be formulated for, heard, and we are giving this consumer a voice.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question. I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Matt Miller, the Circuit de la Sarthe in Le Mans, and this is Bloomberg.
Just taking a look at what's happening, and it's a tough construction job. It looks like it's about 3.1 billion. It went up a little bit, or a lot. So the 2.7 is now 3.1.
I'm not aware of that.
Yeah, it just came out.
Yeah, I haven't heard that from anybody at the Fed. You're including the Martin renovation. You just added in a third building is what that is. That's a third building.
Well, no, but it's a building that's being built.
No, it was built 5 years ago.
It's part of the overall work. So, well, I'd love him to lower interest rates. But other than that, what can I tell you?
That was President Trump grilling Fed Chair Jay Powell on renovation costs. And I have to say, Danny, do you think they actually needed the hard hats?
Well, the fact that Trump was like, yeah, let's take these off. We don't need these anymore. We're out of the danger zone. Probably not. It reminds me when politicians also tour zones with the bright orange vest. It's like the fact that there are cameras everywhere and security, I think, would alert people to the fact that they're there.
But they looked good in them. That's all I can say. Less than an hour away from the cash open. Here are your morning movers with Yahira Anand. Yahira.
Hi, Lisa. Intel is moving away from its build it and they will come strategy. And how are investors reacting? Well, not good. Shares are now down 8.6%, but CEO Lip-Bu-Tan is charging ahead. He plans to cut jobs and scrap some of its major factory projects after it poured billions to try and become a chip foundry powerhouse, but no longer. And the disappointment didn't stop there. It also guided lower on margins and offered little to no clarity on how it plans to compete in AI. And it was a blowout quarter for our next stock, and that is Dockers. Shares are up 11.7%. This is the company behind Uggs and those chunky Hoka sneakers. Sales rose by double digits for both those brands, but it's not smooth sailing from here because this is a shoemaker, so of course it's caught in the crossfires of tariffs. And while it was able to mostly blunt the impact by front-loading shipments, it does say that price hikes may be coming as those costs start to catch up to them. And we end on shares of Paramount. They are up 1.2% after the FCC approved its merger with Skydance, but it came with some strings attached to appease the agency leader, a Republican appointed by President Trump. To secure the green light, the company had to end some of its diversity initiatives and agree to add a watchdog to supervise any bias at the media company. So what happens from here? Well, Sherry Redstone, whose family has run this company for decades, will step down when it's completed, and David Ellison will become chairman and CEO. Lisa?
Thank you so much, Yahira. Have a wonderful weekend, and thank you for this morning. Counting down to the opening bell, here is the trading diary for the week ahead, and it's a big one. On Monday, we have Treasury Secretary Scott Bessent and Commerce Secretary Howard Lutnick meeting with their Chinese counterparts in Stockholm. On Tuesday, earnings from Starbucks. Wednesday, a Fed rate decision and a Chair Powell news conference, some renewed focus on that, plus earnings from Meta and Microsoft Thursday, jobless claims and results from Apple and Amazon. Finally, on Friday, we do get that payrolls report at a time of increasing questions around the U.S. economy. Let's stick with that economic data. Investors looking ahead to next week's Fed decision and other economic indicators. Vishal Kanduja of Morgan Stanley writing this: given the tariff revenue collections, we believe that the next two inflation prints will be reflective of the tariff contribution. Vishal joins us now, and I am curious about whether this is going to be a one-time price shock or whether this is going to have longer legs, and how much we've really gotten clarity versus just people's expectation that this will be just a one-time adjustment.
Good morning. Lisa, definitely in principle, it should be a one-time adjustment. Again, tariffs, there are only three spots that we can see the effects. Either the exporters eat it up, either companies through their profit margins. We heard a couple of those in the earnings, more on the auto side and the OEM side, showing up with one-time charges there, or it trickles through PPI and CPI here in economic data. We saw a little bit of all of that, less of exporters, more of profit margins, and CPI show us a little bit. I think as you track the revenue from the tariffs and as average rates start to go through the economy, I think the next two prints are going to get a little steamy and a little bit more contribution from there. But we still think it's going to be a one-time bump rather than a lingering effect that we had seen in the prior years on the.
To your point, Vishal, the tariff revenue has been real. We have seen a bump in what the U.S. is taking in. What does that tell you about how sticky these tariffs are for the foreseeable future? That this isn't a story of the next 4 years, but this is a tariff story that will continue on beyond President Trump.
Absolutely. I think if you just remove all the politics, midterms, four-year term, et cetera, out of the picture and just mathematically extend the clock out, yes, this is going to be a consumption tax, which is going to be 5 times more. But then companies are resilient and adjust. I think they will take some profit margin hits, slightly more profit margin sectors with higher profit margins will take a little bit more, less on the consumer side. And then consumption will adjust, or consumers will adjust as well. I know we are still squinting to see the weakness in consumption and consumer and labor market, but still there is that sort of underlying weakness that is showing up. And we do think that consumption patterns will adjust. Nominal GDP should adjust down for that matter as well.
What will it take to finally see that show up, Vishal? Because it has been some time since we've seen any of that weakness, despite the constant calls for it.
Yeah, no, I think it'll take time, and that's where it makes the Fed's job difficult. From our perspective, I think why it is difficult to see this and why it's taking time, because balance sheets, both consumer and corporate balance sheets, coming into this 2025 uncertain environment from both fiscal and monetary policy have been extremely strong. I think you're sitting on a consumer who is a homeowner is sitting on 3% 30-year fixed rate. Even the best hedge funds in the world don't get that type of leverage, and their equity is up 25% at least on their houses, and they are running a 4-decade low unemployment rate. So that balance sheet of that consumer is extremely strong to take on some of the uncertainties that we are seeing, and that's why I think it's taking time for it to seep through the economy.
Vishal, you said something in your notes that I thought was fascinating. When you bleed this into the market, you said U.S. assets and U.S. dollar are two separate trades, and this is something increasing numbers of investors are coming around to. Is that something that you expect to be persistent? Bullish U.S. assets, bearish U.S. dollar?
Spot on. I think that's how our portfolios are adjusted today as well. Over the last 7 months, we've adjusted and steered our portfolios in that direction. We're still trying to eke out that positive fundamentals from consumer and corporate balance sheets here. Not saying that there are not some of the idiosyncratic strong fundamental balance sheets in Europe and other parts of the emerging market world as well. But I think that dollar weakness, I think, is coming primarily from that, the urge from the administration. We've heard it time and again from speakers in not the Fed speak, but more from DC on that part. And then where the exceptionalism story is landing us, it is much weaker dollar from here rather than what we had seen probably the last decade and a half. So strong fundamentals from consumer and corporate balance sheets, weak fundamentals from the government balance sheets and deficits, which flows into your currency. And that's how portfolios are positioned at the moment.
Just about 20 seconds, Vishal. You said much weaker dollar. How much further does it have to depreciate?
I think in the next probably 2 years, we think that probably around that 10 to 15% in a basket of currencies. We are not picking one currency to go against. In a basket of DM and EM currencies, that's how we've reflected in our portfolios. We do think that there is a double-digit depreciation along the way. Again, the point being that it is not about U.S. Treasury, foreign buyers of U.S. Treasury as a percentage of GDP has actually not changed. It is the foreign buyers of U.S. equities that are up probably 10 to 15% since the financial crisis. That needs to adjust. That's where some of the hedging will come through, and that's why we think that 10 to 15% is how we are thinking about it.
Vishal Kunduja of Morgan Stanley, thank you so much for being with us. Have a wonderful, wonderful weekend. Right now, we are getting some headlines from President Trump touting the great economic numbers, still, though, arguing for a rate cut.
Yeah, great economic numbers does not save Chair Powell. We'll see what he says next week after that decision.
And we'll be speaking with a host of wonderful guests. On Monday, we've got Steve Chivarone of Federated Hermes, Jay Pulaski of TPW Advisory, Abby Yoder of JP Morgan, and Steve Rasciuto of Mizuho. Danny, thank you so much. Always wonderful to have you here. Love your contributions. This was Bloomberg Surveillance.
It's the most fascinating time for the global economy in years, and our conversations
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
We're building another art museum of the Guggenheim. Now, Louvre's big enough. Why do you need a Guggenheim as well, right next door?
I think it's a great question. I think the beautiful thing about the UAE and Abu Dhabi is we live with over 200 nationalities. And in doing so, they have become a part of the country's and the city's fabric. And we need to celebrate that. So we need to celebrate everybody's identity, everybody's background, everybody's heritage, everybody's history. And what a beautiful way in doing so in these beautiful institutions. These museums are educational institutions and they're community institutions. So we wanted to curate really a story where you come to Saadiyat Cultural District and you, if you allow me to curate the story, you start off at the Natural History Museum. And at the Natural History Museum, you get a glimpse and you get an understanding of how we came to be, how our Earth came to be, how our universe came to be, from a scientific perspective. Once you leave the Natural History Museum, you go to our National Museum, the Sheikh Zayed National Museum. There, you understand the history of this great land, not just the history of the country, but the people of this land that have been a part of this land for over 300,000 years. You get a glimpse of what the past and the present and the future looks like here in the UAE. From there, you maneuver yourself to the Louvre Abu Dhabi, which is a beautiful universal museum. It is universal in its thematic approach. So there, you basically see a part of you on an equal pedestal with the entire world.
In case you missed it on Bloomberg Insight.
Losing a few people is not actually that unusual. These companies are constantly pulling people, in both directions. The real question is, can it turn around Meta's fortunes? It's about who is leading in terms of adoption, in terms of B2B use cases, B2C use cases in different countries. And we're seeing Chinese companies certainly making a strong showing across many of those fields, even if, I would say that the US is still generally in the lead. But what we've seen at the company level and at the product level is actually that continued decoupling. So I think it's a pretty safe bet that is going to continue to be the case.
Not to bring up the past, but you've criticized Sam Altman. I'm just wondering whether you've made peace with Altman on the back of that drama.
So we haven't actually interacted since the time. I'm sure at some point soon we'll end up at the same event, and the AI world is pretty small, but no, haven't had a chance yet so far.
Don't miss Bloomberg Insight live weekdays.
Bringing you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hordern in Buenos Aires, Argentina, and this is Bloomberg.
Good Friday morning, 30 minutes until the start of trading. I'm Matt Miller.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, President Trump says he won't fire Fed Chair Powell while renewing his call for lower interest rates. Muted moves at the end of a record-setting week as earnings make the case for further stock gains. Meanwhile, Bank of America's Michael Hartnett issuing another warning on stocks, says bigger retail, bigger liquidity, bigger volatility, bigger bubble. Katie?
We're going to talk about what that means, but let's get to some of the earnings movers because there's a lot of them today. And we start with Deckers climbing after UGG and Hoka sales jumped last quarter. You can see shares currently up almost 12% pre-market, and that is good news since they were down about 50% year-to-date through yesterday's close, Matt.
So making a little bit of that back. Intel is down again because of concerns again that the CEO doesn't really have a plan. He's more focused on cost cutting than restoring the chip maker's technological edge. We're going to dive into that right now. On the company call, Intel's CFO said they are cutting jobs to drive greater efficiency. Here with more is Bloomberg Tech co-host Caroline Hyde. So Caroline, you're kind of dancing in the dark here.
It feels like almost a bit of an admission of defeat here, Matt. This is a not trillion-dollar company. It's not even $100 billion company anymore, and it's going to erase about half of all its year-to-date gains if this stock move holds as the open comes. Now, look, this is Lip Bhutan having to say, I'm cutting. By the end of this year, it's going to be 20% of my employee base gone. I'm actually no longer going to be expanding fabrication units, manufacturing in Germany and Poland, bye-bye. I'm slowing down my Ohio build-out, and more broadly, I'm trying to consolidate. Maybe Costa Rica gets folded into other manufacturing units over in Asia. He's basically also saying, I'm not in the race to compete anymore on the latest manufacturing innovations. Take 1.4 nanometer technology, Katie. This is the 14A that we talk about. He's basically saying, I'm icing that for the time being because I haven't got customers for it. Yes, I'm still going to push out on my 1.8 or my 18A, and that Puma Lake seems to be on track. But they're not going to seemingly push forward until they see the writing on the wall that customers are there for it.
And I'm glad you brought up the factories there. So one thing that he said on the call was, I do not subscribe to the belief that if you build it, they will come. So clearly the focus here is on cost cutting. It's not about restoring necessarily their competitive edge when it comes to the technology that you mentioned. So it's not really an inspiring message for shareholders to latch onto.
And think how the employees must feel today when they look at that memo as well. All of this just really shows that maybe they'll have to depend more on TSMC a little bit more if they are going to innovate and design more capable chips, if that demand is there, but maybe they don't manufacture it. What does that mean more broadly for the US focus on artificial intelligence? Is the administration really going to let the original winner of tech manufacturing here in the United States to just say, sorry, we're holding out? Actually, the Ohio plant that we back in 2022 were committing $20 billion to, we're delaying that out until 2030 now. I thought this was all about supply chain. I thought this was all about American competitiveness. Maybe this is a bit of a call for help from the federal government more broadly, but it does feel as though we're seeing revenue is now dependent on PC, but we know that that's actually been brought forward because everyone was worried about tariffs. That's likely to slow in the second half of the year. So this really is a worry that they're just kind of saying, hanging their hat for the time being on innovation, and no news on how they compete with NVIDIA and AMD in the world of generative AI.
Yeah, that is a difficult medicine to take. Maybe it's necessary, but as you walk through, a tough message for shareholders and also a tough message to sell to potential talent coming in as well. Our thanks to Bloomberg Tech co-host Caroline Hyde with the latest there on Intel. Let's go to another one of today's top stories, and that is Paramount shares on the move on FCC approval of its merger with Skydance. Now, as part of the deal, the new company will ensure its programming includes viewpoints from across the political and ideological spectrum. Bloomberg telecom reporter Kelsey Griffiths has the details. So we're not just talking about a combination here. This is very much overshadowed by the political elements at play.
That's right. So this has been almost a year-long journey to get to this point. And it's kind of been littered with a lot of these political controversies. We just saw a very popular late night show get canceled, late night with Stephen Colbert, and unfortunately, you know, that kind of, again, got tied up in this big battle over whether CBS is going to be sort of remade in the Trump administration's image now that the companies had to sort of court the administration for deal approval.
Yeah, Colbert canceled. I just watched a little bit of the South Park, most recent South Park episode, lambasting Donald Trump and Paramount. What does this look like from a business perspective? Does the case still play out for this merger?
Yes. So one of the big promises that David Ellison has made with Skydance is to inject $1 billion in capital into the CBS and into the Paramount properties. And one of the factors that the Federal Communications Commission looked at when they approved the merger yesterday is that injection of capital into local broadcast stations, which they still feel are the lifeblood of the communications landscape going forward.
All right, Kelsey, thanks very much. Bloomberg's Kelsey Griffiths setting up the story for us. Let's get more on the deal. We're joined by Brian Weiser, president of Madison and Wall. Brian's a former investment banker, equity research analyst, longtime agency executive. And what's your take on this deal, Brian? I mean, does it make sense from an investor point of view?
Well, I mean, it doesn't really make a huge difference to the overall business because it's not changing that much other than adding a new film studio and different leadership at the top. So I don't think it makes a very big difference in terms of the overall trajectory of the business to start.
And Brian, I'm taking a look at some of your notes here. I hear what you're saying about the business. Let's talk about the process here, because you make the point that this was a much more politicized process than you can recall seeing before in your experience.
Yeah, I mean, and we saw this also with Omnicom and Interpublic coming together. But in terms of any media merger that we've seen, I'm unaware of any similar circumstances here. At the end of the day, I mean, it is remarkable what they had to agree to in order to make this deal happen. Now, I couldn't help but notice the reference to the $1.5 billion investment in the FCC's release, which happens to be the same amount as the deal to get South Park.
Yeah, I mean, well, I guess it makes sense to pay $1.5 billion to get South Park for 5 years. I know that the White House said South Park hasn't been relevant for over 2 decades, but I just paid $12.99 a month to Paramount to watch one episode of South Park. So I can understand the logic there. Still, it's such a crowded space, Brian. You know, Netflix, Amazon, HBO, the list goes on and on and on. How much longer are consumers going to be willing to pay $12.99 a month for, 10 different properties?
What I think surprises a lot of people is that there is an awful lot of room to go. When you think about the total amount that consumers spend on home entertainment, it's shockingly little. I did a calculation last week after Netflix earnings where I could calculate that the typical consumer is spending 22 cents per hour of time spent watching Netflix. It's really remarkable when you think of the value of the entertainment.
It is really important. Good point there. I do want to talk a little bit about Charter as well, which I understand is in your coverage universe as well. So let's talk there because there was disappointment on that front.
Yeah, well, I think that at the end of the day, the cable industry in its traditional form is weak, shall we say. Cord cutting continues uninterrupted, in part because of the relative value advantage that consumers get from streaming services. There certainly is competition on the internet services angle, and there's a lot of competition in the other parts of Charter's business. The video part is really where I tend to focus, and we try to pay a lot of attention to it. A number that maybe investors don't care about as much because it frankly is more a broadband access business than anything else now. But when you look at the reduction in spending on programming expenses down about 9%, not unusual, right? But that's the trajectory of the business. The spending by traditional distributors on programmers such as Paramount is down by a lot, and it's not going to change anytime soon. So it's really kind of ongoing negativity for the traditional media companies.
Absolutely, and Charter shares really feeling that this morning, down about 12% pre-market. Brian, great to get some time with you. That is Brian Weiser. He is president of Madison and Wall. And let's take a check on futures right now. The S&P 500, little changed, I would say. The color is green, but that doesn't mean much. The NASDAQ 100 down slightly. The Russell 2000 outperforming, but overall muted moves. There's much more action under the surface, Matt Miller.
Yeah, it's true that there's not a lot going on the indexes, but there is a heck of a lot going on in terms of the individual movers. Tesla, for example, is reportedly launching its robo-taxi services in San Francisco this weekend, so adding one more city to the docket. They say 25 cities by the end of 2025. We'll see if they can get there.
Yeah, and we'll see if that's enough to excite investors once again. Let's talk about Centene, though.
Speaking of exciting investors.
This one is interesting, I swear to God. It slashed its annual outlook and reported a surprise quarterly loss. But you can see the shares are higher right now because remember, earlier this month, they pulled guidance altogether, 2025 guidance. The shares fell 40% in one day. They reinstated EPS guide for 2025 at $1.75 a share. That is way less than the $7.25 they had been anticipating, but bad guidance.
Viewers what Centene does.
It's an insurer.
It's an insurer, of course. And because of one big, beautiful bill, they're no longer going to make the $7.25 they thought they would in 2025.
Right.
But better than nothing, they'll do $1.75.
Exactly. We also have Synovus up on the board here. Do you want to explain what Synovus is?
Synovus Financial.
There you go.
It says it in the name. Getting acquired by Pinnacle Financial in an $8 billion all-stock deal. Investors aren't terribly thrilled, as you can see, evidenced by the shares down 11% in the pre-market.
Now, coming up, President Trump maintaining that interest rates need to come down while touring the Fed with Jerome Powell. We'll have more on that meeting next and some incredible video. This is Open Interest.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets. Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me. Now we're playing.
Yep, now we're playing. First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5.
Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
We're just taking a look at what's happening, and it's a tough construction job. It looks like it's about 3.1 billion. It went up a little bit, or a lot. So the 2.7 is now 3.1.
I'm not aware of that.
Yeah, it just came out.
Yeah, I haven't heard that from anybody at the Fed. You're including the Martin renovation. You just added in a third building is what that is. That's a third building.
Well, no, but it's a building that's being built.
No, it was built 5 years ago.
It's part of the overall work. So, well, I'd love him to lower interest rates. Other than that, what can I tell you?
President Trump there touring the Federal Reserve with Fed Chair Jerome Powell yesterday. The tour comes as the president continues to pressure, although he said literally, not pressuring, no pressure.
And then he,
the Fed
hit him a little bit.
Lower interest rates. For more, we're joined by Michael McKee, Bloomberg's international economics and policy correspondent. This couldn't be more fun.
Are you having fun?
I'm having fun. I mean, we're all having fun. We wake up every morning and check his tweets. And he did say yesterday that he was honored to be at the Fed. The Fed returning the favor today, saying they were honored to welcome the president to take a tour of their historic headquarters, as they said. You see them touring there. The president said the cost overruns are substantial, but on the positive side, our country is doing very well and can afford just about anything. And the Fed today promising we're continuing to be careful stewards of these resources as we see the project through to completion. So both sides making nice here. I'm going to bet it does not change the president's inclination to speak out about the central bank, and if they don't cut rates on Wednesday, I'm sure we'll get some sort of tweet about that.
Well, that's the thing. We're barreling into that Fed meeting coming next Wednesday. As you say, you take a look at market consensus, you take a look at the words that are coming out of the FOMC. It certainly doesn't seem like they're going to lower interest rates. So it feels like these nice words that are exchanging, or have been exchanged, it's going to be a different story come Wednesday at 2 p.m.
Well, I don't think the Fed wants to necessarily placate the president, but what they might do that would at least go a ways towards that is do what the markets want and set up a September cut and say if we continue to see data like we're seeing now, where inflation is not necessarily rising all that much, it is rising, and unemployment has remained essentially stable, then we could look to adjust the rate going forward. That's the kind of language that we might see. Now, the issue is we're going to get 2 more CPI reports and 2 more PCE reports before, 1 more PCE report, 2, because we get one next week, before the September 17th Fed meeting. So the Fed will have a lot more data on which to base a decision. And of course, some of that data is going to be coming after August 1st, which is tariff day, and we'll see if the tariffs actually go up as much as he's talking about.
So one of the reasons that President Trump has been really beating this drum that he wants lower interest rates, he's often pointed to housing in America and how tight the housing market is, how high mortgage rates are. And you think about a 25 basis point cut, which is what's being discussed. We're not talking about jumbo rate cuts here. I mean, how much would that actually matter?
Well, although I'll jump in and say the president has asked for a 300 basis point cut.
That he has said that he would like to see interest rates at 1% or so.
That would be like Jack Nicholson in The Shining going, wait till they get a load of this. You get 300 basis point cut at one time, we would have a lot of fun. 25 basis points isn't going to change a whole lot. What we have to see is, I was talking with Walt Schmidt of FHN Financial, their mortgage strategist, and he said you got to get below 6%, somewhere in the 5 to 6% range, because people are not going to get 3% again. And if we've come down from 7, then you get into the 5s, people are going to feel better, and that might start to loosen things up. So we're probably not looking for any relief in the housing market in terms of mortgage rates for 6 months or so, but then we might begin to see it earlier next year. Fannie Mae was predicting rates will come down in a release yesterday, but they're not seeing them come down a lot in 2025.
I don't want to get too deep into the weeds here, Mike, but if we had one of the Kevins appointed as Fed chair and he somehow managed to convince the whole committee to cut 300 basis points in one fell swoop, would that lower mortgage rates?
That would lower, wow, that's a good question, because what you would end up seeing if they did 300 at once, you would see long rates go way up because the anticipation would be that you would get an outbreak of inflation.
The bond market would say, what the hell is going on?
Stock market would crash because the Fed would only do that if they thought that what we were seeing was the economy collapsing.
Right.
So I don't think that's realistic. I'm just saying, you know, for those of us in the news business who like, you know, car crashes, things like that, you know, that's what you would have.
Or about faces. We're seeing commentary out of the president coming from the press pool. He says Powell is a very good man.
It's a direct quote.
Yeah.
But again, we'll see what the tone
Not a loser or a stiff.
What?
Not either stupid or evil.
Trump's opinions are subject to change without notice.
Mercurial.
So are all of our opinions. I mean, that's fair. Michael McKee, thanks very much for joining us. If you check out the function WSL Predict, by the way, on your Bloomberg terminal, one of many of the super sweet new worksheet library functions, you'll see betting odds of Powell's tenure ending early are around 20%, so not so bad. Kalshi and Polymarket after recent highs of about 40% on both. And we will be joined by the
Kalshi CEO. You'll be
Kalshi
speaking to him
CEO.
next hour.
That's right. Tarek Mansour joins us in the next hour.
And before we get there, let's take a quick check on futures ahead of the opening bell. We're about 10 minutes away, and it's a little bit of a snooze, but that could change. We are in the heart of earnings season. A lot of action going on underneath the hood. You want to keep a close eye on this market. This is Open Interest.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling.
Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
I'm David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
The risk of a bubble in stock markets is rising, according to Bank of America. The team led by Michael Hartnett, who warned of frothiness in late 2024, says that looser monetary policy and easing regulation could spell trouble for stockholders. Hartnett says, quote, bigger retail, bigger liquidity, bigger volatility, bigger bubble. Alpine Saxon Woods chief market strategist Sarah Hunt joins us now. Sarah, first off, it's great to see you.
Good to see you too.
The second thing is that, okay, you read this note about a bubble, and you honestly could make more of a case now after the past few days of action that we've seen in the frothiest, memeiest corners of the market.
You could, and I think that one of the issues that you have with a market rebounding so quickly from the lows in April is that you now have to see earnings catch up with that, and if they don't, I think you could definitely see some issues. So this is one of those things where the fundamentals are now really going to come into play on the earnings side. And on the technology side, we've seen some good numbers. We've seen some sector issues. We've seen some specific issues to companies like Intel or Texas Instruments. But you really need to see those earnings come through, and projections for next year looking pretty good to justify some of the valuations we see right now.
What do you think about the effects of tariffs? Because you know, we've passed the sky is falling point, and now we've realized companies have really fat margins, and they're eating a lot of these tariffs. So maybe not huge inflation, but that's got to come through in earnings in a negative way, right?
Well, and so that's the question. How much does the margin get impacted? How much adjustment can companies do? How much substitution effect is there, right? In economics, you're always like, what can I substitute X for Y? How much of that can backfill some of those issues or not? And that is going to be one of the things that comes through in earnings. And that's one of the questions is how badly does it come through, or how do they cut costs in other places, which could be an impact on the labor market. So there's a lot of puts and takes going on right now, and I don't think we have all the answers.
And so we're going to get deeper into earnings in the next block, but just to get your sense of how it's going so far, I mean, you take a look at some of the individual movers, even just today, it really feels like so far it's a story of have and have-nots.
And I think that this is where the individual stock picking becomes more of an issue in an environment like this, because it is, as Texas Instruments mentioned the other day, it's very sector specific. So the auto sector, that doesn't look so good. So how much is that is pulled forward? So that goes to the bigger economic question of how much of the economic statistics so far this year has been a pull forward. And that's where all of that information is going to get overlaid, and then we're going to try to pull out the extraction from that and see what happens about what we think is going to happen into next year. And I think that's where things could get a little bit dicey in terms of growth.
Yeah, I feel like pull forward could be a huge issue because everything looks fantastic now on the top line, but so many investors are asking CEOs, and they're not giving the specifics that the market needs.
And I think this is the issue of the changing both the percentages and the timeline on tariffs. It makes it very hard to figure out how much of that pull forward is people just going another 2 months ahead, another 2 months ahead. And that's where either there's going to be some dramatic drop off, or things are just going to tail in a way that is just not very interesting or exciting for markets which are looking for a continued growth across the entire spectrum.
All right, Sarah, hold that thought. We are barreling into the opening bell. That is coming up next. Sarah Hunt is sticking with us. There's the setup as we are just 4 minutes away. Stick with us. This is Open Interest.
get the debt down and the deficit down if we have these big tax cuts?
Well, David, let me just say, I think the deficit is probably the most important issue today in terms of the long-term impact on the economy. And just to put this in perspective, in the first term, we had debt to GDP ratio of about 100%. And with the tax cuts and economic growth before COVID, we were growing the economy faster than we were growing the debt. So that ratio would have come down. And I think we were trying to get it down to 90 to 95. The big focus on the first term was military spending. We unfortunately had to increase non-military spending to get it through the House and Senate. But what really impacted us was COVID. And I think, as you know, firsthand, we had to spend a lot of money in COVID or we would have had a worldwide depression, not recession. I think the problem was, the first $2 trillion was well spent. The next $2 trillion we never should have spent. And then the Biden administration kept on spending. So, we have debt to GDP of close to 125% today. That's a gigantic problem. Secretary Bessent has talked about getting the deficit down from 6% to 3% of GDP, and that's got to be a major focus.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up to the minute economic news whenever and wherever it happens. I'm Jennifer Zabasanja in Luanda, Angola, and this is Bloomberg.
Seven-day rally hits a wall. Moments away from the start of trading. This is Bloomberg Open Interest. Maybe it's the pause that refreshes. I'm Matt Miller. You can see S&P futures not doing much at all. NASDAQ either. The small caps keeping their heads up a little bit, 0.4%. Hear the opening bell and see it on the New York Stock Exchange. Accelerant, ARX, I believe is the ticker. Just went public yesterday with a nice little pop from 21 to 28.50. You can see here on the NASDAQ, we've got, I guess it's a Broadway musical actress here, Joy, who is playing the role of a woman who invented like a mop and apparently some hangers. And I think Jennifer Lawrence did the film version of that. Stocks to watch. Katie, what have you got today?
I think it was a self-wringing mop, if that adds
a self-wringing mop.
Yeah.
That's awesome.
I guess, yeah, that's useful. Anyway, let's talk about sneakers because Deckers climbing after UGG and Hoka sales jumped last quarter. Shares recovering after falling nearly 50% this year, currently higher by about 17% as trading kicks off. A really interesting read on consumer demand and also on the state of supply chains. We'll be talking about Deckers a little bit more later this hour, Matt.
All right, Intel is down because of concerns that its new CEO is more focused on cost-cutting than restoring the chip maker's technological edge. It's really basically got no plan for a comeback, and investors, I guess, waking up and just realizing that this morning.
Well, it had been building a pretty impressive year-to-date rally, and then Lip-Bu Tan took the mic yesterday and kind of didn't give much of a reason for hope for shareholders there, basically really hammering home that they're cutting costs, okay? They're not focused on getting their edge back, so not quite inspiring for shares.
No, and it's worth less than $100 billion now, which is, well, with NVIDIA at $4 trillion, it's slightly disconcerting. We're back with Alpine Saxon Woods Chief Market Strategist Sarah Hunt. And Sarah, you were talking about the tech stocks. Obviously, you pointed out Intel and some others have specific issues. But in terms of the big ones and this AI push, we're seeing more and more money thrown at it. Google just a couple of days ago upping its CapEx to $85 billion for the year. Can you still be bullish on this sector?
Well, I think that the upping in CapEx is telling you that that spend continues, and that spend is hopefully there in search of growth. If that is all going to work in the way that they're trying to get it to, then yes. And I think that this is what the market needs right now, because to be fair, where valuations are, if you don't see some of the areas that are growing grow well and grow profitably, then I think that you have some issues with the general level valuation. So yes, I think you can continue to keep that story, but it is definitely one that needs to keep going.
Absolutely. And if you follow the money here and think about where the likes of Google are spending that money, spending that CapEx, it probably leads you in a substantial way to other tech companies. So is that where you would want to be right now, where companies are spending money on other companies?
I think that there's an absolute line from one to the other. There's also an enormous amount of ancillary work that needs to go into that. You have a lot of power gen that needs to come online. You have a lot of industrials that need to support all of this, because if you just have the chips, you don't really have enough. You need an enormous amount of data centers. You need an enormous amount of other things that come into all of this. So it's the spend technology on technology and the spend on infrastructure and other industrials around that technology stack.
What else do you like here besides technology? I mean, if you get away from that, are you bullish industrials?
There are some interesting individual stocks that we like a lot. There are some interesting places in industrials. I mean, even on ancillary stuff on the energy side, you have pipelines, you have something like Williams, but something like individual circumstances like a James Hardie that just made a purchase of a U.S. company, AZEK, that does building supplies and the things that go outside of buildings and decking. There are individual places where there's some really interesting things going on, and I think that that's looking for places like that and looking for where the market is misunderstanding something is a great place right now.
Sounds like you really need to do your homework there.
You really do, and I think that this is back to the whole stock pickers market. If you're not just jumping on the technology bandwagon only, when you're looking at other stocks, you need to be quite careful, because as you can see from some of the earnings that are coming in, there are some very idiosyncratic earnings stories out there, either good or bad, and when they're bad, the market is very punishing to them right now.
When you say stock pickers market, it makes me think of ETFs. You know why?
That. Because you've been hanging out with me for...
That's because I've been around Katie for too long. No, I mean, it's so weird, and I don't know if it matters to you, but that people don't just buy stocks themselves anymore. Now they buy tokens that represent stocks, or ETFs that are single stock ETFs.
Yeah.
What do you think about that whole phenomenon? Does it matter?
Well, to the extent that something like a single stock ETF is just there to juice it one way or the other, like triple up or triple down or something, then there's a whole bunch of leverage in there. That's something that people like to play with. It's sort of like playing with options, right? But it's doing it in a different way. And I think that there has been a lot of individual stock on the retail side buying, and that's one of the things that I think that a couple of the strategists were calling out as problematic, is that how much of that is going on, because that sort of tells you it's a little bit end gamey or late stagey. But I think that, I mean, just to go back to some of the fundamentals on actual stock picking, which is a fun thing to do if that's what you came into this business to do, is something that right now can be very impactful.
Mm-hmm. Yeah, I'm glad you mentioned the bigger retail presence. That was definitely one of the pillars of Michael Hartnett's notes. I do want to just quickly go back to earnings season, because we got some really interesting drama around Centene this morning. Centene is an insurer.
Household name.
Household name, at least in my household. Anyway, so I thought it was interesting that you saw shares fall double digits pre-market. Remember, they pulled their guidance earlier this month, and that was received very poorly by the market. They reinstated guidance almost $6 lower than their previous forecast, but still you're seeing shares rally right now, and it seems like the message there is that even bad guidance in this environment is being received better than no guidance at all.
Well, for something like Centene on the insurer side, the changes in regulations on what's going on in the healthcare space is very difficult, because you had these models that people had extrapolated into forever, and now they're having to redo them. So that's a very specific problem that has been sort of a concern of ours on the healthcare front, because when the government decides to take a shining light and say, what's going on in this corner of the healthcare market, very often things can go pear-shaped if you had a plan in terms of earnings.
It almost seems binary. That's like an on-off switch, right?
That's a very difficult one. It's why healthcare is such a difficult sector right now, because you know that people are looking at taking costs down in healthcare, and you know that in some cases someone is going to be a beneficiary of that and someone is not, and quite clearly that was not. So I think it was better that they put some guidance out, and it was like, well, at least it's not zero, but compared to where it was, that was a big fall, because I think that stock was, somewhere in the high double digits, 80s, 6 months ago, 100. I mean, that's a huge fall down. So I think
it's down 55% year to date.
Yeah, I think that there's that's where you have some real risk in there as things change, and when you get new people looking at new ways to save money in the healthcare space, you have to be careful about who's going to be the non-beneficiary of that.
All right, Sarah, it's always awesome to have you here. Thanks so much for joining us. Alpine Saxon Woods Chief Market Strategist Sarah Hunt. Let's get a quick check on the stock market right now. Just 7 minutes into the session.
Yes.
But Katie, you're going to do this.
I'm going to walk. I'm going to talk.
over there and show us what's happening.
I want to tell you about the breadth right now, Matt Miller, because it's pretty good. You wouldn't necessarily know that by looking at this pretty uninspired move at the index level, but you have more than 300 names in the green right now. And you take a look at what's leading. Tesla, for example, seeing some signs of life here. You have Palantir, Eli Lilly, United Health, really punching this market higher, or trying to, but look at what they're stacked up against. NVIDIA actually is your biggest contributor to the downside on a points basis right now, just a decline of about 0.4%, but that's painful when we're talking about NVIDIA. Then you take a look at Intel. Intel having a worse day when it comes to percent. That is in second place in terms of biggest losers on points. Amazon, Alphabet. So big tech feeling the pinch here, and you're going to see that on the sector level as well. That good breadth that we're talking about, it holds. When you take a look at the sectors, you have more green bars than red bars, materials and healthcare at the top. The problem is those aren't very big names. You take a look at the weights here, you have tech, a small move overall, but still in the red. Real estate, communication services down about 0.4% right now, Matt Miller.
All right, so some individual movers that are pushing their weight around. I note NVIDIA is now worth it's down today, but still worth $4.2 trillion. Coming up, we're going to talk about Deckers, which does not make decking. It makes Uggs, it makes Hokas, and the shareholders are getting a much-needed reprieve after a strong earnings report. Details next. This is Open Interest.
I'm Alex Rodriguez. And I'm Jason Kelly. And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
about the meeting. I know it's taking place, and he's a fantastic man. He's a great attorney, and people should really focus on how well the country's doing, or they should focus on the fact that Barack Hussein Obama led a coup, or they should focus on the fact that Larry Summers from Harvard, that Bill Clinton, who you know very well, and lots of other friends, really close friends of Jeffrey Summers, should be spoken about. Because, you know, Jeffrey Epstein should be spoken about. And they should speak about them, because they don't talk about them. They talk about me. I have nothing to do with the guy.
Are you considering will you do any business deals with the UK?
Yeah, I'm going to meet with the Prime Minister right now. We're going to be over there in about 6 hours. We're meeting with the Prime Minister tonight. We're going to be talking about the trade deal that we made and maybe even improve it.
Are you considering clemency for Ghislaine Maxwell? Are you considering clemency for Ghislaine Maxwell?
I walked the White House today. I saw homeless people sleeping right outside the gates of the White House. Are you concerned about that?
I think it's terrible, and we'll have them removed immediately. We do remove it. We've got to get the mayor to run this city properly. This city has to be run. You know, I have the right to take it over, and I think it's terrible. Where are they? Where did you see them?
Right outside on Pennsylvania Avenue.
Near the Treasury.
Right across the Mafia Park near the Treasury. Have you heard about Todd Blanchard's interview with Ghislaine Maxwell? And would you pardon or clemency for Ghislaine?
Well, I don't want to talk about that. What I do want to say is that Todd is a great attorney, but you ought to be speaking about Larry Summers. You ought to be speaking about some of his friends that are hedge fund guys. They're all over the place. You ought to be speaking about Bill Clinton, who went to the island 28 times. I never went to the island.
Do you maintain you did not write a letter for Jeffrey Epstein's birthday?
I don't even know what they're talking about. Now, somebody could have written a letter and used my name, but that's happened a lot. All you have to do is take a look at the dossier, the fake dossier. Everything's fake with that administration. Everything's fake with the Democrats. Take a look at what they just found about the dossier. Everything is fake. They're a bunch of sick people. Where did you see the people laying outside? Exactly?
Right across the street from Lafayette Park, sir, towards 15.
We'll take care of it.
For bringing hostages home, what are the alternative methods to bring hostages home?
Well, we got a lot of them out, and it's I've always said those last 10 or 20 are going to be the toughest, because Hamas knows what happens when they don't have any bargaining chips. And they really broke a deal. They broke a deal, and you're going to have to do what you have to do right now. It's a terrible...
That's President Trump, obviously, speaking at the White House as he gets ready to head off to Scotland. We want to turn here back to the stock market, 15 minutes into the session, and talk about a couple of products, Uggs and Hoka shoes. Their saving holding company Deckers from a dismal year for shareholders. Sales for those brands surged in the second quarter despite fears around tariffs and consumer sentiment. Bloomberg's managing editor for global business joins us now here on the desk. Shelley Banjo, great to have you with us.
Great to be here.
Let's talk about, you know, these two brands make up a shockingly large portion of Deckers outdoor revenue.
Yeah, now they're at 95%. So this company might as well be renamed Ugg and Hoka at this point. And there's a standout among the whole entire consumer industry right now, landscape, because these are things people actually want to buy and continue to be buying them.
They could call it Hug.
That's what I said.
Just smush the names together there. You said something really surprising in the commercial break, that you take a look at this breakdown of Ugg sales. It's actually men that are a really fast-growing segment within that brand.
Yeah, I was shocked during the earnings call. One of the executives said that men's sales of UGG in particular are growing at almost twice the rate of the rest of the business, which is sort of crazy when you come to think of it, but it sort of goes to explain the reason of, like, why are Uggs still growing? You know, haven't we penetrated the market? Doesn't every woman who's going to buy an Ugg have an Ugg at this point? But it turns out there's a whole, selection of other people in the world who are buying these Uggs.
It is
the total addressable market.
For me, it's very weird because I find it strange that men wear.
I don't think I've ever seen that.
Tennis shoes in day-to-day life anyway. You know, when they're not playing tennis, it doesn't make sense to me.
That only wears dress
only
shoes.
suits.
I'm an anachronistic outlier. In terms of Hokas, what's the growth look like there? Because it's such a crowded sector. You've got On Cloud shoes. Obviously, Nike, Adidas, Puma had pretty bad numbers today, but there's a ton to choose from.
Yeah, I mean, the interesting moment that Hoka's having right now is that they created this whole sort of clunky, chunky shoe. And so as now that's becoming the thing to do, everyone's copied them, Nike, Asics, everyone. People are like, oh, if I want a chunky shoe, Hoka's the first thing that comes to mind because they created the market to begin with. And so they have their own stores, they have an opportunity to grow their own stores, and people are still buying them.
I bought my first pair of Hoka's in 2015. I have never looked back. In 2015, those minimalist shoes were still really popular, but
Barefoot running.
yeah, I never got into that. But when it comes to Hoka...
By the way, Katie buys a new pair of running shoes from Hoka every 6 months or 500 miles. That's her rule.
Yeah, that's the way to save your feet.
Well, that's the thing. I buy the Clifton model. I love my Cliftons, but they recently raised prices. They're pulling different levers there.
Definitely, and they talked about that in the earnings call. They said that they are selectively raising prices to offset the tariffs. They talked about raising prices as much as $5 a pair on certain shoes, but not across the board price raising, and also looking at areas where they could raise prices more. So, for example, they brought up kids as an area where they might be able to raise prices.
This actually is fine for me because my dad and I share a Roadrunners sports account, so I think it's on his credit card.
So your dad is still paying for your shoe habits?
Yes.
That makes sense. What about consolidation in this industry? I mean, like we've said, there's so many different players. This stock hasn't done well. Today, obviously, is a little bit of a turnaround, but is there any possibility that we see some M&A?
Yeah, I think so. I mean, we saw the Skechers deal not too long ago. Deckers is a company that has bought brands. They bought Hoka before. So you're looking around as companies merge and they look to spin off certain brands. Could Deckers be a acquirer in this case? It's a good question.
I should say it hasn't done well this year, right? Year to date, because if you look over the past 5 years, it's actually up Deckers Outdoor Corp 250%.
Not bad.
All the consumer brands are getting hit with the tariffs. People are saying, oh, tariffs equals consumer weakness. So.
All right, Shelley, great having you on set with us. Thanks for joining us. Bloomberg's Shelley Banjo. Let's get a quick check on what's going on in the market. The broader indexes right now, you can see, are rising. The S&P 500, 63.74. The NASDAQ right now just barely up, about 0.1%. Yields are inching up as well. You can see the U.S. 2-year yield coming up, but the 10-year yield is moving up a little bit more severely, over 440, 442 is the level right now. NVIDIA, you can see down, it's only 0.2%, but as Katie pointed out, it's the biggest contributor to losses on the S&P because it's such a huge company, $4.2 trillion. Intel off 9% as investors seem surprised that the new CEO, Lip-Bu-Tan, doesn't have a plan for growth there. Here's a couple of the shoemakers. We were just talking about Deckers, but On Holding also rising, maybe in sympathy with them. And then Paramount Global up 2% after the deal goes through, and also after paying $1.5 billion to get South Park on for the next 5 years. And then Centene. I mean, we all know the insurance company Centene, ticker CNC, rising 2.8% after coming out of the forecast for earnings, Katie, of 175, even though it previously had forecast earnings of 725, but it's better than nothing.
Bad guidance is better than no guidance there. Also, when it comes to Intel, I think Lip-Bu-Tan would tell you he does have a plan. It's just that shareholders seem to really not like it.
Yeah, but it's more about cutting costs, really, than returning to amazing growth, right? They're not going to be the next NVIDIA anytime soon. And they're pulling back from so many investments, like the all-important investment that they had planned at one point, $30 billion investment in the great state of Ohio.
I know you took that personally. We're going to continue to follow the Intel story, but let's talk about ETFs, because it's becoming a stock picker's market again. But this time, it's not about active managers, it's through ETFs. Bloomberg Intelligence ETF Athanasios Saravegas took a look at this trend, and he joins us now. And I was reading your note, and this line stuck out to me, that single stock ETFs are seeing far more activity than ETFs managed by stock picking professionals. So it sounds like investors, rather than outsourcing portfolio management, are just taking it into their own hands.
Yeah, I think that's exactly right. They're cutting out the manager. And I think I'll give you a perfect example, ARK, right, which was like the epitome of stock picking a couple years. They're actually having a fantastic year, but they have outflows in their funds. And what's happened is with this emergence of now single stock funds, if you look at Kathy Wood's top 10 holdings, there are leveraged single stock ETFs tied to every single one of those. So I think investors are like, well, I could do that too, and I could have levered exposure to these stocks. So it seems that they're now just skipping over that and just going straight to the stock picking themselves.
So where does this leave the industry? When you think about how this is going to develop, there was a filing, I think it was from RecShares earlier this week on the 22nd, and I think there were more than 30 listings in there for single stock ETFs. Are we just going to have thousands and thousands of these single stock funds?
Yeah, we better like settle in because it's going to be a lot of fun. Like every possible stock you can think of, I think, is going to like have some single stock ETF. And then there's bulls and bears, right? So there could be two tied to every single one. There's different leverage factors they can use. There's multiple issuers that can do it. So it's just going to be, a flood of single stock products coming into the market. And there's attention, right? Like you already have a 2X Robinhood launched this year, already has a couple $100 million in assets. Like this is really intriguing to the issuers. So I don't see any reason why they wouldn't want to continue just bringing these types of products out.
And Matt, I saw an interesting tweet from Ben Johnson from Morningstar yesterday that there are now more U.S. listed ETFs than there are actually U.S. stocks. So really crystallizes this point.
That is really shocking.
Yeah.
I'm actually blown away by that figure. More ETFs than single stocks in the U.S. That's crazy.
I wonder how Athanasios feels about it.
Well, and I also wonder, Athanasios, about tokenization. I mean, you and Eric at BI will, I imagine, cover both tokenization and ETFs. Like, what's the difference between a single stock ETF and a token that represents a single stock?
Yeah, we debate this quite a bit on the team. I'm not as bullish on it because I think, to your point, I don't see the major differences here. I don't think that the marginal benefits that you're getting from it are that strong. But I think tokenization can open up some really other interesting areas like private equity, maybe some really hard to reach emerging markets, things like that. But I think trying to just replace a highly traded U.S. stock with a token, I think you just get it too easily with ETFs. Most of the platforms are doing 24-hour trading now anyways, which is one of the benefits that they tout. So I don't think that that's where the money's going to come from. I think it'll come from other more, opaque asset classes.
Well, I'm sure that is a vibrant and lively debate that you're having on the desk over at Bloomberg Intelligence. That is Athanasios Sarafakis of BI. Have a great weekend when you get there. And make sure to tune in to ETF IQ on Mondays at 12 p.m. New York time. And you can read all about the ETF industry in my weekly newsletter. That is Bloomberg.com/ETF IQ newsletter. Please sign up.
On that show with Eric Balchunas.
Yes.
And I wonder, and Scarlet Fu, but on the BI desk, is that like Athanasios, Balchunas, and James Safer? Do they all three of those guys just sit there tossing the football around debating tokenization versus ETFs and whatnot?
I think so, and honestly, it sounds pretty fun. I'd like to get invited into their IB chats.
It does. You're not in their IB chat?
We have other chats. We are news. There's a firewall there.
All right, well, it's been a pretty fun Friday.
It has been.
Hasn't it?
Yeah.
All right, you have a fantastic weekend.
Okay.
We're looking at markets that continue to rally higher, well, slightly higher, but at all-time highs. In the next hour, Ann Milletti is going to join us. She tells us where she sees a sweet spot in the market right now, so maybe there's room to run. And we're going to talk about prediction markets with the CEO of Kalshi as well.
cidade estava sitiada.
Nisso, ao começo, eu também não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home, they are suffering. And someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Bringing you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hordern in Alberta, Canada, and this is Bloomberg.
Strongly. What we're doing is moving education back to the states. The states will run education. When they do it, you're going to have the best education in the world. We'll have 35 or 40 states where it will be as good as Sweden, Norway, Denmark, you know, the top 5 or 6 countries.
How do you attract the top talent, top teachers to get into the class?
We're going to get them. We already have them. When we go back to the states with education, you're going to see a big difference. Todd Blanche is a great gentleman. He's a great man who's a great lawyer. He's got a great heart. But he's over there now. I don't know exactly what's happening, but I certainly can't talk about pardons.
Can you trust what she's telling him? She's a convicted trafficker who's eager to get out of prison.
Well, you know, he's a professional lawyer. I think he's been through things like this before. But, you know, you should focus on Clinton. You should focus on the president of Harvard, the former president of Harvard. You should focus on some of the hedge fund guys. I'll give you a list. These guys lived with Jeffrey Epstein. I sure as hell didn't. Thank you very much.
President Trump trying to walk to Marine One. This is previously recorded. I will say within the last 45 minutes. Air Force One in the air to Scotland now, where he will meet, I believe, Monday with the Prime Minister of the United Kingdom. It is a relaxing trip wrapped around Turnberry, as he mentioned there, and a new golf course up the coast of Scotland, the east coast, towards the continent, in Aberdeen, which I think there'll be some amazing images of. It is supposedly stark and gorgeous up there, wrapped around the University of Aberdeen. Let's see if we still have him. Mark, do we still have the president? We have lost the president. Okay. He's on the plane having Oreos, Vienna fingers, and potato chips. That's what they say they're stocking there. Speaking of good cuisine, we bring in on this Friday with red and green on the screen, Bloomberg Intelligence with Lisa Mateo and Isabel Lee.
Yes, thank you very much.
Have you ever had Vienna fingers?
I have, and they are quite tasty.
Good,
Actually.
that's okay. Probably this morning from the food court, knowing you.
No kidding.
Good morning.
Good morning. Good morning. Yes, you are listening. This is Bloomberg Intelligence. I'm Lisa Mateo alongside Isabel Lee. Paul Sweeney, he does have the day off, enjoying the beach on a Friday. But yes, you've just been hearing from President Trump as he gets ready, departing for Scotland. So we want to talk more about this and some of the issues that he was speaking about. Let's bring in Michael Shepard, Bloomberg senior editor in Washington. Michael, you were just listening to the president. He was talking a lot about different things. He said, trade talks with Japan, everything is amazing. He talked about Jay Powell. Let's start with trade talks. So as far as what's coming up, the U.S. gearing up for trade talks with China next week, has the tone changed? I mean, you have the White House in what it seems like encouraging China to buy more American technology, and we kind of lifted that ban on sales of NVIDIA's high-end AI chips. What's your take on it?
Well, it does sound like the president is sanding down some of the rhetoric about this agreement that was unveiled in London in June between Washington and Beijing. It was an understanding on China easing some restrictions on exports of rare earths that U.S. manufacturers need for their products, especially the auto industry, in exchange for Washington relaxing some restrictions on advanced technology. That includes chip design software, but it also includes some of those advanced chips made by NVIDIA and AMD for artificial intelligence. Now, what Scott Bessent will be trying to do, the Treasury Secretary in Stockholm, will be to try to take this trade understanding and escalate it and elevate it and address some of the other deeper issues, structural issues between the world's two largest economies. And we will see the Treasury Secretary perhaps try to go beyond what Trump characterized today as the confines of a deal with China and maybe make it something more substantive. Another key area that he talked about, of course, was the European Union. He said there was about a 50-50 chance that the U.S. would reach a deal with what is its largest trading partner. The 27-nation bloc does the most business overall in terms of trade with the U.S., and it would be facing a tariff of up to 30% on exports to the U.S. If there is no agreement or understanding achieved by an August 1 deadline that the president has set. So we're watching for that very closely. There's some key sticking points in those negotiations. A lot of those center around the digital service tax and what the U.S. has also called other non-tariff barriers, Lisa.
What else can you tell us about tariffs? Because he said he's not focused on a deal with Canada, and the EU has a pretty good chance of making a deal. And he also said that they will send close to 200 tariff letters. What is the latest on that?
Well, if a nation has not reached some sort of understanding with the U.S. by August 1st, in Trump's view, a deal will be reached with a letter from him setting whatever tariff rate he and his advisors settle on. Now, of course, to you and me, Isabel, this is it doesn't really sound like a deal, but in the president's view, that's that. And then countries can come back later and try to work out the contours of a new agreement with the U.S. that might lower that tariff rate. We've seen Japan just unveil Trump just unveil some sort of understanding with Japan. It puts the tariff rate at 15%. It also includes a $550 billion fund that Japan would establish to invest in the U.S., but the contours of that remain quite unclear, and we're still trying to learn more about that deal and other agreements too, including with the United Kingdom. The UK was the first to actually step forward and sign an agreement with Keir Starmer in the Oval Office with Donald Trump, yet the deal itself did not go to the great depth that we've seen past trade accords. Think USMCA, think other trade agreements with other trading blocs and trading partners. So we'll be looking for some of those rates to come, but we may not see the degree of detail that we might otherwise expect and that businesses and U.S. trading partners would want to see so that they exactly know what to expect when it comes time to actually export goods to the U.S., where businesses and importers here will ultimately start paying those tariffs, Isabel.
Hey, Mike, but before you go, I wanted to touch quickly on Fed Chair Jay Powell, because you heard President Trump talk about it yesterday. He went to the renovation building. He did a tour there. He said he was not going to fire him, but he kept saying that Powell will, quote, do the right thing. So the more he kind of pushes the Fed, is he more or less likely to get what he wants, to get that lower rate?
Well, the Fed has insisted on independence the whole way through, and Jerome Powell has not wavered in that stance one bit. We even saw him contest the president's characterization of cost overruns on the renovation of the Fed headquarters in Washington, shaking his head no and saying, no, you're talking about another building, when the president actually gave a higher estimate than what had been circulating previously about the cost of this big project in downtown Washington. And it was a rare moment where you see an official openly challenge Trump in that way. The president took it in stride. And even today, he moved on in his comments to reporters before leaving. He moved on from the whole reconstruction project question, which some of his allies have tried to use as perhaps cause to move toward dismissing Powell from his job as Fed chair. Instead, we heard the president yesterday and today talk about the Fed and Jerome Powell doing the right thing. And he said this morning that he thought from his conversation with Jerome Powell on interest rates that he got the sense that the Fed would be moving to lower rates. He didn't indicate whether that would come at the meeting next week. Most analysts and experts are expecting the Fed to hold steady next week when the Federal Open Market Committee meets to set interest rate policy, but perhaps by the end of the year we would see some movement in a direction that would favor what the president has want, but perhaps more on the Fed's own terms too, Lisa.
All right, Michael, always appreciate your time. That's Michael Shepard, Bloomberg senior editor in Washington. All right, so let's reset the table, get a check of the markets right now. Let's go over to Charlie Pellet with your Bloomberg Business Flash.
Hi, thank you very much, Lisa Mateo. Here's what's going on. We've got the Dow lower, the S&P, NASDAQ, they're both higher. And this Bloomberg Business Flash is brought to you by IBKR. Financial advisors switch to interactive brokers for lowest cost global trading and turnkey custody solutions. No ticket charges, no conflicts of your interests. Learn more at IBKR/RIA. We're looking at a down day for the Dow Industrials, perhaps more accurately, little change now, down 10 points, down less than 0.1%. We've got the S&P higher by 8, looking at a record 63.72 right now, a gain there of 0.1%, and NASDAQ higher by 33, up 0.2%. Indeed, stay with Bloomberg Radio throughout the trading day to see if we wrap up the week at a record. Our Mag 7 index gaining 0.5%. Tesla shares are up today after yesterday's swoon. Tesla up by 2.5%. The 10-year right now 4.41%, with the 2-year 3.91%. Gold down 0.8%, 33.42, and West Texas Intermediate crude down 0.6%, 65.63 a barrel. Bitcoin down 2.4%, just below $116,000. Intel lower after earnings. Intel plunging by 9.5%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right. Thank you, Charlie Pellet. Let's take a look at some of the stocks on the move today. Lisa Mateo alongside Isabel Lee. We are joined by Bloomberg's Red Brown. So thanks for coming in now. We want to talk about Deckers, right? That's the first one you want to talk about? I love those Hoka shoes.
Yeah, and apparently a lot of people do. You walk around New York City in certain neighborhoods, you'll see them everywhere. So, yes, Deckers Outdoor. The ticker on that one is DECK. They jumped as much as 21% this morning, now trading around 12%. That's still good enough for the top performing stock in the S&P 500 at the moment. And it caught my attention not just because of how well it's doing today, just because it's kind of a rare positive day for the company. Heading into today's session was down nearly 50%. That was good for second worst in the S&P 500. So actually having a bit of momentum this morning after the company reported really steady popularity of UGG and the Hoka shoes as well. Both of those brands grew around 20% last quarter. So, yeah, quite a positive report from the company. And I think it'll be really interesting to see what happens with shares for the rest of the year now that they are starting to post some still strong results despite some of those tariff worries that we had some earlier this year.
What about Centene? It seems like health insurers are really facing their toughest stretch in years.
Yes, that's absolutely been one of the biggest stories, I think, in the market this year. And then shares for this company, ticker CNC, went on a bit of a wild ride this morning. They fell 12% once the company reported, but actually recovered 7% to trade up. And now around 2.5% at the moment. They are the worst performing stock in the S&P 500 this year, despite the positive move this year. And that's kind of to Isabel's point there. It's just the health insurers have been really struggling with some of the government cutbacks, changes to reimbursement programs, things like that. So the company actually cut its, withdrew its guidance today, and also slashed its earnings per share view by, I don't think I've ever seen an earnings per share cut like this before. They were seeing 7.25 per share earlier this year, now seeing 1.75 cents per share, or excuse me, $1.75 per share this year. So yeah, still struggling, but the company started to lay out some plans on how they expect to return to growth, maybe some price changes coming in the future. And I think that's probably explaining a bit of the positivity at the moment. But yeah, otherwise, still pretty significant worries about the outlook for the health insurers in general. So, but yeah, interesting move today for sure.
And then on the downside, we have Intel. I mean, their shares went down 9.5%. It's kind of on how the CEO took this different kind of tone.
Yes, exactly. Yes, shares for Intel, INTC is the ticker for Intel, are trading down exactly for that reason. Analyst investors are looking, or I think we're more looking for insights into how this company is going to get back into being, a top technological leader, while the CEO is more focused, at least at the moment, for the time being, is more focused on cost cuts. So I think it's interesting when we kind of put that in contrast to some of its peers and what they're doing and how they're investing in this moment. NVIDIA, obviously, investing through this technological cycle. Their CapEx tripled last year. It's expected to grow around 40% this year. Intel, on the other hand, is cutting back. They're scaling back their capital outlays. So maybe some concerns for investors around how the company is going to continue to be competitive in this environment. But yeah, shares are down for the moment. Have been struggling for a little while now, and I guess still needing to be convinced of the turnaround plan.
All right, Brett Brown, thank you so much for your insight. For more conversations like this, you can subscribe to our new Stock Movers reports. You can listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers. It's on Apple Podcasts, Spotify, and anywhere else you listen. All right, well, yesterday, Fed Chair Jay Powell, he joined President Donald Trump to tour the Federal Reserve's headquarters renovation project in Washington. Now, during that tour, President Trump, he criticized Powell for the cost of the central bank's renovation, and this tense moment came as Trump had been escalating his pressure on Powell to lower interest rates. Take a listen.
It looks like it's about 3.1 billion. It went up a little bit, or a lot. So the 2.7 is now 3.1.
I'm not aware of that.
Yeah, it just came out.
Yeah, I haven't heard that from anybody at the Fed. You're including the Martin renovation. You just added in a third building is what that is. That's a third building.
Well, no, but it's a building that's being built.
No, it was built 5 years ago.
Well, I'd love him to lower interest rates. But other than that, what can I tell you?
That was just a portion of it. So we want to bring in, for a reaction to this, maybe the play-by-play, Michael McKee, Bloomberg International Economics and Policy Correspondent. So, Michael, you saw some tension there, but then you had President Trump saying, you know what, we're not going to fire him. But then he kept saying he's going to do the right thing. Like, he kept saying that. It's kind of this mixed message. What was your take on that?
Like handing the old Japanese soldiers the sword and saying, do the right thing.
Yes, correct.
No, he's not going to resign, and the president's not going to fire him. I don't know if you guys have dogs, but you have a dog and you yell squirrel, what happens? The dog's attention is no longer on you.
That happens with some people.
And we've got this Epstein thing out there, and I think that's really driving a lot of what the president's been doing. Now, he is angry at Jay Powell for not cutting